Lesser, where I'm the editor-in-chief of Yahoo Finance, and this panel is a strategy for the next growth cycle. And I think it's an incredibly fascinating topic. We have a great group of panelists, and I will start off by introducing them. To my far left is Renee Mauborgne, who is a professor of strategy at INSEAD. Welcome, Renee.
Thank you.
Mark Machin, who is the chief executive of CPPIB, which is the Canadian Pension Plan Investment Board.
Very good.
And to my right is Rich Lesser, who is the CEO of BCG. Welcome to all three of you.
Thanks.
So it's interesting, we're going to be talking about a strategy for the next growth cycle when we're still in a growth cycle. And so the question we will be talking about, or one of the questions is this just a continuation of the current growth cycle that we're in, or are we going to see a downturn? Are growth cycles different now that we're in a fourth industrial revolution? How should growth cycles be managed? Should you pay attention to growth cycles or cycles at all? Or should you just have a constant North Star as a leader of a business or an NGO or a government official? And obviously, these cycles pertain to everyone here at the World Economic Forum annual meeting, whether you are working for government, private sector, or a nonprofit, because they pertain to funding, they pertain to all of your constituents and how they interact with your organization. So there's a lot to get to, and I maybe want to start with Mark, because you are so tuned into the markets as a market participant. And let's actually start off by going a little bit backwards looking and talk about the current economic cycle, which is 11 years now. And, you know, the longest on record, I think, since they've been keeping track of those things. I don't know if we go back to the time of the pharaohs, whether that pertains, but certainly in modern economic history, it's a long one. And I'd love to pick your brain and sort of get your take on why it's been so long.
Well, I think one of the reasons why it's been so long is the incredibly sharp downturn before it. So it's been a slow climb back out of it for many years. And that's one factor. And then the second factor is what Ray Dalio would call the long-term debt cycle. So we have $250 trillion of debt in the world that is really keeping weighing on the economy around the world, and meaning that central banks are having to keep interest rates lower than they have been before. And so this is, we're basically in a very long, extended climb out of that deep trough, which has been accelerated recently in the U.S. by the stimulus of deregulation and for the tax cuts, etc. But there's no reason why it will die immediately, but it is an extraordinarily long climb out of that deep trough.
And maybe we'll get to a little bit later whether or not that this long upturn has to do with competency of central bankers or luck or both. But I think central bankers might want to take credit for it, but some people would suggest that maybe luck has a little bit more to do with it, or it's just coming out of a long downturn.
Well, I think it's been talked about many times. Central bankers have really carried the weight of the recovery. So they've done. Monetary policy has carried just about everything until these tax cuts in the U.S., which gave this fiscal boost. Arguably at a late stage of the cycle. But the question is, keep this going, then fiscal policy has to kick in, and that's what probably could extend the cycle a lot further if we have the combination of the two, and we take advantage of these incredibly low interest rates and in many cases negative interest rates to actually issue for governments to take advantage of that by issuing debt and then investing in things that increase productivity in the long term in their economies, whether it's infrastructure or other things. So I think that's something that governments have to take over from central banks, or work hand in hand, or have even a formulaic linkage of the two.
Renee, I wonder how these cycles sort of relate to your work, which is about companies and succeeding in these new environments, blue ocean strategy. Can you talk to us a little bit about what that means, first of all?
Sure. So Blue Ocean strategy is about how do we break out of competing in existing markets and create new markets. And what we have seen is, and I think we all know, our business cycles are very hard to predict. We don't know what we don't know. And that in business strategy, though, there is a truth. What we see, there's a pattern about resilient growth across business cycles. So whether you're in a growth cycle or a contracting cycle, there are strategic patterns that lead to resilient growth. And so in strategy, there's market competing and market creating. And those that invest in market creating tend to have good upside growth, like all firms, in an up market. But when the market turns down, they have strong rebound potential. So if you look at the recent downturn that happened, who was growing and bucking the trend? It was Amazon. It was Netflix. It was Apple. They're growing in spite of a downturn. So it's what we see as market creating as critical for resilient growth across the cycle.
And that sort of speaks to whether or not you should even pay attention to cycles. I mean, obviously you have to pay attention to cycles to a degree, but how much do you recalibrate? Because predicting when the cycle is going to turn, of course, is next to impossible.
I think the companies that are creating these new markets, their real focus is, how do I offer a quantitative leap in value? They're not focused on the competition. And how do I offer a quantitative leap in value to buyers? And if I am able to offer a high delta of value over cost, I believe the buyers are going to come to me. And even more so in a contracting market when consumers have to make difficult choices with their cash, and they're going to look for who's delivering the highest level of consumer surplus to me. And it's the ones that do innovative value there are. So I think that's where the real prize is on. Do they make some adjustment? And I'm not to say maybe build a factory when things are growing or not, if a factory is even needed. But the real eye of their prize, what they're really looking at, is delivering that leap in value to buyers, I think. And that's what they think. If I nail that, I'm likely to have sales that are going to follow. Yeah.
And this is kind of close to some of the work that you guys do at BCG, obviously. I mean, I know, Rich, you have done a lot of work, and I think have sort of looked at 5 pillars of growth or ways to sort of organize a company or an organization around these pillars to sort of set yourself up for a successful decade in the roaring 20s that we're in, maybe.
So I don't know about the roaring 20s, but I'd like to highlight 2 elements in here. First, I do think the ability to predict, I think, has been shown over and over again to not be so high, including here in Davos, where we were talking before. The prevailing mood of how it feels here has often, a contrarian investing strategy might have turned out pretty well in many, many years.
Right.
So I think we can never overestimate how much we know about exactly what will happen when. But we do talk about what it means to build advantage in adversity. And that part of advantage in adversity is thinking about how you prepare in advance, not when you're in it. What can you do to preempt? Because the companies that get ahead of it are often the ones that come out stronger. How do you still look for growth vehicles? Exactly Renee's point. And when you look at the companies that win in downturns, they find growth. And then how do you use those moments to transform and take on challenges? So I don't minimize. In fact, I think it's quite important for every company to be thinking about the potential of an environment and what they would do. But the core question for most companies is the one you alluded to, which is, what is it going to take at a time of so much change and so much transition in the world and uncertainty to win the 20s? And as you said, we talk about 5 themes that we see as essential. Competing on learning, the nature of competition is shifting, and the power of data and the ability to turn it into action is an enormous unlock and a source of advantage and speed in the years ahead. Building bionic companies that combine machines and people. People a few years ago here even, all the conversation was, will the machines replace all the people? And I think most CEOs I talk to today, having now lived with it for a while, don't see it that way. They see that, yes, the algorithms and data and IoT will provide enormous power, but the key is to get humans upskilled, working in different ways, integrated with technology. And how to do that is a huge challenge and a new form of change, which is the third point. New models of change. The fourth is the power of diversity, not just because it's the right thing to do, but because it creates more resilience, more innovation, more adaptiveness. And the fifth, which has been the theme of Davos this week, is the importance of finding synergistic ways to create societal value and shareholder value at a time of both more challenge to the world and more scrutiny. And so much as we do believe in preparing for adverse environments, we think the core of leadership's agenda is thinking about those 5 elements, what it means for them in their industry, given their position, and how to make that work in the years ahead.
Well, there's a lot of stuff there. I want to come back to you
Sure.
And to drill down on some of that. But I want to go back over to Mark and get your thinking on this notion of how much do you manage for the cycle and how much do you ignore a cycle? Because I know that's something that you look at when you're looking to invest in companies.
Yeah, so from an investor perspective, as you said, it's to exactly time a cycle is nigh on impossible. So it's something that as an investor we don't do. So we believe we have skill on designing portfolios that are going to perform in the long term, that are diversified, and are going to be resilient to an economic downturn or shock. All right, so that's the first thing we do. And then the second thing we do, we think we've developed skill in, is picking the good company over the bad company, the good deal over the bad deal, the good building over the bad building. So that security selection skill. We believe that we have those 2 skills. The short-term, market's going to go down by 200 points in the next few weeks. That, we don't know. And even, what's GDP going to be like in the next 6 months? Not sure we can really time that perfectly. But if we get the first 2 right, we can make good value over time. When we invest in the companies, likewise, we want to make sure that they are thinking for the long term. So they're planning for the long term, but they're also resilient just in case that things come along. So one of the things, I think an additional thing I'd add, maybe the 6th thing to Rich's list.
Can you add one on?
Anything Mark can always add on.
Well, the thing from our point of view is, as capital providers, is we want to look at balance sheet resilience and liquidity as well. So we want to make sure that people, while they're doing all those 5 things, and that there's a terrific list for long-term planning and making sure your company is really resilient for the future. But the other one we'd probably add in is making sure that you have a balance sheet that has sufficient liquidity, that you have debt that's turned out sufficiently, that you've stressed it if you are wrong over the next year over what your economic predictions are, and that you can weather that downturn. So we spend quite a lot of time with the management teams of portfolio companies that we're in, where we sit on boards and making sure they have that capital planning in place.
So do you actually say, okay, we're going we think a downturn's coming, and so we're going to change our portfolio, our investment strategy from X to Y. Do you not really think that way, or?
No, I mean, not really. So one of the things, I only say, if we look at our portfolio construction overall in the longer term, one of the things we've done is we are increasing a little bit more in renewables, obviously because there's a long-term trend there towards more renewables and climate change and infrastructure related to that. And one of the things with that is, that is going to be much less cyclical.
Right.
And so that's going to be the type of business you can invest in through a downturn and should have, great resilience. So, for example, we just bought Pattern Energy in the U.S., one of the largest renewable companies in the U.S. for $6 billion, and we think that'll be a terrific business that we're going to continue to expand, and we think will be very cycle resilient.
Yeah, cycle resilient, that's a great phrase. And Renee, I want to ask you about that, because when you mentioned the companies that were able to buck the trend, I mean, you talked about Netflix and Apple and Amazon, they obviously have such a wind at their back, in part because they're so well operated, but in part because they are riding incredible trends. Mm-hmm. Can old school, say, industrial companies become blue ocean companies as well? And how would they do that?
Yeah, so first, yes, they can. A government can become blue ocean. Dubai's been striving to become a blue ocean, and it turned a patch of sand into a mega metropolis that everybody around the world wants to come and see. Right. But if I go back for a second, I agree with all of the points Rich made, your 5, and Mark, your added 6. The question becomes, what are we directing those? That's internal capabilities. These companies that buck the trend direct those internal capabilities to a mindset of market creating and a balance with market competing. Many companies develop these internal competencies, but they keep them stuck in existing industries and competing and competing and competing. So if we look at how Microsoft recently turned around, its stock price was very flat for the longest time. What happened recently? Well, when Nadella came along, he started shifting that culture from a pure competing mindset of what it was doing. Microsoft was a really competition focusing on Windows and DOS all the time. And it said, no, we're going to start thinking about cooperation, creating, innovating. They launched Azure, and they're shifting that balance, and now they're creating growth. So you need the resilient internal structure. I think I really agree on that. But how, as we at organizations, where are we directing it to? And to your point, yeah, so whether you're an industrialist, a nonprofit, a for-profit, we can all think creatively and create new markets. So yes.
it sounds like leadership is so important there. I mean, you mentioned Satya Nadella.
Well, thank you so much. It's extremely important. So, a lot of companies say, well, Renee, we've got innovation going on, but what they have it on is it's a function. It's on the side. And so the CEO every now and then stops by and sees it, but the message being sent is corporate strategy is competing. And we'll look at the R&D. Microsoft had huge R&D budgets for the longest time, some of the most impressive labs. It just never got into breakthrough products and services in the marketplace. What sets Amazon, Apple, now today Microsoft, Netflix, those CEOs, Gilles Liberté from Cirque du Soleil, he bucked the trend as well.
Yeah.
They own it. It's a discussion the CEO is having. So it's not a side branch. It's part of the corporate strategy that's doing it. So the question is, what does your diary say about what you're spending your time on? Competing every day? What's happening in the existing market, or creating as well our future growth? So your point to leadership is spot on. It's held by leadership.
Right. And Rich, maybe you can pick up on that a little bit, because your clients, I'm sure you have a whole range of CEOs and other leaders that you have to deal with, and sometimes they get it and sometimes maybe not so much.
Yes. I also think we're seeing an underlying shift, and then I want to come back to something you asked, Mark, about that I think is important to note from the standpoint of the company rather than the investor. But to your point, we lived in a time for almost a decade, from the middle of the last decade, the one before, 2005 to 14 or 15, where it felt like the key element and a lot of the focus of markets was around executional excellence and driving productivity and doing that. And the tech companies were an exception, but for many others that was less the case. And what we see is the balance between execution and innovation and thinking about future growth is always there. Any good leader is thinking about those two elements, as well as building their team and the next generation and what they're doing. But we are seeing a shift right now, because the level of disruption that exists, the kinds of new opportunities that technology opens up in many places, new kinds of consumer behaviors, that we see and observe that leading companies, CEOs are thinking, of course you still need good execution. If you ignore what you need to deliver to the expectations that the market has or whatever, you normally don't get to stay so long in the role. But the relative emphasis around innovation and thinking about what's next and how to embrace a world where technology is infiltrating every sector of the economy, and what that means for the way work gets done, the kind of roles companies play in the world, that goes up greatly in importance. Back to your comment about ignoring trends, I guess I would highlight, I actually don't think if you're a corporate CEO, your responsibility is to understand how you perform across the environment, to think across different scenarios, right, and to think about what you can do in the event of certain scenarios to take advantage of them. And if I look back at not a high-tech company, but another kind of technology in the biopharma world, if you take a company like Pfizer that 15 years ago was viewed as entirely focused on large molecule, general practitioner, traditional chemistry, the decision to buy Wyeth at the middle of the downturn, like the worst, January 2009, to pull the trigger on that deal was a brave decision that could not have been done if management hadn't been thinking deeply about strategy and where they wanted to take it. But had they done that deal a few years earlier, the price would have been dramatically higher. So it was both understanding the strategic long-term, where is the world going in growth, and where will future markets come from. That's strategic, long-term, growth-oriented, and it's very much thinking about the cycles and saying, but this deal's really expensive, and probably wasn't. I'm sure they had a portfolio of things they considered, but this doesn't make sense now. But when times got tough and many people were backing away, they had the balance sheet, they had the ability to get the financing, and they were able to take a deal that operationally allowed them to position against a long-term strategic goal. And so I think that's what we look for leaders to do. We look for them to have the long-term vision about where they're trying to go, shift more towards innovation and growth in the world we live in today, but also have the sophistication to think about how would they play that differently across different environments, and what moves could they make in different scenarios, and to be prepared so when those moments hit, they're ready to move.
It's interesting, because I guess what you're talking about is actually planning, like as you said, scenarios. This company, for instance, is something we might want to acquire, but can you really afford to sort of wait? I mean, it's like timing. It's like stock market timing, though. I mean, which is to say,
But there's often a different question that gets asked, and Mark lives with day and out.
Yeah.
It's not just, it's a question of, does this make sense from a financial point of view? You invest billions and billions, you need to get a return. And in some markets, you can know something would be strategically lovely to have in the portfolio, but you can't defend the premium you need to pay to do that. But in another market, at a different point, if you believe in the long-term strategy, you could say, well, I could take that bet because I still believe in the long term. So, but you have to, without preparation, without thinking deeply about that, it's very hard in the midst of really difficult times to focus on anything other than the here and now. So if you haven't prepared in advance, the odds of being ready to take advantage of those opportunities goes down substantially.
Right.
Yeah.
I
agree. I mean, I think from an investor point of view, one of the ways we do this is we create platforms with good management teams around particular areas where we want exposure. Those teams, for example, whether it's in renewables or student housing in Europe or in financial services, in insurance or reinsurance, we'll have very competent management teams that are doing a core business, and when they see, when a downturn happens or another company runs into trouble, we can work with them. We can deploy more capital quickly into that vehicle, and they can acquire and build that platform. And so I think what's important, we don't want to be in a position where when a piece of stress happens in a particular company, whether it's isolated, whether it's because of a market downturn, that we're just starting to get into that strategy and we're starting to put a team together that would understand it. That would be too late. So we want a team operating, I say, in insurance, reinsurance, renewables, et cetera, the housing, where that team can then seize those opportunities quickly when the opportunities arise. And we, as a long-term capital provider, can put the capital in and help them exploit those opportunities. And then the other way we do it is just with particular companies as well that we have investments in, where they are running the metrics, running their eye over these companies all the time, looking at a company they like to buy, but the opportunity hasn't risen. When it does, then we can put more capital into that company and they can go buy. And so we've done that a bunch of times with companies like WSP, the engineering company in Canada, for example, where they've made multiple acquisitions in that way.
Right, so it's sort of echoing a little bit what you're saying.
Exactly.
Do you make any distinction between market cycles and economic cycles. In other words, the stock market, I mean, they're more or less correlated, but is there a distinction worth making there?
I'm not really sure. I mean, from a company perspective, you know, if you're going to buy something, obviously it's the market valuation that matters. So, you know, if it's a publicly listed company, so a market cycle and you know, company's value plummeting would be you know, quite helpful if you're looking to buy that company. And it could be triggered by an economic cycle. I mean, you know, there's some sort of pseudoscience that, you know, market cycle can precede economic cycle by you know, almost a year.
Right.
But you know, I say, you know, I'm not sure the economic, you know, someone who's an academic will tell me whether that's really science. But so I think you generally market will anticipate in some way, and you know, but market can be wrong as well. So.
Right.
You know, for us, I'd say 50% of our holdings are private. So, and as a long-term investor, we want to make money in the long term. We don't care about the next quarter, the next year. We care about the next 10 years, next 20, 30, 40 years. So, market's somewhat irrelevant to us from that point of view, other than for seizing the opportunities when they arise, because companies are buffeted around by market.
Right. Renee, I liked it when you talked about Dubai, because, again, we hold up these big, particularly tech companies, so much and so often. There have to be other entities out there succeeding. And in particular, I'd love to know, maybe we can ask the audience a little bit, you know, what NGOs are bucking the trend? In other words, and, you know, to a degree, NGOs are beholden to the cycle in terms of, say, fundraising. Mm-hmm. So which NGOs are succeeding through different cycles, I think, would be a really interesting topic as well.
I mean, even if I just think about a charity like Red Nose Day or Comic Relief in the UK,
mm-hmm. Yeah,
which is totally bucking all cycles and shot the lights out of, you know, has 96% brand awareness in the UK by selling a £1 nose and making the whole UK every 2 years, so you don't get tired of being always demanded money all the time.
Yeah.
And every 2 years you do something funny to raise a little bit of money. And, you know, they've raised billions. So they're one that, to me, has really bucked the trend, you know, in the nonprofit space, I would say. Yeah.
That's a great example. I want to ask you, as maybe a futurist, what you think are some elements that are changing business cycles. I mean, two things that come to mind. First of all, technology. We keep talking about that all the time. Climate would be another one. Pandemics, which is obviously, sadly, very much in the news right now, potentially. Have you given any thought to that, about how cycles would change relative to new factors?
I think technology is one of the key factors I see happening. It makes more and more players be able to enter the market from anywhere in the world, drops the cost of doing business, global business, dramatically, which in effect makes innovation and market creation even more important, because the number of players that are entering the global economy and competing from any place in the world with the price of a website. So, you know, I think that is changing, and so companies are thinking more along those lines.
Right.
You know, I think governments, hopefully, in monetary policy, they're learning their lessons, are getting smarter. And what I see right now, and we were talking about it in the room, even though we've been in this long growth cycle, when I see consumers today, at least in the U.S., let me speak, every market is different, and I speak to corporate executives, they're not exuberant nor optimistic, but they're not completely skeptical. So they're skeptically optimistic, and I think that's a very healthy attitude for a growth trend to start to continue. Because if you look at John Templeton, I think he had said, the investor, you know, a bull market starts with pessimism, grows on skepticism, matures on opportunity. When you're, what's the O word?
Euphoria?
No, opportunistic and euphoria.
Euphoria is the end.
Yeah, it goes
Right.
down.
Yeah.
So, you know, I think the optimist. So I think right now we're seeing right in between growth and that. And so I think that's also part of what is changing. But maybe, Rich?
I was going to add one other factor that I think is a longer term trend, which is keeping the cycle, keeping growth in check, which is demographics. You know, just the world is aging. almost every
And that's
major...
extending the cycle?
Yeah, well,
The upcycle?
I think it's almost every major market every major economy has a substantially aging population, and as people age, they consume less. They have different requirements, medical and other requirements, but they tend to consume less, and behavior changes. But it's one of those mega trends that's out there, like climate change, like
right. So it's not
technology.
necessarily extending the cycle, but it is certainly changing the cycle.
It's good. It's one of those things that's changing the cycle. Yeah.
Yeah, I mean that's interesting. Talking about responding to those large changes and jumping on a trend that would help one's entity buck the cycle. Just ride that. In other words, if you're not creating an iPhone, well, what can you do? You can do something like this. Maybe you're a food manufacturer. Take advantage of that trend and point your business in that direction.
But I think you have to think about it from both an opportunity and a risk vector. And let's take two at the top of the list right now beyond technology's core and will stay fundamental for the decade ahead. We've talked about it a lot. If I just take two others, climate is a huge both opportunity and risk. And companies who ignore it, I thought, the conversation at Davos this year felt of a different tone to me because I think people are starting to realize just how fundamental this is to the future. Opportunity in terms of getting ahead of the trends of the world. What Ørsted did to reshape its energy portfolio, what others have done on many other sectors. And risk of not taking this seriously, not risk of when it will actually hit, risk of when the capital markets will realize it's eventually going to hit with some certainty, and then the multiple on the value drops down. I have a house a few blocks in from the beach in New Jersey we've been going to. If climate goes up a degree and after 2 degrees, my taxes probably go up. There's more infrastructure, whatever. Yeah. If climate goes up 3 to 4 degrees and we don't change it, it probably has no value. I mean, at some point. Right. But that's decades away. But the question is, when will that hit? It's when will people realize that hits?
Right.
And now that's a small asset, and that's not. But for many companies, it's a sort of a parallel question about portions of their portfolio. So that requires both sophisticated thinking about opportunity to be on trend and risk mitigation, and it's hardcore investment decisions. It's not just a societal obligation, though that's true too. The second we talk about a lot is all the geopolitical uncertainty. We don't know how that will play out, and we hope that things will work out in a way that will allow for effective global supply chains and things to work. But if you're not a business thinking carefully about your supply chain, not just in a best case scenario, but across a range of scenarios to create some optionality for how you build supply chains for different environments that are beyond your ability to control, you're putting risk into the enterprise that might not play out, but could. And so I think these sorts of trends are quite important for companies to engage in, not necessarily to know the answer, but to think through what it means under different scenarios.
and getting back to your first point, Rich, about climate, I mean, for instance, maybe people don't realize it, in the United States, the coal companies are all bankrupt. They filed bankruptcy because of a problem accessing capital, because of potential litigation, because of the lack of demand for the product. And so, you know, those things happen slowly and then they happen very fast. I mean, that's the old saw, but it's really true. I wanted to ask any of you all how much any of you have studied Australia. And the reason I bring Australia up is because it's been on an it's been on an upcycle for 27 years. And it's amazing. I mean, talk about not being a part of the trend. And I'm wondering if anyone has any thoughts on how the Aussies have managed to do this.
I mean, it's been absolutely remarkable. And one thing to note is the flexibility of the currency. So, you know, the currency will go almost parity to the US dollar and then down to 50 cents. And you know, over time, you know, approximately. That's a huge buffer for them in extending that cycle. I mean, there's a huge, having that free, you know, that free floating currency, and you know they've also had the huge draw of demand from China. So you know, it's an export-driven economy for many and the growth of China over the last, you know, over that time, 27 years, has created an enormous boom. I mean, the challenge is their dependency on China, but then India's coming as well. But they've also got a dependency. You know, they've got to diversify away from that heavy dependency on a commodity-based economy, which they've been doing. But that's one thing. I mean, I know, you know, the alarm when I know the renminbi moves by 3 or 4%, and the world sort of panics occasionally. If you look at that currency, that can move around a lot and create a huge dampener.
I think they've also done a pretty good job at accepting immigration as a core part of the growth strategy of the economy.
Yep.
And for instance, in other countries, immigration comes and goes. And I think they've had much more of a long-term perspective on this as a part of how our country's going to grow. It's pretty interesting.
Yeah, no, that's true as well. So, it's definitely been a core part of the growth. You know, it's similar. You know, it's not without challenges in Australia over time, as in any country. I mean, it's always challenging for countries to calibrate that so it is acceptable and people don't feel like there's too much immigration and jobs are challenged and they feel threatened. And so I think, but they've also had quite an intelligent immigration system looking for, you know, talented people, people bringing money, people bringing skills. That has been quite a thoughtful system over time.
Right. Renee, before we open it up to questions from the audience in a minute or two, do you have any specific tips for any of these organizations that are represented here in terms of being able to become a blue ocean company?
Yeah, you know, I think one is, I would just say that, you know, look at your portfolio of your opportunities and make sure you're always working to have a good balance between your market competing, which is generating your cash, and your market creating, which is generating your growth and your resilience. Do you have that right balance? And then second of all, ask how serious are you about that balance? And in reality is, where is that balance occurring? Is it in an R&D lab or in an innovation function? Or is it really happening with a top team on a regular basis? Because as we articulated before, and Andy, you mentioned it, in these companies, these CEOs are discussing it all the time. And when things don't go well, and I've heard it from multiple CEOs that are driving these companies, they never say it's because the market is bad. They say it's because we're not putting magic in the market. When you put magic in the market, so what they effectively try to do, try to be very smart about the world, but they try to make the results and they try to put the pressure on themselves to take excuses away from the market to justify performance and themselves. So I remember even talking with Hasso Plattner back here at Davos. It might have been 1998. And we're asking him, you know, how did SAP come from, you know, create this big global giant? And he said, you know, I always challenge my people. What would it take to win the massive corporate buyers with new marketing? Not that he didn't want marketing, but he challenged his team to be so good in the value they delivered, people couldn't resist the offering. Those are the types of questions I would just say, are we having those discussions? Microsoft for so long had us all that R&D, but it was on the side, and it wasn't doing that. And a third tip, and let me get out of that, always ask if your technology is linked to value. The companies that were saying they're technology players, there's tons of technology players out there, but they don't have 1 trillion market cap and growth. Right. And the difference is these companies are fundamentally always asking, is our technology linked to value for the marketplace? How does it make people's lives better, cheaper, easier, funner, more productive? And that's critical there. So not tech innovation, but value innovation is what opens up blue ocean. So, yeah.
Can I just add one point? I very much agree about this focus on value innovation and obsession with the customer and where the world is going and how you find new sources of unlock. I'd just like to highlight in the world we're heading toward, what you do inside your own organizations is an enormous power and unlock. And the decade ahead that we're facing, where technology is going to be so intermixed to every core business process, whether it's how you build relationships with customers, run your manufacturing, organize your administration, operate your supply chain, that it's going to create an enormous challenge for companies and a source of competitive advantage for those who do it well about how they bring along their workforce, how they make themselves a magnet for really top talent, how they change the way work is done, how they build a sense of purpose and deep meaning into their organization so that people are not just executing their job, but are energized about it and therefore ready to take on the challenge of learning new skills and working in different ways. And it's not in any way minimizing the external requirements and opportunity, but I think sometimes it's easy to lose sight of how much the organizations are going to need to evolve over the next decade and how powerful it can be for companies that can get that right.
Make sure your board has the people who can understand this and predict.
Great.
So you have people on your board who understand where the world's going, have the digital skills, who you're actually in touch with younger consumers, are in touch with these trends. So make sure, this is one of the things we do, work with our portfolio companies to make sure they have those people in place over time.
All right, we're going to ask Mark one last question before we get to the audience. What about the cycle? How long is it going to last? You're the market guy here.
I'm glad you asked him. I'm glad you asked him.
No, I was going to ask you. I said maybe it's unfair, but it's his job.
I told you that that's incredibly difficult to predict.
Yeah. Having said that,
having said that, I mean, I think the central prediction is we're in a world of lower for longer. So we're in a world where it is likely that this cycle will, provided this sort of stability in international relations, particularly between the largest two economies in the world, then I think we're going to end up with fairly soggy, extended growth across the world. The U.S. I think will keep powering along. I think Japan's bouncing around. Some very low level of growth. Europe, some very, very low level of growth. But we saw the IMF predictions of 3.3% growth for this coming year. So I think we're going to be. I think this could extend sub-trend growth for another few years. So
China's going to be okay.
China over the long term, again, it depends on the relations with the rest of the world. But over the long, and obviously they've got the short-term crisis right now with the coronavirus, which we all hope is managed really quickly. But if you look in the long term, they're on a slowing trajectory, and there is a massive economy that is going to gradually slow. By the end of the decade, it'll be down at sort of 4% growth gradually.
Really?
Yeah.
In China?
That's a view.
Yeah. And so we're fine, except for those several black swans out there that we don't know what they are and can't see them at all. That kind of thing, right?
Yeah. And the other thing, aging in China is the biggest. They'll have 250 million people over the age of 60 by 2050. They'll have 100 million people over the age of 80.
Healthcare in China, then. That's a good trend.
Yeah.
But can I just, I was interested in, more question for Mark. You talk about below trend growth, but in a world where demographics in the world are shifting quite a lot, where the capital intensity that's often required in many industries to deliver value to customers, I think continues to go down. We see many lower capital ways to bring value to people. Do you think lower trend growth necessarily means lower trend sort of impact and what it means for citizens operating in those societies? Like, how do you, because we've got a demographic shift that's quite fundamental underway.
I'm quite sure about the quality of life in Japan, where they've had extremely low growth for many years. Quality of life in Japan is fantastic.
I love that point. And there's a lot of, sorry to interrupt, but there's so many countries around the world where economists, particularly U.S. economists, say that's a terrible economy. And you go there, and it's a wonderful place to live.
Yeah.
And this gets back to Joe Stieglitz's point of, are we measuring the right thing, which is GDP and et cetera. Go ahead, sorry.
Well,
I go nuts on that one.
Yeah, that was my point.
Okay, sorry.
Yeah.
Right. Anyway, do we have some questions from the audience here? We have someone. One over here. Yeah, sorry. We forget the mic. Thank you, sir. Okay.
In view of this energy transition, what we are seeing now, what will be your estimate for the next strategic growth cycle for the oil and gas industry?
Well, so first, I think it's important to get the balance right. Energy will be critical for the world and for many parts of the world that are underserved and are energy deficit for many years to come. And so we need to have an energy transition in the economy. We talk about it all the time. It will take a while to get there, but we need to start soon to move toward it. I think that the leading energy companies are all either are or will soon be thinking deeply about the energy transition they need to undergo and how to use resources, because the world will need a huge amount of energy, and how to get it in more productive ways. I think that's the trend. So if you describe it as oil and gas, I think the trend is obviously going to be challenged. I don't necessarily mean in the very short term, because I think there's a fairly long time where it won't drop as much, but certainly longer. If you broaden it to energy companies, I think they want to be a part of the future of providing energy for decades to come, and I think most of them are going to be thinking about how to be a part of that. And the more innovative ones, I'm confident, will unlock ways to contribute for long periods of time.
Yeah, and to Rich's point, I mean, we see the oil and gas companies showing an interest about how do they create blue oceans, whether in oil and gas, but also realizing the fundamental shift to environmental friendliness. and some of the key producers themselves talking about how do we start to think about creating blue oceans in the new renewable energy spaces. So shifting that portfolio from only gas and oil to all new sources themselves. And so we see that happening, yeah.
Okay, thank you.
Great. Other questions? You guys did such a great job. You answered everyone's questions. Maybe that's the case. Anyway, I think that the discussion was really interesting to me because instead of sort of focusing on when this cycle is going to end and when the next one's going to crop back up again, we were focusing more on how to mitigate the cycles or how to ignore the cycles or buck the cycles and how to position yourself from these various perspectives that our three panelists have to sort of ride above the cycles and sort of make sure that you're positioned in a way that whatever happens, obviously you're going to get beat up to a degree, depending on what sort of entity or what sort of business you're in. But the best way to think about it is just to make sure that your company or organization is positioned so that you'll be able to succeed no matter what the cycle is. So to me, that's actually something that I hadn't really considered as more important than the cycle itself, being someone who follows the market's twitches every single day. So it was nice to hear people saying, forget about that a little bit. Anyway, so I hope everyone has a wonderful day and a wonderful Davos, and look forward to seeing everyone again next year. Please join me in thanking our wonderful panelists, Rich Lesser, Renee Maborn, and Mark Machin. Thank you guys so much.
Thank you.
It has been a busy week here in Davos, all manner of subjects being covered. You just heard about strategies for the next growth cycle, and we've been covering all kinds of stuff here this week. And you guys, this is all a first time for the three of you, so gotta ask you, what's a little takeaway from your first time at Davos?
Well, besides the fact when I was walking to a panel, MLB Commissioner Rob Manfred was there. That was definitely interesting. But for me, it was how the administration, the entire administration, came out in full force. And I think to distract from the impeachment proceedings going back on in Washington, D.C., they really hammered home their economic message and how fast growth has been.
Julia.
I gotta say, I didn't know what to expect going into my first World Economic Forum, and I really enjoyed the whole experience. And what I found interesting, Andy, is that we had two very powerful forces here. We had President Donald Trump, and we had Greta Thunberg, the climate activist. So it's just been kind of an interesting conversation around those two figures. And I gotta say, I think more people are leaning toward the Greta camp than the Trump camp.
Max.
Yeah, for me it was that, this conference is known for a place where business and political elites come, and it gets a lot of criticism as affirming and solidifying their power and excluding others. But you do see voices of dissent here. This morning I was speaking with Joe Stiglitz, who handed out leaflet piece of papers during Trump's address at the conference, criticizing it in real time. We've heard from Greta Thunberg making her critiques of some of the slow pedaling of reforms needed for climate change. So it's interesting that a conference known for maybe the wealthy and for the powerful to talk to each other and meet up in the Swiss Alps has voices that you might not otherwise hear on the international stage.
I think that's actually one of the really important parts that he just brought up is just the meetings that people have. And you don't know exactly what they're saying, but you'll see two CEOs that you recognize just having a side conversation.
Right, and for me, this is, I think, my 9th Davos, more than all of you have put together times 3 or something like that. It's the same thing every year, but it changes every year. There's a slow evolution, you guys, and right now there's more and more companies here having more and more meetings and more CEOs, and be interesting to see how it evolves next year. We'll see you then.
Good morning, everyone. I'm Shauna Smith.
And I'm Dan Roberts. Brian and Alexis are on their way back from the World Economic Forum in Davos. This is the first trade for Friday, January 24th.
Well, downplaying climate change, the stunning new words from Treasury Secretary Steven Mnuchin as Wall Street focuses on sustainable investing, why he says experts are overestimating the financial impact.
A big beat. Intel soars in the pre-market after posting better than expected results. Revenue climbed above $20 billion.
And heading for $900 a share. As Tesla heads even higher, we speak with one analyst who has a very big prediction for the stock.
All right, let's get a check of the futures ahead of the opening bell on this Friday morning. Right now, we are seeing green. Futures are up. The Dow right now up 75 points. S&P futures up just 6. NASDAQ futures up 25 points.
Well, let's see what is moving the markets this morning with this morning's buzz.
All right, Emily McCormick is live in the newsroom with the buzz. Emily, let's talk earnings. Let's start with Amex, American Express. How did it do?
Well, American Express had a solid beat on both the top and bottom lines for its reported quarter, also guided for full-year adjusted earnings per share ahead of the midpoint of consensus expectations. Really seeing a benefit here by a combination of higher-than-expected card fees and lower-than-expected costs in the form of rewards for customers. And remember that American Express has been ramping up its rewards, especially for its flagship Green Card, but really didn't see an impact to cost from there. Overall rewards costs climbed just 8% to $2.72 billion during the fourth quarter. That was better than the $2.76 billion average of analysts. Also benefiting from a strong consumer overall, continuing to spend with its cards. Total spending on the firm's cards rose 5% over last year to $325.2 billion. That was just below the $327.3 billion estimate, but again, it's still posting year-over-year growth. And then at the same time, there was a little bit slower growth on the corporate cardholder spending, but overall, really solid results. Net card fees, $1.08 billion, so still racking in those fees from customers.
Emily, another big mover today is Intel. They were out with earnings after the bell yesterday. The stock is getting a pretty big boost this morning, trading near its highest level in around 20 years.
That's right, Shauna, and also pulling that Philadelphia Semiconductor Index up with it with this 5% gain in Intel shares in early trading. Intel has really been a beneficiary of these big tech companies like Google, Amazon, Facebook, building out their cloud computing capabilities and demanding these server processing chips from Intel. So this was a beat on the top line, beat on the bottom line. Full year revenue was at an all-time record high of $72 billion last year, and also delivered guidance for the current quarter and full year 2020 that was ahead of consensus expectations. Looking at these fourth quarter results, Data Center Group revenues, that was up 19% year over year to $7.21 billion, and PC revenue grew 2% to $10 billion. So a little bit more modest growth there, but well above that estimate for just flat to negative growth for the quarter. No signs yet that AMD, which of course is a main competitor for PC, that PC unit encroaching on Intel just yet.
All right, Emily McCormick, thank you. Now for today's big story. As world leaders head home from Davos, Treasury Secretary Steven Mnuchin is once again taking on a key issue, climate change. But he did tell the closing panel there that let's not call it that. Let's call it, quote, an environmental issue instead. He also brushed off the big concerns from Greta Thunberg, Larry Fink, and others about sustainability. We have Brian Chung joining us now. And Brian, when we take a look at what Treasury Secretary Steven Mnuchin said, he wanted to call it an environmental issue, wanted to distance himself from that climate change. What did you make of that?
Well, this was an extension of what we heard from his remarks yesterday, where he was saying, in response actually to a question from our own Max Zahn of Yahoo Finance out there in Davos, where Steven Mnuchin said Greta Thunberg should go get an economics degree before she talks about some of these issues, to which Greta Thunberg responded with a tweet yesterday saying, my gap year ends in August, but it doesn't take a college degree in economics to understand the impact of the carbon budget. So I think that this is just an extension. We know what the administration's position is on climate change. They haven't necessarily taken it up as much of an issue as the Obama administration did. They just seem to think it's not an issue. Not that they're denying that climate change is an issue. They just think that there are other things higher priority. That's what Steven Mnuchin was saying on the panel today, where he said, quote, I don't mean to minimize this issue, referring to climate change, but he said, quote, there's lots of other issues we could talk about. The world is dependent upon having reasonable priced energy for the next 10 to 20 years. So it seems like the pricing of fossil fuels, not the divestment of it, is a bigger priority for the Trump administration.
Arguably, and I know you've been watching everything from Davos closely. If not Greta herself, climate change as a topic has been, to me, the closest thing to a theme for this year. I mean, if there's been a unifying theme, CEOs discussing it, Mark Benioff and others saying, time to practice conscious capitalism. I mean, they always say things like that. Yes, Larry Fink's letter. But it does feel to me, maybe in a year we'll be saying, no, it's this year. But it feels to me like maybe this year is the turning point where everyone is at least claiming that they want to prioritize climate change.
Yeah, I mean, I was at the Davos conference last year, and they did talk about climate change, but I didn't think it was as much of a adopted theme as it was universally in this year's Davos. And even in the conversations that on the many interviews we've had here on Yahoo Finance, we had Dambisa Moyo, who's a Zambian economist, and she was saying, look, I think that climate change is definitely an issue, but the suggestion to divest from fossil fuels, she called it naive because she thinks that those are the same companies. Now, again, she's a board member at Chevron, but she thinks that those energy companies are the ones that could actually provide some sort of discovery in terms of alternative energy sources. Now, Greta Thunberg, in her speech on Tuesday, which really kicked everything off, she said, when she called on companies to divest, she said, people will probably call me naive. So, I mean, there's a lot of jostling around at Davos. A lot of people seem to acknowledge that climate change is an issue, but there's a lot of differing opinions over where the responsibility to address that actually lies.
Well, and what's interesting, it's going to be just interesting, I guess, going forward, watching if there's other companies that also kind of take after what BlackRock just did and kind of shift their strategy and focus on ESG investing in terms of their pathway forward, because we talk about the younger generation, specifically millennials, and a lot of millennials are very focused on this or very aware
and they want
when they're making their investment decisions.
And there have been a number of companies that have said they want to go zero carbon or carbon neutral is the way that they describe it. But Greta Thunberg, in her Tuesday speech, said that's not enough. Carbon neutral just implies that you're maintaining the status quo. Again, this is the framing that she was saying. She says that she wants companies to be carbon negative, really, actually divest entirely from the fossil fuel industry, basically pull money from any sort of extracting of fossil fuels and just cut the ties entirely. A lot of business leaders in Davos saying we don't think that's very realistic.
Got to start somewhere, though.
All right, Brian, thank you.
Well, coming up here on The First Trade, Synchrony Financial is out with its earnings, and it's teaming up with a telecom giant that we know very well here at Yahoo Finance. We will tell you our trending ticker for the day.
time for one of today's trending tickers, and it's Synchrony Financial. It's moving lower in the pre-market after posting mixed results for the latest quarter. Now, earnings beat, but revenue came in shy in the wake of losing a contract to run Walmart's store-branded credit cards. The CEO called it, quote, a year of significant transformation. And we also had just yesterday Synchrony announcing a new deal with our parent company Verizon to offer a Verizon credit card later this year. Dan, there's lots to unpack here. Let's first just talk about the earnings results because it was a mixed quarter, like we said, but it wasn't exactly weak here for Synchrony Financial.
No, it wasn't. And you mentioned the Walmart deal. I mean, it is very common that when these companies, and many times it's a financial company, sometimes it's more like fintech. I'm sure Synchrony would say, oh, we're a tech company. Everyone's a tech company.
Everyone's a tech company these
But
days.
sometimes you get a little short-term boost when you announce a partnership like the one Synchrony had with Walmart. Then it ends, and now you see the stock fall again. But I imagine it's just, it isn't losing the amount that it gained from the initial announcement of the deal. You know, you gain partners, you lose partners. That's part of doing business.
Yeah, and what's also interesting
Verizon has just gained another partner.
Exactly, and this Verizon deal, I mean, Verizon is hardly the first tech company, I guess Verizon is now a tech company, to adopt this type of credit card or to do these types of offerings. So we don't have many details on what this card will have, but it'll be interesting to see what they offer.
Yeah, I'm sure there will be perks for Verizon customers. That'll be the people it's aimed at. All right, let's head to the New York Stock Exchange and let's check in with our friend Yahoo Finance's Ines Ferre to find out what's going on here before the bell. Hi, Ines.
Hi, Dan. We're watching Discover Financial under pressure this morning, down more than 7% after reporting their quarterly results, with earnings coming in just above what the street was expecting. Revenue roughly in line with expectations, but what some analysts were asking about in the current earnings call last night was its expense growth for 2020 coming in greater than expected. Evercore downgraded the stock to underperform from in line, predicting that its top line would be affected because of higher investments. Then just checking out Dow component McDonald's. McDonald's price target was increased to $235 from $225 at KeyBank. By the way, McDonald's will be reporting its earnings next Wednesday, the 29th, before the opening bell. And then looking at Generac, this is a power generator company. It's trading near all-time highs. Oppenheimer upgraded the stock to outperform because of solid top-line growth. This is a company that created quite a presence for itself in California after the fires last year, and also the company going forward is seeing that there will be grid changes because of 5G that will be beneficial for the company.
All right, Inez, thank you. Well, let's take a look at what's moving the European markets today. We have the FTSE, the CAC, and the DAX all moving to the upside. Looks like the FTSE and the DAX are the big outperformers, both up just around 1.5%. We have Yahoo Finance's Tom Belger joining us now from London. And Tom, there's some headlines that's getting our attention. Let's first talk about what Christine Lagarde, the European Central Bank president, said over in Davos. Now, she was talking about Brexit, talking about its potential impact on Britain, and she was saying that Britain faces a Brexit cliff edge. Now, a lot of people are saying that she's referring to the uncertainty when it comes to trade, the future of trade there in the UK. How is that being received in London?
It's probably too early to say how that's been received, but I think a lot of businesses in the UK certainly share that fear. It's worth saying when the moment of Brexit actually comes next week, it's expected to go relatively smoothly despite all of the political turmoil of recent years and business fears about Brexit. Now, that's because a one-year transition period has been agreed with the EU, where actually a lot of the British public, businesses won't notice much change in that initial year until December 2020. And now that's the point at which Lagarde is warning of a cliff edge. That's because trade talks haven't even begun, despite negotiations dominating British politics for years about the divorce deal. The trade talks about the longer relationship are yet to begin. And frankly, if a trade deal can't be reached by the end of that period in 2020, we could be back to a hard Brexit all over again. And businesses have a lot of reason to worry about that in terms of new trade barriers and disruption to the decades of closer and closer integration we've seen with the EU.
Tom, let's turn to Italy and talk big tech. Facebook facing yet another fine there, $5.6 million for failing to tell users how it uses their data. Now, of course, we've seen Europe in the last year or two levy quite a lot of fines against Facebook, but over here we noticed that the stock has just gone up anyway.
That may be the case, but certainly Facebook will. They've commented on this story already. They it's worth saying this started in November 2018 when Facebook was accused by the Italian Competition Authority of violating its consumer code and of practices that were unfair commercially. It was fined for failing to tell new users that handing over their data to be used commercially was effectively part of the deal when you sign up. And the Competition Authority is now saying Facebook's failing to comply with that. That would suggest maybe these penalties, as you say, aren't really biting.
Yeah, we'll see what happens. Tom Belger in London, thanks so much. See you soon. Well, if the repeated highs in the market every day aren't giving it away, investors are increasingly bullish on stocks and on the global economy. That is the finding of the new UBS Investor Sentiment Survey, which now says 60% of global investors feel optimistic. And here in the U.S., it's even higher. It's 68% are optimistic. And here to talk about it is Michael Crook. He is head of America's investment strategy at UBS Global Wealth Management. Hi, Michael.
Hi, Dan.
So let's talk about the survey because there are a number of headwinds, concerns. We talk about trade still, even though we have a phase one deal. We talk about the election in 2020 coming, and yet the markets every day have just shrugged it off. Even right now, the coronavirus, which is a concern. Now we're talking hyper recent news, but markets have seemed to just chug along anyway.
Well, you might start by questioning the direction of that causality. Markets were up in the U.S. 30% last year, so investors are now bullish. Maybe it's not surprising that they're a little more encouraged than they were 6 months ago, a year ago, after we'd gone through a difficult period. But I think what we're seeing right now is they're telling us some of the risks that we had a year ago are not as large, or they don't loom as large. Political risks, trade risks, certain policy risks that they were worried about have dissipated at least a bit.
How does this stack up against maybe some of the emerging markets? Because we talk about the fact that even though things are very strong here overseas, it's a slightly different story. There's still fears of a global economic slowdown. So how does that play into their responses?
It's similar. They're not as optimistic outside of the U.S. in a lot of regions that we look at, but they're still optimistic overall. And I think a big part of that is, take trade, for instance. Trade policy has a big impact on China, has a big impact on the rest of emerging markets and on the U.S. Investors everywhere are feeling better about trade today than they were just 6 months ago.
I wonder, too, if we can kind of zero in on the political risk, whether the election might change things or if it should just be status quo. I think here in the U.S., we've heard a lot of analysts come through and say the only thing that could slow down the markets is if Elizabeth Warren is elected because of her view on big corporations. I'm not sure I necessarily buy that. I'm making it clear I don't necessarily buy that. But, you know, and then if it's a Trump re-election, people generally expect stocks to continue to do well. Do you think there's been kind of too much made of the impact of the 2020 election on stocks?
I think investors are concerned. What we see right now is ebb and flow in terms of the concern around the election, and it really depends on who's leading in the primaries or in the current polling. It's too soon to know in terms of exactly how concerned investors should be. But what's clear is that they tell us that is their main concern, and it's not only in the U.S. Investors virtually in every region say domestic politics are what they're mainly concerned about. So this is an issue here in the U.S., but it's also an issue in Europe and around the rest of the world, too.
What's also interesting is their responses, and they think that China will overtake the U.S. as the world's biggest superpower, 57% saying that will be the case by 2030. Is there any risk, do you think, to that?
Certainly we're in a world where economic growth is more dispersed than it used to be. But on the flip side, what we've seen is, from a globalization standpoint, is really we've hit peak globalization. And so we don't expect that trend to continue even more strongly like it has over the last 20 years. But that does change the face of geopolitics and really how we have to think about allies across the world. And it certainly has an impact both on business owners in the U.S., but also a lot of the investors that we work with overseas.
And talking about geopolitics, we were just discussing Christine Lagarde's comments on Brexit. If we zero in on Brexit, what are the possible implications there if that either goes smoothly, supposedly it will, doesn't go smoothly, ends up being a hard Brexit?
Yes. So Brexit seems like one of these risks that's gone back and forth for a couple of years now, at least.
It's been
dizzying. And what we would say right now is it's not something investors, particularly in the U.S., should be overly concerned with in terms of the broader impact. Honestly, when we look at risks across the globe, we put out a publication called RiskWatch. And one thing to know about RiskWatch is once the risk is on there, it's a known risk, right? And you can manage it. Brexit's been on there for a long time. And a lot of the big concerns that were on that, part of that publication a year ago, have really declined. And so that's, I think, goes back to this investor sentiment issue. They can at least see the light at the end of the tunnel.
And also, what's interesting, I mean, just speaking of the risk, the top U.S. business concerns, cybersecurity was 52%, rising healthcare costs 52%, and taxes was 51%, which I was a little surprised about.
I think taxes goes back to policy in terms of political issues. Healthcare is an issue, mainly because of demographics. Right. Baby boomers are about midway through retirement, and they certainly have to think about how healthcare will impact their retirement plans. And cybersecurity, it's a big wild card for everyone, but there's so much uncertainty in terms of, I think, from an individual basis, how we protect ourselves from a cyber standpoint, but then also cyber warfare and some of these other issues that are effectively unknowns right now.
All right, Michael Crook of UBS, thanks so much for joining us today.
Thank you.
Well, coming up here on the first trade, China is trying to contain the coronavirus and has now shut down Shanghai Disneyland. We know 35 million people are affected by this at least. Well, News Bites are coming up next.
News Bites. Now, the Chinese government is working hard to contain the coronavirus. The government is restricting travel for 35 million people who are in 12 cities that are near the outbreak. And McDonald's has now shut down stores in 5 cities as a result of the virus. Even one of the largest tourist attractions, Shanghai Disneyland, has been shut down temporarily. Disney's website said it's merely a safety precaution and it plans to reopen eventually. Now, so far, 26 people have been killed as a result of the virus, and 830 reported cases have grown quickly. Now, China is teaming up with the EU and over a dozen other nations to settle trade disputes, and that will be part of an appeals process from the World Trade Organization. The U.S. is not part of that alliance. The pact was agreed upon at the World Economic Forum this week in Davos. Meanwhile, House Democrats are set to wrap up their opening arguments in President Trump's impeachment trial today. That's after spending much of the day yesterday arguing that the president abused his power by pushing Ukraine to investigate Joe and Hunter Biden. And they argued a key tenet of the Trump defense, that Biden himself is corrupt, was unfounded. Now, President Trump has called the entire impeachment proceeding a hoax. Now, the opening bell is coming up next here on The First Trade. Let's give you a look at the action in overseas markets first. You can see what's happening with the DAX, the CAC, and the FTSE, and we'll be right back.
Welcome back to the first trade. We are a few minutes away from the opening bell, and taking a look at futures, we are still seeing some movement to the upside. It looks like the Dow, the S&P, and the Nasdaq will all open the day in positive territory. Well, let's go around the bell. We have Jay Jacobs, Global X Head of Research and Strategy, and we are also joined by Catherine Rooney-Vera, Chief Market Strategist at Baltic Capital Markets. And Jay, let me start with you. We've seen this momentum to the upside. Now, the Dow, I should say, has been, and we also have Jared Blickery. Let me bring him in. Jared, I didn't forget about you. Sorry, I was just so excited to get Jay's take on what's going on. But Jay, let's talk about what we have going on in the markets. We have seen the Dow under pressure for the last couple of days, but last week was another record-setting week. It looks like we're going to end this trading week to the upside. Do you still think there's enough momentum moving in the positive direction?
I think we're still seeing pretty good short-term momentum. This week, of course, was a little bit choppy. We saw VIX increase a little bit, but we had Davos, we had, the outbreak of the coronavirus. We've had earnings that haven't been great, and so a choppy week is actually a pretty good scenario given a lot of negative news. So I think that shows that the momentum in the market is still pretty strong, and if we see a little more positivity, I think we could continue to see it rise.
Yeah, let's ask Catherine, too. I've been interested in following the coronavirus impact, Catherine, because, if you look back at 2002, 2003, SARS at that time did have a big impact on stocks. Now, obviously, we're not at that level. We hope it won't get there. But do you think that actually maybe people are underestimating the impact here of this virus in China?
If it becomes a pandemic and it is as contagious as some fear, then certainly it would have an impact on economic growth in China and then even on a broader scale. But at this point, it's impossible really to say what we're looking at. What I can say is that a lot of these times, with the exception of the one that you mentioned, SARS, a lot of these times, these fears, specifically about the health concerns or natural disasters, they tend to be contained. And that's why you can look at 2 days ago when this news broke, you saw a peak or a jump in call purchases for Chinese equities, because I do think that a lot of people are perhaps looking past this. And as your other guest mentioned, really, even despite some of the negative news that we've been getting, the markets really haven't reacted in too negative a light. So look, I think it's too early to tell.
Jared, I want to get your perspective because I know you have the global markets there up on the board. When we take a look and talk about the potential macro implications of the coronavirus, how do you see that playing out in the markets across the world?
Well, you brought up the 2002 to 2003 period because of SARS. I would also mention that was post 9/11. We were going to war with Afghanistan, thinking about Iraq at the time, still coming off of the dot-com bust. So there was a lot going on there. I don't know how much you could really attribute to SARS itself. These events, though, they tend to be short-lived in nature. Looking at the global heat map here, lots of green. Shanghai is closed for a week, of course, but we can see the CAC 40 and the DAX up over 1% along with the FTSE, and we're poised to open up record highs in the NASDAQ in the U.S. I'd also point to some seasonality here, and I'll go to some of the work from LPL Financial, and just looking at January overall. So this is the month of January. We tend to have positive seasonality in the final week. That's what we're entering, so that could be good news for the stock market. But after that, things tend to flatten out. So here we have S&P 500 index performance when President was up for re-election, 1950 to current, and we can see February through June is pretty choppy. Now, seasonality can account for about 20 to 30% of a stock movement. It looks like we got the opening bell here in just a minute.
We do. The opening bell is underway on Wall Street. We can see the New York Stock Exchange and the NASDAQ both on our screens. When we take a look at how the day is opening up, we have the Dow moving to the upside, up just around 72 points, so up around 0.25%. We're also seeing some gains in the S&P and the NASDAQ. Let's bring you some of today's headlines that were on the first trade front page. Now, first up, we have earnings season continues. Talked about that earlier. We have American Express and Intel both topping Wall Street's expectations. We're also taking a look at Treasury Secretary Steven Mnuchin. He is downplaying climate change. He told a closing panel at the World Economic Forum in Davos that climate change should instead be called a, quote, environmental issue. And Facebook is under pressure by Italy's government. Now, the social media giant may face a fine of up to $5.5 million for not telling users how their data is used. And Jay, we talk about the fact that some of these big tech giants could possibly face more regulation going forward. Yet, as Dan brought up before, it hasn't affected any of the stocks, really. A lot of these tech giants continue to trend in the positive direction. Are you seeing any investment opportunity in some of these names at this point?
Well, some of these names are the fastest growing companies in the world from a revenue perspective. So, some people think, the trend of social media has been around for a decade, 2 decades. Facebook is still growing revenues at over 20% a year. So this is a phenomenal growth engine. This theme is not over yet. People are continuing to spend more advertising dollars on social media. People are continuing to engage more and more. We do think as 5G starts to roll out and we see new technologies that people are going to kind of change the way they interact with social media a little bit, maybe more mixed reality, augmented and virtual reality, more e-commerce through social media. But the trend is still very powerful and nowhere near ending.
It is remarkable to think that big tech could just be the obvious best trade for 2020 like it was in 2019. I mean, at the same time, we talk a lot about how maybe the FANG names are decoupling a little bit. Maybe that's not the most useful acronym anymore. I mean, Netflix has been under pressure. Catherine, I want to get your take on big tech and those FANG names and how you expect those to play in 2020, especially because I do think it's still a remarkable story how lawmakers still come out and they're angry about big tech and they make threats and they levy fines, but it really hasn't mattered for most of these stocks.
You're right, it hasn't mattered at all, and I'd be curious to hear about what Jay thinks about the risk for technology names in the event that you do get, some political change. Say you get a Sanders or a Warren becoming the nominee. Say you get a Sanders or a Warren becoming the president. Will that have an impact on the tech momentum? I ask myself because, of course, tech is a huge component of the S&P 500. What about 25-30% of the S&P 500? So, and that has been the majority of the impulse or the momentum for the broader appreciation of the index. So when you get, big names that could affect policy change, talking about breaking up of monopolies or coming under fire tech and financials and even energy. These are things that do concern me, and I think that the market has completely discarded this risk.
Yeah, what do you make of that, Jay? Political risk for the big tech names, depending on the election.
It depends how any sort of regulation materializes. So the value of these companies is that they have super valuable data that allows for hyper-targeted advertising to their users because they know exactly what their users want, and that's very valuable to advertisers. So if regulation somehow devalues that data because they have to throw it out, or they can't consider some of that data, or they have to anonymize it, that's going to devalue their advertising. It just is because marketers are not going to pay as much for that advertisement if it's not as targeted. I just don't see that as being super likely. I think it's a complicated issue, and there's been very little consensus about how to regulate this space.
And so far, it's been talk about regulating the way they use data more than actual regulating of the way they.
Yeah, and there's lots of questions about how they would even go about with the regulations. Jared, I noticed that you have a bunch of the big tech giants up on the screen there, and taking a look broadly speaking, there's not a heck of a lot of red on that screen.
No, Tesla's down 1%. Can't remember the last time that happened. But no, seriously, Apple's up 0.5%, probably record high right there. NASDAQ 100 and Composite, they're both at record highs as well. And just thinking about what has been working so far this year, the first 8 or 9 months of last year, we had interest rates trending down, at least on the long end. And we had this odd situation where we had these growth and momentum names doing a lot of the horse work, along with utilities and real estate. And that's because those are interest rate plays. So far this year, interest rates on the long end have come down about 18, 19 basis points, and we're seeing a resurgence of that trade. So we're not seeing values and cyclicals outperform like we were in the fourth quarter of last year when the interest rates were trending up. We're seeing the opposite. We're seeing kind of a mirror of what was happening last year. We'll have to see if that continues, but so far, the tech names are doing most of the heavy lifting, and of course, chip stocks. These guys are just incredible. Intel's up 6.5%, really outperforming no matter what the interest rate environment is.
And Jared, you mentioned Tesla. I mean, we've been talking a lot this week about the metric of how long Tesla can stay above that $100 billion market cap since Elon Musk has a big bonus there. Down 1% today. But man, that has been just such a remarkable story, Tesla's previous 6 months.
Yeah, definitely. Over the last year, up 95%. And by the way, that's a $35 billion package. Now, Tesla has to get to a $650 billion valuation. That implies a stock price of something like $3,500. But not a bad gig if you can get it. But you got to keep it there for 6 months. We'll see if that happens.
Catherine, I want to get your take, just speaking more broader picture here. Obviously, a big driver in the markets right now is earnings. We've gotten a couple of companies have reported, but we still have a ways to go. When you're taking a look at what you expect for earnings, not only this quarter, but also looking out for the rest of 2020, are you expecting to see a return to growth?
Yeah, look, I think earnings have been remarkably stable. I don't think that we're going to see something to the extent that we saw in expansion of 2019. But even stability, I think, would be a very positive sign for the markets. What I'm looking at is if there's going to be a growth in the P multiple or not. I mean, really, what we need to see is we need to see the denominator catch up to what we've seen in price movement. So really what I'm looking at now and telling my clients is look beyond the United States. Look at emerging markets. Emerging markets have not kept pace with the rise in developed market equity markets. So really look at EM, look at MSCI Emerging Markets Index. Chinese equities, I think, look attractive right now. As one of your other presenters said, these things tend to be short-lived. So I do like Chinese equities. And there is a return of capital going into the emerging markets that I think will continue.
Jay, your crystal ball for 2020, especially because this week with Davos, we've heard about, black swan events. Was impeachment going to be a black swan event? But also the talk has turned now to climate change, and people are jokingly calling that a green swan event. What do you see that might happen in 2020 that could have a big impact up or down?
This is a sentiment-driven market. Earnings are negative. They're not great. So what's driving these markets forward is people are bullish on certain concepts like support from central banks around the world. They're supportive of, what we're seeing in the political arena. So I think this is going to turn into a very politically driven market going forward because of the elections. And the two areas that we have our eye on are infrastructure and healthcare. Infrastructure is a rare area of consensus across both sides of the aisle. So frankly, I think we're going to see a lot of infrastructure plans being put forward, a lot of one-upsmanship on how big those plans are in the trillions of dollars, but it's going to be a hot topic as we get closer and closer to the elections. Healthcare, less consensus. That's going to be much more politically charged, none opposite. That's going to probably introduce a lot of volatility into the healthcare sector as people use that as a proxy for trying to invest in how they think the election is going to go.
All right, some good themes for 2020. Jay Jacobs, thank you. Catherine Rooney-Vera, thanks for joining us. And our own Jared Blickery at the screen. Thanks, guys. Well, we're just a few minutes into the trading day. Let's find out exactly what is moving markets on this Friday morning. Yahoo Finance's Ines Ferre is live at the New York Stock Exchange. Hi, Ines.
Hi, Dan. Tech is leading the gains and chip stocks are on fire. And look at Intel. Intel is a top Dow component, hitting a 52-week high after beating on the top and the bottom line. Full year revenue hitting an all-time high. Guidance for the current quarter and full year coming in ahead of expectations. Its results were driven by its client computing group, that's processors for PCs, laptops, and also its data center business. That's the processors for servers. Those carry some high margins, and that helped with earnings. And just taking a look at its main rival, AMD, hitting a new high. Now, analysts have been saying that AMD has been gaining momentum because of the the Intel supply chain issue that it had last year. So we will see when AMD reports its earnings next Tuesday. And then just looking at a Dow component, McDonald's announcing that it will be closing its stores in 5 Chinese cities because of the coronavirus. The stock is not reacting too much this morning. Dan?
All right, Inez, I'll take it from here. Thanks so much. Well, another stock that we are keeping an eye on this morning is Tesla. Right now, taking a look at shares over the last 6 months, the stock has been on quite a run after climbing more than 110%. You can see the stock today is under a little bit of pressure, but still trading at $568 a share. Well, earnings, they're due out next week, and many are expecting things will only get better for Elon Musk and company. We have Dan Ives of Wedbush here. And Dan, I know you have a very, very bullish call out on Tesla. You think it could hit $900 a share?
I think that's really the bull case. I mean, you sort
the very
of,
bull case.
Yeah, because you got to take a sort of line in the sand. Base case right here, what's called 550. But really the bull case, it's all predicated on China. Mm-hmm. Because fundamentally, if you look what's happened in terms of Giga 3 and Chinese demand, just put numbers around it. What's called today 360, 370,000 in terms of units. China could be an incremental 150 to 200K. That's why the bull thesis, China's worth another $300 per share. That's how you get to that sort of uber bull thesis on Tesla.
Well, is there any problem for Tesla with so much of the story right now being about China, considering everything that's happening, not just U.S.-China and trade? I know we have the Phase 1 deal right now, but also China's supposedly slowing economic growth. I mean, right now, Elon Musk has a lot of his eggs in the China market basket.
No doubt, and that's also why with Giga 3, remember, that's the big advantage here, the only U.S. car manufacturer with a footprint in China. It comes down to EV demand. I mean, today, 4.6 7.9% in terms of China's EV as a percent of overall automotive. We think that goes to 10% in the next 3 years. So no doubt China continues to be sort of, I think, an emotional bull bear story in terms around Tesla. But nonetheless, in terms of next week, I mean, obviously I think it's bullish, but specifically around China. That's really what I really want to emphasize is what I view as the difference between a $550 stock or $700, or bear case, how you get to a $300.
It's remarkable how many companies supposedly were going to have troubles in China in the last year because of trade and just didn't. I mean, they're big American companies, Starbucks, Anheuser-Busch, a Belgian company, but Budweiser is a big brand there. Under Armour is doing very well in China. Trade hasn't seemed to really ding these American brands in China like people expected.
And we talked about it here, even if you go back a year ago, you look at Apple, right? I mean, that's sort of been our, that's been the core part of both thesis and Apple, is that the view is that the trade was going to be a negative headwind in China. But ultimately, what Chinese consumers are doing, they're not protesting Apple, they're actually just buying iPhones. And that's why if you look at it, you see it in terms of numbers. But I do agree, that's why I think from an investor perspective, there's a lot of noise. Got to peel away the onion to see where the fundamentals are.
Well, let's talk a little bit more about Apple, because I know you just came out with, you're more bullish than you were before. You have a $400 price target on the stock right now. So you still think this stock has room to run. When we take into account the fact that Apple already had such a great 2019, do you think that is at all, I guess you don't probably, a risk to the company this year?
After issuing a warning in January 2019. I mean, how much changed in a year for Apple?
Yeah, and that, but I think our thesis on Apple, it's really been a multi-year, sort of bull thesis, even going back to a year ago, it comes down to the install base. And that's the one thing I want to emphasize, that 350 million of 925 million iPhones are in the window of an upgrade opportunity. Going into a 5G super cycle, that's a perfect storm of demand.
Do you think they need to lower the prices of the iPhones, though, or no?
Ultimately, I mean, if you look at numbers today, both in the U.S. as well as internationally, I mean, demand's been strong. I think that's what you'll see next week from Cupertino, probably about $1 billion beat. AirPods obviously continue to be strong as well, but it's a re-rating because it all comes down, the linchpin of it is the services business. You go back 2-3 years ago, that services business not really getting a rating. You're valuing the overall iPhone franchise. Today, we think services is worth $600 billion in terms of that piece. That's a key part of the re-rating here on Apple.
It's interesting, though, that you mentioned services because, correct me if I'm wrong, I feel like when Apple did come out and say, hey, we're not going to sell as many iPhones in China, warning, in January, it was like January 2, 2019, they said, look over here at services, and you started to see everyone talk more about services and say that's why it's okay. The install base, the services are going to be huge. And now, even though that business is still huge, clearly, people are excited again about iPhones. It's like, actually, iPhone is pretty good business. We don't need to try to hype up the services.
It's a renaissance of growth in terms of what's happened with the iPhone. Think about the last few years, okay, flat growth, even declining. Now, I think ultimately 2021, that could even be a peak year, even surpassing iPhone 6 in 2015. Wow. You put numbers around it, that's why, look, the haters are going to hate on Apple.
I know.
And no doubt.
Well, their ecosystem is so strong, it's hard to hate.
But it all comes down to the install base is the golden jewel, and as long as they monetize that, given what we're seeing in terms of the super cycle, the stock has a 4 in front of it in a year.
Wow.
Yeah, I mean, what would you say, just real quick, because we're running out of time, but what would you say is the number one risk to that bull thesis on Apple at this point? Is it China?
It's China. Yeah. Because China, ultimately, for Apple, you have 60 to 70 million iPhones in the window of an upgrade opportunity. If there's disappointment there, then the stock obviously gets hit. But that's why our view is that right now, if you look at the opportunity set and you look at where we are in 5G and look at the install base, I think right now it's sort of a Goldilocks scenario in terms of the setup, despite volatility you could see in the stock.
Wow. Same with Tesla. Both of them have China risk.
Hard to bet against it.
Dan Ives, thanks so much.
Thanks for having me.
Great chat, as always. All right, let's stick with tech. Over at Davos, our Yahoo Finance editor-in-chief, Andy Serwer, spoke to U.S. Secretary of Transportation Elaine Chao, and they discussed where the U.S. stands right now with the exploding drone industry. Watch.
Well, I just came out of a panel at the World Economic Forum about how do we handle drones. There are now 1.5 million drones in our country. We have over 150,000 professional drone operators. I was the Secretary of Labor. When I was at Labor, when I was the Secretary of Labor, this job category did not even exist. So now drones are getting bigger, heavier, they have more capacity to carry either freight or potentially human beings. So we're talking about air taxis, and we're talking about all sorts of humans in flight in drones. So our responsibility at the U.S. Department of Transportation is to ensure that the FAA, the agency that's in charge of the drones, again, are viewing safety as a #1 priority. We're ensuring security of these drones because obviously they need to be safe from a security point, cybersecurity point of view. Thirdly, they need to respect privacy. We get a lot of complaints about people who don't want to see drones outside their second floor window, let's say, or third floor window. And then lastly, as drones proliferate, the issue of noise enters into it as well. So the FAA has a responsibility to address noise issues with drones. And how do we license drones? Do we treat them like airplanes? And how do we track them? So for example, we heard recently that there were these coveys of drones flying at night over in Nebraska, in Colorado. We don't know who they belong to. We don't know who's operating them. To this day, we do not.
Really?
And
Are
so
you investigating still?
the local law enforcement initiates the action. We're very lucky; nothing happened. So the local law enforcement have stepped down. So we're not actively investigating that because the local law enforcement stood down.
Right.
But this talks to a very pertinent notice of proposed rulemaking, which we just announced. And we're sending it out for public comment, and the public comment will end on March 2nd, so please comment. I urge people to do so. But this new notice of proposed rulemaking would require remote identification of drones. So any drone that is over 0.55 of a pound, half a pound, and that is registered with the FAA needs to be able to have remote identification capacity. And again, there could not have been a more timely example as to why we are thinking about this than the covey of, again, drones over the skies of Nebraska and Colorado.
Speaking about just the sheer size of the drone market, the global drone market is expected to grow to over $43 billion within the next 4 years. Woo! All right, well, coming up here on The First Trade, Amazon may be in the crosshairs of the White House as the administration looks to crack down on counterfeit items. Companies to watch next. Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. Broadcom cutting a major deal to put its components into new Apple products. Now the agreement will last into 2023, and Broadcom says that it could generate up to $15 billion in revenue. That's on top of existing agreements to provide wireless parts for Apple's phones, laptops, and other products. Now, it is unclear, though, that this is part of Apple's expected plans to launch a 5G phone as soon as this year. The U.S. is cracking down on the online sales of counterfeit goods and warning e-commerce giants like Amazon that there will be penalties for companies that don't help weed out fakes. Now, the Department of Homeland Security is set to release a report that will outline specific rules and goals for combating counterfeit products. We're also taking a look at Uber and Nissan. Now, they are linking up in the UK. The ride-hailing giant will offer drivers in the UK a discount on Nissan's electric cars. This offer is open to all UK drivers, but is mostly targeted at workers in London as Uber faces a potential ban in the city. This is also part of Uber's larger push to ensure that all of its vehicles are electric in London by 2025. And this, of course, is to combat air pollution in the city. We're also taking a look at startup backed by SoftBank. Now, it's reportedly running into trouble. Reuters says that CloudMinds, which develops AI and cloud robotic systems, is slashing jobs as it burns through cash and reportedly will be shutting down an office in Silicon Valley. Now, we have to remember SoftBank famously backed WeWork and took a $4.6 billion hit when that company's IPO plans imploded. And Bayer will be close to a settlement, or they could be close to a settlement. The company may be ready to dish out $10 billion towards claims that its Roundup weed killer caused cancer. This is all according to a report by Bloomberg. Now, it's estimated that there are at least 85,000 cancer claims in the U.S. The case was wiped out about $18 billion of Bayer's market value. You can see the stock today trading up just around 2%. Well, coming up here on The First Trade, Nike's Vaporfly shoe is breaking all sorts of records. It's happening so much that it's actually causing an investigation. We'll have more on that next. Let's take a look at one of today's trending tickers, Nike. Its Vaporfly shoe is being looked into by an athletics committee after runners have used the shoe to help shatter new records. A report by World Athletics will be out by the end of this month. And Dan, I know you're following this story, or Nike at least, very closely. When you take a look at this, I was reading exactly how this gives runners advantage. I'm not clear on it. How exactly does it work?
So there's a plate in the sole that helps when you run, and it basically gives you lift, pop. and you just pop like you're running on clouds. There's also the shape of the heel, which is really looks like a blade. Now, I think all this is a little bit overblown because if the shoe is so incredible that it's shaving milliseconds off times and other runners think it's unfair, well, you can wear the shoe.
Yeah.
I mean, if runner A is faster than runner B, runner A is still a faster runner than runner B. But this is a controversy, and now the question is, if Nike has to change the design of the shoe, so be it. Nike will do it. I don't think this is like a huge business concern to Nike, nor should it affect the stock. But it's an interesting controversy.
And what's interesting is this Vaporfly shoe has been very popular. Now it costs $250, so it's clearly not cheap. And it is really picking up. I mean, it's one of the big reasons why their shoe, market in North America kind of rebounded.
But if you're a professional runner, you can get expensive shoes. So if you think they're unfair, then you can wear them.
All right, well, that is it for the first trade this morning. We could talk about Nike all day. I'm Shauna Smith.
And I'm Dan Roberts. Before we go, let's give you a check of the markets with our friend Inez Ferre, live on the floor of the New York Stock Exchange. Inez.
Dan, Shauna, we're looking at the Dow that's up about 100 points, and we're looking at some of the Dow components, some companies which are taking action because of the coronavirus. McDonald's saying that it will suspend its business in 5 Chinese cities because of the coronavirus. Also, McDonald's, by the way, its price target was increased to $2.35 at KeyBank, and McDonald's will be reporting earnings next Wednesday, the 29th. Also, we're also looking at Dow component Disney, with Disney announcing that it is temporarily closing its Shanghai Disney Resort until further notice. Remember, this is the Lunar New Year celebration time for the Chinese, and this will be a time when that park would be packed. And then also looking at Yum China. Yum China this week had come down into correction territory, down about 10% for the week since it opened on Tuesday. More than 8,000 stores in China right now is down just minimally. Stay with us. On the Move is next.
All right, a little bit after 10 a.m. in New York City, we are 30 minutes into the trading day and stocks are trading higher. But China on lockdown as the death toll climbs, the country isolates nearly 40 million people as it races to contain the spread of the deadly coronavirus. Intel on the rise, shares jump as PC sales help drive a strong fourth quarter for the company. We're going to break down the numbers for you. And teaming up, what Broadcom's massive deal with Apple could mean for other companies in the sector. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thank you for joining us. Our top story today, the growing death toll of that deadly virus emanating from China. The death toll has now climbed to 26 with nearly 850 confirmed cases. Authorities in China are racing to lock down more cities in a bid to halt the spread of that virus. And it's having a big impact on businesses as well, with Disney announcing it's closing its mega theme park in the nation and McDonald's also announcing some closures. And now several drug makers are racing to develop vaccines that could protect against the virus. Let's bring in our panel for the next 90 minutes. Yahoo Finance's Dan Howley and Jared Blickry to talk about this. So we have been seeing in recent days a depressive effect on the markets from concerns about this, but we are also watching some of these drug makers. And it's going to take a while, right? It's going to take at least 3 months probably before they develop something, could get something approved. But nonetheless, people are watching these stocks.
Definitely. And not only those, glove makers. There's a whole slew of companies that have shot up over 100%. The drug makers are actually on the lower end of this. The net effect of this is it's going to be a drag on Chinese GDP for sure. They're going to take a hit in the first quarter. That's unavoidable. They're going to figure this out. We're going to figure this out. And any hit that we take in the short term probably going to be mitigated in the next few months.
When you say mitigated, though, I mean, we're still trying to figure out what it is we're dealing with. And from at least early indications is, as some people have said, it's the flu. Maybe not even as severe as the kinds of outbreaks we've seen previous years.
Yeah, it seems like this is something that most people with a healthy immune system wouldn't have to panic about, right? I think it's the idea that we had SARS, and so now it's this other virus that might be scaring people, and I think that's driving a lot of fear. But the World Health Organization has said it's not time to press the panic button and start freaking out, and I think that's the important part.
But you get, for instance, can we pull up the quote from the CDC? When just one case in the United States was essentially confirmed, they put out this quote that says more cases are likely to be identified in the coming days, including more cases in the United States. So that's the kind of thing that ramps people up.
Yeah, and we also have the regular flu that kills a ton of people every year, and I think that's something that there's not a lot of context with. I feel the discussion about this. I think you hear about a virus that came from a food market, and then we saw the viral photo where they were selling all sorts of different animals, koalas and bats, and beavers, snakes. So it's like you hear that. You mix it with, now we're a globally connected world, so everybody can come anywhere from the airports. We're talking about locking down countries, and that's where the fear comes from.
Yeah, I mean, that's the thing. The Chinese response has been swift, and it's been dramatic. I mean, if you talk about
Wuhan... They knew
Wuhan,
about this since November.
Right.
That's not real swift.
But they're swift in response to the latest sort of ratcheting up and spread of the disease. If you look at Wuhan, where this seems to have originated, it's a city of 11 million people, which is... or 40 million people.
Well, Wuhan's 11 million, but the other cities affected 40 million
altogether. Right, excuse me. So you're talking about a large number of lockdowns. And meanwhile, experts say the best thing you can do is what you do for any sickness prevention, which is to wash your hands.
Yeah, and not congregate within large numbers of people, and that's exactly what the Chinese New Year is about.
Right.
And so, the official celebrations not going to happen, but you got to imagine there's some private gatherings going on. That would be my biggest concern over the next week.
This is, by the way, if you remember from your high school English, if you had to, Camus, the plague. This was written about in 1946. What happens
because of you.
Yeah, this is what happens to a city that's on lockdown because of an outbreak of something. But let's move from that and head to the floor of the New York Stock Exchange, where Yahoo Finance's Inez Ferre is standing by, and you're looking at shares of Intel.
Adam, Intel is the leader on the Dow, the S&P, the NASDAQ, hitting a 52-week high after beating on the top and the bottom line. Tech stocks are definitely leading these gains this morning. And I also want to show you, take a look at Generac. This is the power generator company. That stock is at an all-time high right now. Oppenheimer upgraded the stock to outperform because of a solid top-line growth. This is the company that created a bigger presence for itself in California last year after the fires, after those power outages there. And the company also says that moving forward, it will be seeing some grid changes with respect to 5G, which will also be benefiting the company. Adam, Julie.
Thanks, Inez. Well, let's talk more on Intel, which reported results for its fourth quarter. The tech giant topped Wall Street estimates. It predicted robust 2020 sales amid an emerging rebound in global chip markets. Dan, data centers were strong. The cloud has been a strong source of demand, which you might imagine. But so are PCs, which is really kind of a fascinating sub-thread of the Intel story.
Yeah, obviously the data centers are the big, chunk of what we talk about usually. But yeah, the PC sales actually increased, and according to IDC, sales increased for the first time in the past year, for the first time since 2011. And they actually saw a 2.7% year-over-year increase. In 2011, they only saw 1.7%. And the interesting thing is the PC market has been either declining or flat, and it could be that people are just looking at these old computers they have and saying,
it's the replacements.
It's time to get them.
Well, there's an upgrade cycle with Microsoft Windows too. That I think something is expiring in January. But you take a look at, and also there was a shortage of these PC chips in one of the previous quarters. You take the fact that memory has troughed and it's accelerating. That's not an Intel play. The server space is just on fire right now.
But isn't this also have to do with cloud computing in the data centers? And, it might be good in the short term, but when we get to the second half of the year, it might have moved some of what would have been purchased then now. I mean, that's what the critics are saying.
Well, and we experienced a similar thing with cryptocurrencies. NVIDIA took a big hit because everybody ramped up production to take advantage of, to build these server farms for cryptocurrencies. That didn't work out so well. I think, it's going to get overdeveloped because that always happens. It's a cycle. But, worry about that in a few quarters.
All right, let's keep talking about chips. Moving to Broadcom, they announced they've entered into multi-year deals to supply Apple with wireless components used in Apple products. The deals could generate up to $15 billion for Broadcom. I've got to ask you, Mr. Howley. Apple eventually is going to be making their own chips, but they can't do it just yet.
Yeah.
So how much longer does Broadcom or the other suppliers have with Apple?
Not much longer. I mean, according to the filing with the SEC, it'll be 3.5 years about that this deal will go through. And, $15 billion, nothing to sneeze at, obviously, but that's, including other parts of the deals that they have in place. They already have a previous one with Apple. And then, you have the Qualcomm deal as well going on. So obviously, and by the way, they sucked up Intel's wireless chip. So there's different aspects to wireless technology in phones, though. There's the cellular, there's the Wi-Fi, there's the Bluetooth, there's the NFC. It's all these different chips inside that need to come from somewhere, and Apple isn't capable of doing all of that just yet. I think the big deal for them is going to be when they start making their own 5G chips, and that's why they purchased Intel. This, I think, is just to get them over that hump to get Intel's technology in and kind of make it work the way Intel couldn't.
Although it's interesting, too, because there are reports that Broadcom is looking to sell its radio frequency business, which makes some of these chips that go into some cell phones, Apple's and others. And then there's a report from Bloomberg today that Qorvo and Skyworks are potentially interested in buying it. So there's still some movement of all of this stuff in the chip business.
There's going to be. And I think one of the things that accelerated a lot of this, M&A and divestitures and all of this, is the trade war. Because that's what really jostled the supply lines, got people thinking, Apple thinking about the longer term, we got to get this stuff in-house.
All right, well, speaking of Apple, the tech giant reports its latest earnings results next week, and now the stock has come a long way since this time last year. That's when Apple issued a rare revenue warning following an unusually weak holiday quarter. Wall Street's expecting revenue of about $88 billion for Apple this time around. Also on deck for earnings results next week is Amazon. So let's talk more about these expectations and bring in Angelo Zeno. He's senior industry analyst at CFRA Research. Angelo, good to see you. So when we look ahead to Apple, especially given some of what we've talked about in terms of input costs for the chips for Apple, what are you looking at from their numbers next week? And is there going to be continued focus just on iPhone sales numbers, or have we seen that sort of pivot to services, and are we going to see more focus on that too?
Well, our view here is, as far as Apple's results are concerned, it's all going to be, it's all going to be about the iPhone as well as, how they're doing on the services and wearables side of things. But I think it's an interesting point about what's going on with Apple on an internal perspective. I mean, clearly they did buy, Intel's modem business just a couple of quarters ago. We actually do think they're actually looking at Broadcom's business as well. I mean, you kind of highlighted the fact that they kind of extended that agreement for their 5G devices here over the next couple of years. When you kind of look at who potentially could buy that business, I mean, Qorvo and Skyworks certainly are in that discussion. We think probably too big for either of them to really want to leverage that. So Apple could be interestingly looking to actually acquire that type of business here over the next couple of years. And it would make a lot more sense to kind of bring a lot of those chips in-house.
I want to switch it and include a discussion about Amazon, because we know what you'll be looking for with Apple, but with Amazon, where should we as investors pay attention? Is it, obviously it's going to be cloud, but we know the percentage of revenue generated by cloud, but we still don't know a lot of the metrics that people need if they want to buy it. What is an expensive stock?
Yeah, I mean, I think when we kind of look at Amazon here, we do have a buy recommendation on the shares. We do like them. I do think that when we kind of look at the long-term potential of Amazon, it clearly does come with Amazon Web Services, AWS. I mean, the growth potential is clearly there. We do think we're still, fairly early in the whole kind of evolution towards the cloud. So we think Amazon will be perfectly fine here. We actually think kind of that digestion we've seen in the stock price here in recent quarters actually bodes well for the setup going into 2020 into 2021.
Hey, Angelo, Dan Howley here. We talk about how Amazon lost out on Project Jedi to Microsoft. That would be a huge, $10 billion over 10 years for Amazon's pocket. Do you think that they're going to be discussing this? They obviously have now put in a legal, suit or something along those lines to kind of fight back against what Microsoft has and say that there was interference in the bidding process. Do you think that they'll discuss that when their earnings come out and maybe even think about contributing that to their future earnings?
Yeah, I think that's interesting. I think they'll clearly highlight it. I don't think there's going to be much discussion about it. I think Amazon makes a valid case. I think they're kind of being penalized to some extent here, being who they are. But that being said, I mean, listen, I think Amazon's got a case here.
I guess we lost Angelo there, unfortunately, but he was talking about Amazon and the prospects for growth there. Angelo, sorry, I think we've got you back. Do you want to finish your thought?
Yeah, I mean, I think at the end of the day here, I think it's just overall, I think they'll highlight it. I think it'll be discussed in terms of the quarter. We just don't expect to get much out of them as far as the contract is concerned.
Yeah, I just wanted to, sticking with Amazon, wanted to ask you about margins. There's still the 400-pound gorilla in the room when it comes to product sales, e-commerce, but they're facing more competition, direct-to-consumer, as we see with Nike and others. But they're also facing more competition in AWS and cloud services. How much investment do they have to make this year to regain their competitive edge, and what is that going to do to their margins?
Yeah, I mean, I think Intel's results almost tell you kind of where the direction is coming from as far as some of these cloud providers are concerned. And I think you're going to see some significant investments, whether it be from Amazon or as well as the likes of others. But that being said, I mean, we're kind of evolving in a world of AI. I think you're going to, again, see some significant investments and a nice capital boost in terms of the Amazon side of things.
All right, Angelo Zeno, Senior Industry Analyst at CFRA Research. Thank you so much.
Coming up, we're going to bring you more coverage from the World Economic Forum in Davos, Switzerland, including an interview with Secretary of Transportation Elaine Chao right after this. Plus, before we go to break, take a look at some of the winners on the Dow.
Welcome back to On the Move. I'm Jared Blickery. We have stocks in the green. S&P 500 just by a margin, small margin. Dow is up about 80 points or 1/4%. S&P 500 3 basis points. NASDAQ up about 1/3%. Russell 2000 once again in the red. Here's the intraday price action in the S&P. We can see we gapped up to about 33.33, gave back those gains and are just right around the unchanged line right now. Want to get into some seasonality. This is something we touched on yesterday. LPL out with another post. This shows January seasonality. This is the entire month of January. And we can see accelerating into the month end, we do have positive seasonality. And I'll also go over what we looked at yesterday. And this has to do with the seasonality in a presidential election year when we have an incumbent. So this is the entire year. And we can see once we get into February coming up here, kind of go sideways into the beginning of July. And that's when we kind of launch higher towards the end of the year. Just something to keep in mind. Here's a 10-year T-note yield. You can see it's down another 2 basis points. And guess what? That brings the total for this year, this month to date as well, to about 20 basis points down. That's a big deal. The yield curve is contracting too. And then we're also going to take a look at the US dollar index because that is up to a 7-week high, up 14 basis points, but it is on the march, and this affects the earnings of multinational corporations, and it's also a weight on emerging markets. So here's the NASDAQ 100 heat map. You can see lots of green around the screen. Apple up to another record high, up about 78 basis points. Microsoft and Apple and Facebook and Amazon, they're all in the green. You can see Intel outperforming, up almost 8%. This is a stock, and over the last year, we can see it just broke to new highs. That is the highest point since the tech bubble. So that's a 19-year high that we're looking at right there. Lots of record highs looking at ASML, NVIDIA on the march as well, Netflix. To the downside, really not seeing too much. We have Intuit Surgical, that's down 4%. And it's been kind of from the lower left to upper right since September. Stick around, we're going to be back in 1 minute.
Stocks are on the rise this morning as we close out a rocky week of trading, although I should point out the S&P 500 has fallen into negative territory as we have been in the stream for the last 20 minutes. The Dow, NASDAQ, S&P 500, as you see right there. Joined now by Daniel Morris, BNP Paribas Asset Management Senior Investment Strategist, who's joining us from London. And there's a great deal to talk about all of this, but mostly, I guess I would say it's your optimism going forward, that you still see opportunities in equities, and I'm hoping you'll explain it to all of us.
Well, I guess tempered optimism might be the better phrase. I think we've got to keep in mind the U.S. economy is still quite solid. Globally, growth is okay. We know it's not spectacular, but we're not going into a recession this year, at least not as far as we're concerned. So in that environment, it still should be a positive returns for risk assets. The concern is obviously that you have much higher multiples now than you had at the beginning of last year, and so it's going to be more challenging to get very positive returns. But we still think you're going to see higher corporate profits at the end of the year and hopefully a reasonably good multiple on those profits.
And you also think then, therefore, that those multiples that we're seeing now are not too high, as particularly I know that you're looking at sort of sector by sector PEs to distinguish and to sort of peel back where the growth is coming from.
Exactly, because what's been very notable over the last couple of years is the rising dominance of technology. Of course, this is not a new phenomenon, but over the last 2 years, since we had the S&P 500 at roughly the same forward PE, about 18.5 times. Over those last 2 years, you've had the PE on the technology sector, broadly defined, go up about 16%. Whereas you've had the multiple on the rest of the market actually going down. So on average, you look like you're at the same PE today as you were at 2 years ago, right before you had the sell-off in the market. But at a sector level, it's much higher multiples on tech, lower multiples on the other sectors, and then you have to think about, well, whether those multiples, particularly for the tech sector, are justified or not.
This is Jared Blicker. I wanted to ask you about the interest rate environment. We got the Fed on hold, so I'm really focusing more on the long end. Well, yield curve is contracting. The 10-year is at 1.70. That's the lowest in about 7 weeks. Then we have the U.S. dollar. That's surging. The U.S. dollar index is about at the highest in 7 weeks. How does that factor into your analysis, if at all?
Well, I think the key thing to keep in mind is if we look at the returns that we had last year, which of course were outstanding, even when you had essentially zero earnings growth for the year, we'll see what we get with the current earnings season that's being reported, but expectations are it's going to be about zero, maybe even negative year-on-year earnings growth, but you still had, of course, 25% or so gains in equity markets. And one of the key drivers for that, besides multiple expansion, was the fall in interest rates. Now, this year, with the Fed more or less on hold until after the election, you're unlikely to get that kind of support, irrespective of what happens with 10-year Treasury yields. So that's clearly a much higher barrier for much appreciation in the market, which what gets us back to we really need to see solid earnings gains over the course of the year. And what we're really going to be looking for out of this earnings season is a corporate guidance that companies give to let us know whether the confidence we have in, say, 10% or so earnings gains by the end of 2020 are realistic or not.
Daniel, what mistake might investors be making who are a little nervous and want to seek out some value stocks? I mean, like energy really hasn't performed that well. Are there other mistakes that you could help them avoid?
Well, I guess you could argue all of last year or last several years has been a mistake from a retail investor point of view, because of course you've had redemptions, broadly speaking, from equity mutual funds. Now, what I think is a bit comforting, if you will, at this point, is though a lot of that money did go into fixed income funds, actually about twice as much money went into money markets. So a lot of people actually are sitting on cash, having been nervous about the equity markets. Clearly that hasn't manifested itself really quite yet. But if, more likely when you do see a bigger correction in the market, I think at least we know there is cash on the sidelines. And given that we think the underlying fundamental outlook, particularly for the U.S. economy, is still good, I would anticipate that people will buy the dip and then ultimately will support the market and keep it from falling really too much.
All right, Daniel Morris, BNP Paribas, thank you very much for joining us. And just want to bring you some breaking news regarding the coronavirus. The CDC has just announced that deadly coronavirus has infected another person here in the United States. That brings the total number in the U.S. to 2. Now, remember, Chinese health officials have scrambled to contain the outbreak, and they have essentially quarantined different cities in China with populations totaling about 40 million people. But once again, the CDC says a second person in the United States, this one in Chicago, has been tested positive for the coronavirus.
Well, a multi-plaintiff trial against Bayer is getting underway today in St. Louis, or Bayer. The farmer giant is facing its 4th U.S. trial over allegations that its popular weed killer Roundup causes cancer. This trial is being held in the Missouri city where Monsanto was headquartered before Bayer bought it in 2018 and acquired that Roundup brand. There are an estimated 75,000 Roundup-related lawsuits against Bayer in the U.S. Most of these are expected to settle out of court. So we're looking at the long-term impact on Bayer. Bayer, Jared, I'll start with you, has consistently underplayed the effects of this, right? Has said it's not going to be a big deal, knew about the lawsuits, at least some of them, as it was making this acquisition, and said it's going to be fine. And increasingly, we see maybe it's not going to be fine.
Well, and $10 billion is a lot of money, but a little bit better than feared. But Purdue Pharma, with the opioid crisis, they were saying something similar, ended up in bankruptcy. That's also a potential in this case, not for Bayer or Bayer, but Monsanto, because that legal entity which they acquired is still in existence. It owns all the liabilities, and that's being discussed right now. So they're reserving $2 billion for future claims, $8 billion of what they're offering for current settlements. If it ends up being too much more than $2 billion, they might just wipe that off the books.
I mean, and this would be a huge deal, not just for the corporate entities, but for farmers, because many of them are extraordinarily reliant on not just Roundup, but the whole Roundup ecosystem. So you've got Roundup itself, you have Roundup resistant seeds that Monsanto also sells to farmers. And so there's a big reliance on this.
Yeah, there is. And Monsanto is also one of the most litigious companies on earth. And so now Bayer is as well. I don't think there's going to be any love loss. But of course, Bayer is going to end up with the products anyway. And so farmers are reliant on these things. I don't see that going away. Roundup, for its part, there's going to be a comeuppance in all of this. And like I said, it depends on what the future liabilities are.
All right. Well, coming up, racing to 2020, Bernie Sanders just cut into Joe Biden's polling lead. We have the latest polls for you straight ahead. Plus, day 3 of the impeachment trial. We'll get the latest from Washington next.
About 10:30 a.m. here in New York City, 1 hour into the trading day, and we're seeing a little bit of a reversal in stocks here. The Dow and the S&P 500 are now lower, even as the NASDAQ remains higher. We just got some new headlines from the Centers for Disease Control confirming a second case of coronavirus in the United States, this one from in a Chicago woman who just returned from Wuhan in China. We have been seeing oil under pressure as we have been getting these reports of coronavirus because China is a huge source of demand. We are seeing oil right now down by nearly 2%. From drone delivery to private spaceflight, we'll hear from U.S. Transportation Secretary Elaine Chao on how the government plans to regulate the growing sectors. Trump on trial, which you need to know as the 4th day of impeachment proceedings kick off on Capitol Hill. And barred from banking, how regulators' decision to ban former Wells Fargo CEO John Stumpf could have a lasting impact on the industry. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. China has implemented a massive lockdown as it struggles to contain the spread of the deadly coronavirus. Several companies are also feeling the impact. Inez Ferre is on the floor of the New York Stock Exchange to bring us up to speed on that angle of this. Inez?
Adam, Disney has announced that it will be closing temporarily its Shanghai Disneyland Resort, closing it starting tomorrow, the 25th. This is a normally very busy time of the year for the resort because of the Chinese Lunar Year celebrations. So Disney announcing that it's shutting down its theme park in Shanghai. Also, I want to mention McDonald's. McDonald's announcing that it's temporarily suspending business in 5 Chinese cities, including Wuhan, which is, of course, on lockdown, and also the surrounding cities around Wuhan, because also of the transportation, which has been suspended in the area. And also McDonald's says that it is taking safety measures at the restaurants that it does have open, including taking the body temperature of personnel when they come into work. And if anyone has a fever or a cold, they're sent home. And then just taking a look at Yum China, this stock's under pressure. This stock actually entered into correction territory this week, down about 10% since its closing price on Friday. This is a company that spun out of Yum Brands in 2016. They have more than 8,000 restaurants in China. Today, slightly under pressure. Adam, Julie.
Thanks, Inez. Well, the future of tech takes the Alps. From autonomous vehicles to drone delivery, big ideas were at the forefront of the World Economic Forum in Davos, Switzerland. Yahoo Finance editor-in-chief Andy Serwer sat down with the head regulator on some of these issues.
I'm here with Transportation Secretary Elaine Chao. Secretary Chao, so nice to see you.
Nice to see you.
So you just issued a report on autonomous vehicles, some guidelines. Can you talk to us about what that entails?
You know, autonomous vehicles are changing so rapidly. The technology is changing every year, if not faster. So we want to make sure that the federal government, which is going to be a major regulator of this new technology, would at least have some harmonized guidelines as to how to approach this new technology. So there are like 38 different federal agencies throughout the government, and they had their own way, their own language on how to talk about all of this. So in conjunction with the White House, I announced a report that we did at CES, and it basically puts forward certain principles. And very top line, we want to talk about safety and security. We want to ensure that innovation is not hampered, and also that whatever guidelines and policies that come from the federal government, that they are consistent, so that there's consistent policy emanating from all these different government entities. And I think that's really important, because the government's role is to create the environment through which innovation can flourish. And that's what this AV 4.0, maintaining America's leadership in autonomous vehicles, is all about.
Really starting to see this coming on stream. And a similar technology or a similar issue for you in terms of transportation that's also coming this year perhaps is commercial space travel.
Very exciting.
And you've got Virgin Galactic, SpaceX, Blue Origin, all ready to go. Are they working with you and your offices to make that happen?
Of course, because they have to get licenses to be able to launch their rockets. And 6 years ago, America was not very much in the lead at all. But because of the advent of American technology and innovation and the invention of the reusable rocket, America has now zoomed to #1. So we're we should all take great pride in that. And the number of launches are increasing every year. So we've had about 32, 34 this year, and next year there's going to be about 44, 45. And as these commercial space vehicles go into space and they become more frequent, we at the FAA, at the U.S. Department of Transportation, have to think about how do we integrate and facilitate these launches. So one example, it's still that if a launch goes up, a certain perimeter of airspace has to be emptied. So this is very disruptive. And if indeed there's going to be more frequent launches, what does that mean for operation of the national airspace? So that's a big question. And second of all, we're also licensing spaceports. So there are over a dozen spaceports now throughout the country, and more states are interested. And then thirdly, the FAA is actually in the business, in the responsibility is a better word, of licensing these launches. And as they, again, become more frequent, how can we facilitate these launches, not make the government such a barrier, but still protect safety and security of these launches? So these are some pretty weighty questions, but I think they speak to the tremendous potential of transportation technology and the benefits that they can bring to our world, to our society, and of course to our country as well.
You think we'll see one this year, some commercial space flight?
Oh, definitely. As I mentioned, we'll probably have about 40 to 45.
Right. Oh, I mean with humans on board.
I think that's a little bit too early because that's, you're kind of asking, but I'm going to give you a serious answer.
Yeah.
Anything that involves a human being exponentially complicates the licensing and the permitting process, and rightly so. It's a human life, and so we have a heightened responsibility to ensure safety. So our mantra at the Department of Transportation on all of these emerging new transportation technologies can be very simply summarized in one sentence, and that is, we are preparing, the U.S. Department of Transportation is preparing for the transportation system of the future by engaging with emerging new technologies to address legitimate public concerns about safety, security, and privacy without hampering innovation.
That brings us to drones, naturally, because that sentence definitely speaks to drones and what people think about it. And it's another business that's exploding, and a lot of work for you guys to do to make sure it's safe, but also to allow that innovation. Where do we stand with drones, Secretary Chao?
Well, I just came out of a panel at the World Economic Forum about how do we handle drones. There are now 1.5 million drones in our country. We have over 150,000 professional drone operators. I was the Secretary of Labor. When I was at Labor, when I was the Secretary of Labor, this job category did not even exist. So now drones are getting bigger, heavier, they have more capacity to carry either freight or potentially human beings. So we're talking about air taxis, and we're talking about all sorts of humans in flight in drones. So our responsibility at the U.S. Department of Transportation is to ensure that the FAA, the agency that's in charge of the drones, again, are viewing safety as a #1 priority. We're ensuring security of these drones because obviously they need to be safe from a security point, cybersecurity point of view. Thirdly, they need to respect privacy. We get a lot of complaints about people who don't want to see drones outside their second floor window, let's say, or third floor window. And then lastly, as drones proliferate, the issue of noise enters into it as well. So the FAA has a responsibility to address noise issues with drones. And how do we license drones? Do we treat them like airplanes? And how do we track them? So for example, we heard recently that there were these coveys of drones flying at night over
in the Midwest?
In Nebraska, in Colorado. We don't know who they belong to. We don't know who's operating them. To this day, we do not.
Really?
And
Are
so,
you investigating still?
the local law enforcement initiates the action. We're very lucky; nothing happened. So the local law enforcement have stepped down. So we're not actively investigating that because the local law enforcement stood down.
Right.
But this talks to a very pertinent notice of proposed rulemaking, which we just announced. And we're sending it out for public comment, and the public comment will end on March 2nd, so please comment. I urge people to do so. But this new notice of proposed rulemaking would require remote identification of drones. So any drone that is over 0.55 of a pound, half a pound, and that is registered with the FAA needs to be able to have remote identification capacity. And again, there could not have been a more timely example as to why we are thinking about this than the covey of, again, drones over the skies of Nebraska and Colorado. And law enforcement in particular. Law enforcement and the military are very concerned about remote identification of drones.
That was our editor-in-chief, Andy Serwer, along with Secretary of Transportation Elaine Chao, and a really weird-looking fern in between both of them. Coming up, the woman who convinced her boyfriend to take his own life was just released from prison before completing her sentence. Plus, The Wolf of Wall Street says the movie company that turned his story of criminal fraud and scam into a film actually scammed him, and now he wants big bucks. Former Wells Fargo CEO John Stumpf agreed to a settlement that bans him for life from the banking industry. Stumpf's deal with the Office of the Comptroller of the Currency requires him to also pay $17.5 million in fines for the fake account scandal that crippled the bank and cheated millions of its customers. Broadcast news icon Jim Lehrer died yesterday at his home in Washington, D.C. The TV news anchor and former newspaper reporter was 85 years old. Lehrer spent 36 years at PBS, where he also anchored the MacNeil-Lehrer NewsHour with Robert McNeil. 23-year-old Michelle Carter, the woman who was convicted of urging her suicidal boyfriend to take his own life, was released from prison yesterday. Carter was serving a 15-month sentence for manslaughter, but had 3 months shaved off for good behavior. The U.S. Supreme Court, by the way, just last week rejected Carter's appeal. Convicted Wall Street scammer Jordan Belfort, a.k.a. the Wolf of Wall Street, is suing the movie company that turned his story into a film. Belfort claims he got scammed because the production company used embezzled funds from other people to finance the film, and he never would have agreed, so he says, to the production if he had known that. Belfort is suing the filmmakers for $300 million.
The impeachment trial continues today. It's the last day the Democratic House managers have to argue their case against President Trump. The president's defense team will then have the same amount of time to make their case. Yahoo Finance's Jessica Smith joins us for more on this from Washington, D.C. What's the latest, Jess?
Well, today, House impeachment managers will try to convince the Senate that the president obstructed Congress while they were conducting that impeachment investigation, the impeachment inquiry. Yesterday, those managers tried to convince the Senate that the president had abused his power by pressuring Ukraine to investigate the Bidens for his personal political gain. Let's watch.
Because he knew it would be damaging to an opponent who was consistently beating him in the polls, and therefore it could help him get reelected in 2020. President Trump had the motive, he had the opportunity, and the means to commit this abuse of power.
Republicans at this point seem largely unmoved by the Democratic lawmakers' case, but we'll see if that changes throughout the course of the day. The president's defense team takes over tomorrow, and the president isn't too happy about that. He was tweeting that his defense is happening during the Death Valley of TV, as he says. His defense will have 3 days to make their case, but they might not use all of that time. After that, we'll move on to senators' questions, and then they'll have a debate and a vote on witnesses before moving on to deliberations and the final vote. So right now, Adam and Julie, this timeline is pushing up against the Iowa caucuses on February 3rd.
The Death Valley of TV. Just don't know what to go with there, but thank you, Jess. Joe Biden and Bernie Sanders are going to are head-to-head for the Democratic nomination in a new poll from Emerson College. Biden received 30% of the Democratic voters, while Sanders received 27% of the support. Here to discuss what this means is Yahoo Finance's Rick Newman. So, as they said on the 1950s sitcom, explain it to us.
I think what it means is it's 2016 all over again. So if you substitute Joe Biden for Hillary Clinton, it almost looks like the 2016 race, doesn't it? Where you've got sort of the traditionalist, the well-known guy at the front, and Bernie Sanders lapping at his heels. This is a national poll we're talking about. What really matters right now is how these candidates are doing in the early voting states. And there it also looks like Biden and Sanders are pretty close. We're also interested in how well Pete Buttigieg does there. Amy Klobuchar is kind of a sleeper candidate. And of course, there are a few others on the ballot.
And what might be different now from 2016, however, is the role that the Democratic Party itself has to play in all of this, right? Because they came under a lot of criticism then for sidelining Bernie Sanders and favoring Hillary Clinton. What's happening this time around?
I guess the party's trying to do nothing. In fact, you're hearing rumors that, Barack Obama, former president, has stayed out of it. He's had nothing to say about who he prefers in this race, but there are some rumors that he may come out.
And he's alarmed about Bernie Sanders.
That's right, by the rise of Bernie Sanders.
Yeah.
I mean, I think it's fine that Bernie's in the mix, that he's sort of down there trailing, and everybody knows his story. But yes, the Democrats are nervous that if he's the front runner, he just won't be able to beat Donald Trump because he's happy to acknowledge that he is a socialist or socialist.
Or maybe they're nervous that he will. I mean,
I don't think so. I think they're nervous. I think the Democrats want anybody who can beat Trump, and that's why Bernie is sort of giving them heart palpitations at this point. But look, I mean, it's actually quite similar to what we saw in 2016. And, I don't know how decisive the role of the party was then, driving a wedge, between some voters and Bernie Sanders. But he didn't win. I mean, as close as he came, he helped define the race. He helped introduce some new issues that tended to catch on a little bit. I mean, give Bernie Sanders credit for putting Medicare for all on the map and at least getting all these candidates talking about it.
And he seems to be doing a little bit better among minorities this time around. But I haven't heard you mention Elizabeth Warren yet.
Oh, wait, I have her.
At least I don't think so.
Elizabeth.
I have her.
Okay, is she?
Yeah,
do you think she's out?
She has clearly faded. I won't put her behind the two. I'll just put her with the two. She's clearly faded. I mean, she was close to being a front runner in the fall, but she seems to have tripped up on Medicare for all. That actually,
she pulled back
that's the point. Well, she got a lot of criticism because she wouldn't say how to pay for it at first. And then she did say how to pay for it, and that was pretty ugly because there's really no way to do this just by taxing the wealthy. I mean, it would cause all kinds of disruption and a lot of new taxes. And then she pulled back from it. You're right. So she seems like her heart really wasn't in it on that. And of course, healthcare is probably one of the top 3 issues for Democrats.
In the echo chamber that we refer to as the Northeast, the fact that the New York Times endorsed her and Klobuchar, does it mean anything for Democratic voters as we go into Iowa?
I mean, the New York Times has been roundly panned and reviled for
years,
unable to pick one candidate. I mean, what does it mean when you pick 2 candidates? Voters don't get to pick 2 candidates. So I mean, how much does a New York Times endorsement matter in Iowa and New Hampshire and South Carolina, Nevada? Probably not very much. It can't hurt if you get it, but I don't think it's going to make a difference.
Do you see you're talking about how there's nerves about Bernie Sanders gaining. Do you think that that was the strategy behind Hillary Clinton coming out and saying, nobody likes him, nobody wants to work with him, he's a career politician? Do you think that's part of the strategy?
In other words, she was doing the bidding of the party. She was sort of a plant for the party.
Right. I mean, she did that with Gabby Tulsi Gabbard, yeah, and kind of took her down a few notches, and now she's being sued for it. But do you think that's kind of like their strategy there? We'll just, throw out some bombs and see what hits?
It's certainly not out of character for Hillary Clinton to criticize Bernie Sanders. I mean, they were bitter rivals in 2016, and she had all kinds of nasty things to say about him. So she's staying in character, and it's not as if she doesn't pop up from time to time and say what's on her mind. So she could be a proxy for the party, I suppose. We will find out more if Bernie Sanders actually starts to win a couple of states. I think, my guess is that everybody is just forgetting about Joe Biden. No one's talking about him. Well, I have to if I put Trump away, if I put Trump down here, they're sort of scaled to each other. No one's talking about Joe Biden, but he has been the front runner by a little bit for a long time, and he still is the front runner. So, there in the fall, there was talk that Joe Biden might not even finish in the top three in Iowa. And the worry was if Biden can't even crack the top three in Iowa and New Hampshire, he is going to do very well in He's probably going to win South Carolina because he commands minority vote, which will be important there. But what if he wins Iowa? If Joe Biden wins Iowa, even if Bernie Sanders is a close second, I think the party takes a deep breath and relaxes a little bit, and Biden will get some momentum, some additional fundraising, and some of the other candidates will probably start to drop out, and we will start to see some consolidation among the Democrats. But Bernie Sanders has enough money and enough support to stay in this race probably through the end. So he's going to be an adjutant the whole way.
Good times.
Yeah, I think so.
Google's annual developer event has a date and a location, and we're going to tell you where and when coming up. Plus, implications for investing in 2020. Jared will take a look at some key areas for us.
Let's look at a couple of stocks that are big movers right now. One up, one down. eHealth is the up mover. The company, which provides online comparisons for Medicare plans, it came out with a preliminary fourth quarter forecast that was above what analysts have been anticipating, and they are gushing about how the company has been doing, not just with this forecast, but its performance as of late. And the stock is definitely performing, and how, in today's session. Also, let's take a look at Discover Financial Services. That company's earnings per share also beat estimates, but the stock is lower by about 10%. That's because it said its net charge-off rate was about 3.19%. That's an increase of 11 basis points. It also raised its provision for loan losses to $836 million. In other words, more people not paying back their bills.
It's time for Word on the Street. We're going to check in with our panelists and find out the stories that they're watching. And Jared, you're looking at the implications for investors this year. We keep talking about all kinds of things, earnings growth, what's going to happen. What do you want us to know?
Well, I always like to look at bond yields, and those have been sinking in 2019 so far. In fact, the 10 years down about 22.5 basis points. That's a big number. That's a big drop. Some of it has to do with the coronavirus, so that was a factor. But it was dropping at the beginning of the year, too. So, the first 8 months of last year, what was working? So those high growth names, those momentum names, big tech, and also defensive plays, because as the 10-year was dropping for the first 8 months of the year, utilities, real estate, those plays were doing well. Well, the same thing is happening this month. So in September of last year, we started seeing this rotation in value in cyclicals. That has absolutely gone away so far in 2019. Doesn't mean that has to persist, but energy is the worst performing sector. And financials definitely underwater here for the year. And what's doing well? Tech and utilities again. So just something to keep in mind as we go through this year. It's kind of a carbon copy of last year, at least at this point so far.
Yeah, there's also the perennial question of, will we see tech continue to lead? People keep predicting its demise, and they're not.
3 or 4, maybe longer.
Yes.
And every time we get a dip, people buy it.
Exactly. So let's turn to one of the tech giants to see what's going to propel it further. I'm talking about Google, or Alphabet, right? Google, though, setting its dates for its annual developer event.
Yeah, the Google I/O is their annual conference, and it's going to be from May 12th to May 14th in Mountain View. And really where this, what they do here is Sundar Pichai will come out on stage, say, hey, I'm the head of Alphabet now. Everybody can just come to me and hang out. Not really. But what they do is they talk about a lot about what they want to do for the future. So you get some concrete topics, but then you get a lot of these like long tail announcements. So one of them in the past few years was the way that some Google Assistant will be able to answer phone calls for you or take phone calls for people. That really hasn't panned out. You do get a lot of updates on what they're doing with the Android ecosystem and then what they're doing in the server space. And that's really where they kind of want to go. Google is far behind as far as the cloud wars go. They are nowhere near Microsoft or Amazon. Let's not put Microsoft and Amazon on equal footing there, though. Amazon is still crushing Microsoft. What's driving Microsoft is the amount of growth that they have in that space and the runway that they have. But this will be interesting to see what happens with Android, believe it or not, because this year will be the year that we really do get to see functional, commercial, consumer-level foldable devices. And Android last year announced that or Google announced that Android will have a version for foldable devices, and that's what we're going to see. So the Samsung foldable phone, the Huawei foldable phone, all of those, they're running Android kind of like a screwed up version of Android to fold in half. But now Google is going to have a version. Yeah, and then
isn't Google the one that comes up with like the goofy names for its operating systems, like ice cream?
They stopped actually. They stopped.
Good.
So now it's just numbers. But it's interesting because we're going to see Google announce this, and shortly before that, we'll see Microsoft roll out their version of Windows for foldable devices, and that's going to be, they're going to have an Android-powered Microsoft device. It's insane. Google's going to be powering the software inside of Microsoft's device, even though Microsoft makes software.
I love it when Dan Halley gets all fired up about this stuff. All right, coming up, Intel shares hit a 2-decade high after beating earnings estimates. We're going to break down the numbers for you. And here comes Apple, what we should expect from the company's earnings report as the battle for 5G ramps up. about 11 a.m. here in New York City, 90 minutes into the trading day. Stocks are mixed right now. The Dow and the Nasdaq very slightly higher than S&P 500, very slightly lower. Let's look at the 10-year Treasury yield as well to see if there's any more movement there. There is actually down 4 basis points, 1.7% is where we stand there today. I'll have to ask Jared in a minute when the last time is that we were at that level.
About 7 weeks.
7 weeks, all right, quite a while. Intel on the rise, shares jump as PC sales help drive a strong fourth quarter for the company. We're going to break down the numbers. Shifting genes, 23andMe announces layoffs as consumers cool on DNA testing. And AI warning, why top CEOs are sounding the alarm over the rise in artificial intelligence. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Stocks have turned negative. That's after news of a second case of coronavirus was confirmed by the CDC last hour here in the United States. We want to go to the floor of the New York Stock Exchange. Inez Ferre is there watching what is taking place for us, and we're trying to go positive again.
We are trying to go positive again, Adam. Now, airline stocks took a hit when that CDC headline came down. Some of the airlines with routes to Asia. You're looking at Delta that's still under pressure. Delta down about 2%. Also, American down about 3%. And United down about 3%. United earlier this week in their earnings call, executives had said that they were in talks. The company was in talks with the CDC about the coronavirus, very much on top of this, as well as safety measures and screening measures. And then just taking a look at some of the China stocks, which have taken a hit this week. You're looking at Yum China, which Yum China entered into correction territory this week, down about 10%, more than 10% since its closing price on Friday. Today it's down more than 1%. This is the company which spun out of Yum Brands back in 2016 with more than 8,000 restaurants all over China. And then if you take a look at Luckin Coffee this week has been under pressure. Today it's down about 7%. This is the competitor for Starbucks in China. They have more than 4,000 shops in China, and many of them focus on delivery and also pickup. So a lot of back and forth, and in some of these areas where, in some cities where there's a lockdown, that's very difficult to do as well. Adam, Julie.
Thanks, Inez. Well, Intel is out with its fourth quarter results. The chipmaker topped Wall Street estimates and predicted strong 2020 sales amid an emerging rebound in global chip market. Shares of Intel getting a lift from that report. Let's dig a little deeper. Our panel, Yahoo Finance's Jared Blickery and Dan Howley. Intel shares are up about 9% right now.
Yeah,
and
best
Jared,
in 2 years.
Yeah, so we've been seeing this big rally with all the chip makers. Intel hasn't always been participating in that, at least not in the same magnitude, but these results are encouraging.
Yeah, they had a couple of headwinds over the last few quarters. Number one, they weren't able to crank out enough PC chips to meet demand, so now they're apparently doing that. Another thing is they're just getting smoked by AMD in the server wars. AMD's latest server chip, when that came out a couple quarters ago, it was just evident that it's light years beyond what Intel is doing, but Intel's cranking up the volume. They also do produce chips that are used in these server farms for the cloud, and that's doing well for them. And overall, before this report had even come out, they had broke to 19-year highs. They haven't been this high since the tech bubble burst, basically.
But there's a lot of talk that maybe the future for growth here might be subdued, yet everything is cloud, AWS, whoever's cloud you want to pick. Why wouldn't they have even greater growth going forward? Because look at Amazon. Amazon's cloud it's 9% of their revenue. They're going to grow. They're going to need more chips.
So I think what it comes down to is when companies purchase the actual servers. That's been kind of the issue because it's cyclical when they do this. And so you can see it's either front-loaded in the first half of the year or it's back-loaded in the second half of the year. We've seen them kind of front-loaded, and so that's why towards the end of last year you saw the stocks for the chip companies fall a lot because people weren't making those purchases. That, on top of the trade war, was making a bigger issue for them. But I think what you're going to see is companies start to reinvest into their infrastructure, make sure that they have these kinds of systems up and running, and then in the back half of the year, you might see kind of a fading a little bit of the growth from these companies. But for Intel itself, it's interesting just because, as Jared said, they were holding up these chips coming out, we talk about nanometers when it comes to chips. It's basically the distance between the transistors. And so we're starting to get to a level where silicon can't even be used to conduct the electricity in these chips. And they're trying to get past the 10 nanometer. They haven't been able to put out the products for the 10 nanometers. They've been stuck at 14 nanometers. AMD's been like, we can do that, no problem. So they've been pushing them out. And so you're starting to see more consumers particularly go towards AMD because they have the technology, and guess what? They're cheaper. And that's also happening in the server space.
All right. 23andMe, they say it is going to lay off 100 employees. That's about 14% of the home DNA testing company's staff. CEO says the cuts are due to declining sales. Yahoo Finance's Dan Roberts joins us now. And why is she saying sales surprised her, that they didn't see this decline coming?
Well, they were extremely bullish on home DNA testing and thought that this market would really pick up. Instead, it's decelerating. And this is a company that clearly is in trouble. And most troubling, it doesn't know what to do about it. Anne Wojcicki, who is the CEO, that's the sister of Susan Wojcicki, who's the CEO of YouTube, and very accomplished in the medical field and in the field of science. I mean, started this company, and it has gotten a ton of funding, but it has had its ups and downs. It has had trouble with the FDA. For a while, they had to stop doing the testing. Then they made some changes. And she is citing, potentially as a theory, privacy concerns as the reason fewer people are doing these tests. But she doesn't know. And in an interview with CNBC, she said, this has been extremely troubling for us. And boy, it is troubling. I don't know what the future of this company is. I mean, they laid off 15% of their workforce, and most of the workers were in the product.
What's the value proposition for this company? Well, yeah, I think the security concerns have dented their sales. There's not as much interest, but the real value for consumers should be health. And they used to make some comments. They, as you said, they got into trouble with the FDA because they weren't qualified to do that. They are only qualified to opine on some very specific use cases for the product in terms of health. If they could cross that threshold, I think there'd be a lot more demand for the product.
Yeah, and they're going to try to emphasize their therapeutics products instead, which I don't know as much about, instead of the home testing. But I do think it's unsurprising. I mean, for those of us who've known that this company and this option was out there, if you were someone who was going to buy one of these things and you were interested in trying it, I feel like by now you would have. They're $99. I've bought them as gifts often for people. So
I got one as a gift, and I didn't use it.
So I bought one for my parents. They didn't learn that much. I learned you are exactly what you thought. You're 100% Jewish, and you're from this part of Eastern Europe.
And the other problem is it's not a repeatable thing. In other words, once you have used this product,
that's it.
You're not going to use it again.
But on the privacy issue, so a family member of mine did this. And I don't know, you have to sign up that people can contact.
You opt in.
Well, yeah, well, this family member opted in and apparently got contacted by people who were related to, but basically because this family member's genetic code is very similar to mine, essentially I'm in their database even though I've never done it.
Don't like
That's
that.
the privacy issue
Don't like
right
that.
there.
Isn't there also two things? Great beard. Got to throw it out. Gotta, you get the beards going. Gotta
Maybe
get
we should test our DNA.
Yes, maybe we're related. But I think the idea, though, outside of just the privacy that someone else could get you in there is that the government can then get access to your DNA. And that's what we've seen. Obviously cold cases have been solved through these kinds of technologies. So do you think people are seeing that? And then outside of the fact that it's a one and done, I don't need to retest who I am or where I'm from. Do you think that that's also an issue where people are saying, I don't want the feds to know where I've been or what I'm doing?
Well, so some people cite the Golden Gate killer or Golden Gate Bridge killer as one kind of inciting news event that has soured people on these things because DNA tests were used. Now, on the flip side, let's make sure we mention there are some positives to doing this. I mean, CBS Sunday Morning recently did a big feature on people who met an entirely new long-lost relative because they did a DNA test. Now, one of the people in the feature also learned that the person they thought was their biological brother their whole life isn't related to them. So you also risk learning troubling news.
Back from the days
that
of
can be
milkman
life-changing. Sure, exactly. Babies switched at birth. But yeah, look, I just think that I love to say, a favorite take of mine is, people don't actually care that much about their data privacy in the end. They hem and haw, but really, if it's going to make their life more convenient, they'll do it. A good example is Clear, the service at the airport where you put your fingerprint. I love it. It has changed my life. I don't care that they have my data. Now, that said, maybe DNA testing is an example where I'm wrong on that take, and people do care. And they're
You
saying,
paid the $109 for Clear.
This is not a convenience, though, right? That's the difference between this test.
Yeah.
You don't have to do it.
No, it's something that it doesn't make your life easier. It's just interesting.
Yeah,
so maybe that's the distinguishing factor.
One of the things interesting is I was at the doctor yesterday and I was in the waiting room and there was this group doing a survey. It's for, I think it's the National Institute of Health. It's All For Us, and they're trying to get more DNA samples from more people to figure out how they can better tailor medicine. And
ads.
Well, yeah. I mean, no, this is specifically for medicine, but it was interesting because they're going around asking everyone in the waiting room, and the person next to me goes, "Who keeps the data?" And I was like, "Wow, that means that regular folks now are starting to realize that the data that is taken from us is incredibly important." Now, I got to say, they said that you keep all the data; it's yours. You know, it's identifying factors are for you. But you know, it was interesting to see someone in particular say, "Who keeps this?"
Now, the headline here is the man who won't do Facebook actually paid for Clear because they have all that kind of information.
Love Clear. Don't care. Love it. The best combo is Clear plus.
Stand in line with the rest of us at the airport.
Thank you, Dan. All right, it's not us, it's them. That's the message some of the biggest leaders in tech had for audiences at the World Economic Forum in Davos, Switzerland this week, warning that artificial intelligence is what should be closely regulated, not the tech companies themselves. Microsoft CEO Satya Nadella was asked about regulating AI and if nations like China care as much about it as the U.S. does.
I think China cares as deeply about AI ethics as the United States. To assume that somehow the Chinese people and the Chinese government are also not going to worry about the implications of AI run wild would be a problem. And so therefore, I think both the United States and China and the European Union having a set of principles that govern what this technology can mean in our societies and the world at large is probably more in need today than it was in the last 30 years.
Nadella was one of a number of tech leaders who called for standardized rules on AI. IBM's Ginni Rometty and Google's Sundar Pichai did as well. But what's more interesting to me is them sort of saying, we're not the problem. We don't need to be regulated. It's AI that you need to pay attention to and have standardized rules on.
You know, this has been something that the tech companies have been kind of, I don't want to say crying about, but, you know, making, I mean, we have Elon Musk who says we might be in a simulator, or, you know, I mean, I think there's different issues going on with AI. There's the science fiction, AI is going to take over and become sentient. AI right now is dumb as a box of rocks. It's not really what you think it is. It's, you fed it this information, it can pick out that information.
Okay, so he is a genius and has done great things with Microsoft. Where I'm having a disconnect with what he said in regards to the Chinese, they're using AI facial recognition data to follow 1.3 billion Chinese, and it's the Communist Party, 82 million, controlling 1.3 billion. The social, what do they call it? The social scoring situation. Right. So when he's talking, because it's, I might have misunderstood what he's talking about, but is he talking about standardization for the use of that kind of technology? Because that's already out of the box, and the Chinese aren't going to pull that one back in.
So Microsoft, in particular, as well as Google, have come out and said, we're not going to allow certain countries or certain agencies to use our facial recognition technology.
The Chinese can do it without them.
Right. So they're not using Google or Microsoft. Microsoft will work with other agencies, but not, you know, certain. And they've said that they've gotten calls from foreign governments saying, look, we want to, you know, contract with you, and they turn them down. But I think what they're asking in particular is a set of standards to say, this is where we draw the line, that we can't go further than this as far as AI.
Let's get back to the original point, was that these tech executives are saying that the technology should be licensed, it should be regulated. Maybe you need a 10 commandments of AI or something to that effect. This reminds me almost 15 years ago, especially 10 years ago during the financial crisis, when high-frequency trading was coming to the forefront. And I remember the CFTC, which regulates futures. There was somebody there, Bart Chilton, who wanted to put a good housekeeping seal of approval on every algorithm. It's just not feasible. This technology is so advanced and beyond the capability of not only the regulators, but the average person even to understand. Good luck with them regulating it.
I think, you know, what you're going to see eventually is there'll be rules for the companies, and they will have to follow them. And then there'll be another set of rules for the government, where the government will say, look, we have these rules in place as regulators, we have this, but then, you know, behind the scenes, we'll have the government working on real in-depth kind of AI that maybe the public wouldn't want to necessarily know about. So, yeah, I think that's kind of where it's going to be.
All right. Well, coming up, the rise of fake news. A new study finds the truth is harder to reach people than false news on social media. We've got the details. And people, how's the housing market doing?
Yeah,
we'll talk
pretty
about
good.
that.
Stocks going into the red. This is On the Move. I'm Jared Blickery. So the S&P 500, which was in the green before, down 16 basis points. Dow is now it's in the green again. Head dipped into the red. Here's the intraday price action. Now, something happened in the last hour when we got that CDC confirmation of a second case of coronavirus. We took another leg down, not only in stocks, but also interest rates, and gold spiked. So we'll take a look at some of these markets here. I'm going to go to a 6-month chart on a candlestick basis. Where do we have support in the S&P 500? Well, we have it at about 3,300. That's right there. And then we have 3,260 to 3,270. That's right there. In the grand scheme of things, we're not talking about big drops here at all. But we want to take a look at the 10-year T-note yield, because as I said, that had taken another leg lower on that coronavirus report. And this is something that we've been watching, this consolidation here going back to September of last year. Now we have definitively broken to the downside, and we could be racing towards that 1.43 support that we saw in September, and then we have 1.33%. That is the record low below that. Also looking at the U.S. dollar index, that is climbing here, and that is I believe it's a 7-week high. And before we go, I want to take a look at WTI crude, because that has sunk now to about a 7-week, or is that actually a 12-week low? It's down. We're going to be back in a minute.
Mortgage rates fell this week to hit a 3-month low. Now, this comes as the prices in the housing market continue to rise. Here with us to discuss all of this is Doug Duncan, Fannie Mae Chief Economist. It's good to have you here again, Doug.
Thanks.
There's a double-edged sword when mortgage rates are falling, because that also inflates sometimes the prices, and we're already in a lot of places at levels that people call unaffordable. So what does this mean for people who might be buying or selling?
Well, you're absolutely right about that. And the way to think about the relationship between those two things is it's driven by the greater strength on the demand side than the supply side. So when borrowers look at the size of payment that they'll have to make to buy a house, it has an interest component and a principal component. So when they figured out what payment they can afford, if interest rates fall, the interest component of that payment shrinks so they can bid the price of house up, and that shows up in the principal part. That's why prices go back up. So the decline in rates from an affordability perspective helps, but it's partly offset by prices. That said, it's still the expectation in the housing market is it will pick up strongly this year, probably about a 5% increase in new home sales and a 1.5% increase in existing home sales. That's a pretty good year, because these are historically low interest rates.
I want to talk about the spectrum of housing, right? Because Fannie Mae itself, I know you as an economist focus on the entire housing market. Fannie Mae itself focuses on the sort of lower end of the housing market, right? Capped. It doesn't handle jumbo mortgages, which are for the pricier homes. So with all of the information that we are getting about sort of mid to lower income consumers, the fact that their wages are rising more quickly than the rest of the market, for example. But anecdotally, we also hear that a lot of them are sort of on a knife's edge in terms of expenses. How is all of that translating into that segment of the housing market?
Well, there's no question that the demand is being driven by lower income, first-time home buyers. The millennials, frankly, started in about 2015 as the driver. Because of where they are in their life cycle, their incomes are lower because they're starting to grow. So the credit analysis business is to determine who's on a knife's edge, and getting into a mortgage would actually tip them over if there's a problem in the economy. So you've seen some things in the news today about credit scores and the rejiggering of credit scores. That's key in trying to figure out what's sustainable in terms of a mortgage. So you don't just want to give people a mortgage, you want to make sure it's sustainable for
Is that going to do, are these new standards going to do a better job at that?
Well, I think they will. I think it's a response to the fact that we've had a long expansion now where there was a big upset in the housing market, and people are testing whether this experience in this expansion is stable or not. So that's why you're seeing an exploration in that, but it's only one piece of the puzzle on whether somebody can pay back their mortgage. There are other components of that too. It's the composition of debt. Student debt, is that an issue for you? Are you managing that well, and is it going to tip you over if you apply for a mortgage? So it's a complex calculation. Credit scores are a piece, they're an important piece, because they say something about your willingness to have paid back past credits.
No, I want to talk about the supply of new homes. We were talking about the home builders just doing phenomenally well, especially this month as we've seen the long end of the yield curve come down. And Lennar happens to be one of the best performers in the S&P 500. But we had a situation last year where there just wasn't the supply of new homes coming onto the market. Is that situation being resolved? Are we lengthening that window into this year?
It's still true that there is less supply than there is demand for. The problem that builders have is traditionally the bulk of the building builders have done is to the move-up buyer. A small share of what they have done is for entry-level buyers, but typically an entry-level buyer will buy an existing used home. Mm-hmm. They'll put in some sweat equity into it. That builds them some equity for the move-up, and so there's this kind of a ladder. Builders typically build further up on the ladder, so the square footage they've been building has been shrinking, so they're moving toward that entry-level borrower. But if you think about their sales staff, when you walk into the sales office, they're going to offer you, do you want granite countertops? Do you want finished basements? Do you want, what kind of paneling do you want? Those are all options that move-up buyers would consider. Okay. If you're an entry-level buyer, you're looking for basics. Yeah. 3 bedrooms, a bathroom, and a garage.
All right, Doug Duncan is the chief economist at Fannie Mae. Thank you for being here on The Move.
Thank you.
Well, fake news spreads faster than the truth, and according to an MIT analysis, false information on Twitter is 70% more likely to be retweeted than factual information. How does this create potential risks for investors ahead of this year's election and potential risks for all of us? For Yahoo Finance's Melody Hom has the details for us in today's West Coast Wrap. Melody?
Hey, Julie. Yeah, this is an MIT study that Paul Donovan, the chief economist at UBS, is citing. And I think for our Yahoo Finance audience, of course, to your point, humans should be afraid and humans should be held accountable for spreading this kind of false information, which, to be honest, has not fully been checked, right? There has been very little accountability for bad actors on platforms like Twitter and Facebook. But he rightfully points out that even looking at, say, the coronavirus, right? It's most likely compared to the 2003 SARS virus, when essentially social media was non-existent. Now you see a lot of echo chambers and niche groups really kind of sparking that xenophobia and really encouraging perhaps more of this boycotting on China, a lot of tensions. You know, as someone who uses Korean platforms, KakaoTalk, a local Korean social media outlet, they've been proliferating a lot more fake news about the Chinese economy. It's just stoking a lot more racist and xenophobic fears. So that bodes very, very a lot of trepidation for investors and economists like Donovan, who says that it's probably the biggest risk going into 2020 because a lot of these boycotts and protests and even petitions that are circulated online are not necessarily organized in a proactive way where you can anticipate their outcome and their kind of momentum. So I think this is a really interesting conversation and shows an existential crisis that's happening within the election.
And Melody, just quickly, what are the implications for Twitter also?
Yeah, for Twitter, it's important to point out that a couple months ago, Jack Dorsey did ban political ads, and it has become almost a political act itself, right, for these leaders to come out and say, hey, we don't want to be involved. Whereas Mark Zuckerberg, of course, is doubling down on allowing these ads to float freely without being fact-checked.
Thanks, Melody. And thanks also to Dan and Jared for being here for this 90 minutes. And coming up, President Trump lauded negative interest rates at Davos while taking another shot at the Federal Reserve. But what actually are negative interest rates? We're going to break it down in the latest edition of Yahoo U. Plus, big changes could be coming to your credit score. We just alluded to that with the chief economist from Fannie Mae. And now we're going to break down the latest updates to FICO coming up.
We are just past the halfway point in our 3 hours of power in New York City. 2 hours into the trading day, and stocks have fallen into negative territory. Remember, On the Move is on for 3 hours, 10 a.m. to 1 p.m. Take a look at the 10-year Treasury yield. It is falling 1.7%. Prime for growth, why Morningstar says Amazon Fresh is finally ready to deliver big when it comes to online groceries. Facebook under fire, why Italy is threatening to fine Mark Zuckerberg and company. And President Trump wants negative rates. Yeah, but the Fed ain't buying. But if they did, what would that mean for your investments? Our latest episode of Yahoo U breaks it down just ahead. Welcome to On the Move. I'm Adam Shapiro.
Spoiler, nothing good for a lot of stuff. All right, Morningstar recently released a new report on Amazon Fresh with analysis showing the company is poised for online grocery acceleration in 2020. RJ Hatovi is a consumer equity strategist with Morningstar and joined us now with more from Chicago. RJ, thanks for joining us. I have to say, even as an Amazon Prime customer, I personally did not realize they'd gotten rid of the fees for Amazon Fresh. So maybe they're not doing such a great job of publicizing it, but you say that this was a great move on its part and is going to help that service grow.
Yeah, I do. And to be honest, you were probably one of the few people who weren't aware. It seemed like that was one of the key catalysts, right? Maybe you just slipped through the cracks there, but it was definitely a big moment. What we've seen in the past that U.S. consumers have been slow to adopt online grocery for a number of reasons. It's costly, it's sometimes inconvenient, and honestly, a lot of people just like going to the stores to see the produce and proteins before they purchase. However, when Amazon takes away the $15 monthly fee and opens up 1 to 2 hour delivery windows, I think that got a lot of people's attention. We looked at Google Trends and saw that a lot of people searched Amazon Fresh at that point, and more importantly, I think they acted upon it. We used a third-party data service called Placer to track movement inside of Amazon Fresh's fulfillment centers, and it seemed like there was a big spike in activity there. We guessed that between the month of November and December, when they dropped the fees, we saw upwards of a 40% spike in order frequency among consumers. And I think that's going to continue in 2020. I think Amazon broke down a lot of those cost and convenient barriers that have been preventing U.S. consumers from buying groceries in the past.
So I'm one of those geeks who does like to go to the store, and I like to, what am I paying per ounce depending on the size, and I compare it to all those nutty things. But what I don't understand, I think a lot of us get confused when it comes to Amazon. How do they integrate, if they integrate, Amazon Fresh with Whole Foods? Because they could have efficiencies there that we see played out with, say, Walmart and Target.
Yeah, you're absolutely right, and I think that's going to be the next step of the evolution. I think getting consumers to adopt and try it, Amazon Fresh is important. And the reason why this is important is because they're running out of white space in terms of new Prime member acquisition. Our best guess is that there are north of 90 million memberships in the U.S. to this point, and that doesn't leave you a lot of additional growth for new members. And so now the strategy for the company, we've seen a pivot, and it really think back to everything the company's done the last 2 years, whether it be Whole Foods, whether it be pharma, everything that they have is either subscription or membership angles to it. And I think the orders, the strategy is getting more engagement out of consumers at this point. But the next step is to better integrate the two businesses. I think that's one of the shortfalls. It's a little bit awkward that you have to go to either an Amazon Fresh or Whole Foods. I think as you start to streamline and integrate the two different supply chains between the system, I think that's an opportunity, because I don't think consumers want to place different orders for different products at Whole Foods and Amazon Fresh. So I think that's going to be the next big opportunity for this company. And what I think we'll see is that that'll help to promote even greater engagement among Prime members.
Yeah, so why are Americans so slow to adopt online grocery sales compared to other developed markets? Because it's not the same story when you look at Japan or South Korea. So in the U.S. in 2019, it was only 4% of overall food and beverage sales that happened online. It's supposed to grow to 9% in 2024, but it's still not that big. So what are other countries doing differently than we are?
Well, the big difference between the United States and the other markets you mentioned, whether it be Japan, South Korea, and I'd throw the United Kingdom in there as well, population density explains a lot of it. The fact that there's more consumers, more packly dense in those markets, in those countries, I think that's the biggest reason. It makes sense. It's easier for the delivery companies or the online grocers themselves to get products to these consumers in a more cost-effective manner. In the U.S., we're a little bit more spread out, and I think that's been one of the big deterrents. But I also think that at the end of the day, a lot of the companies, particularly the traditional grocers and mass merchants in the U.S., underestimated how operationally complex this business is. This isn't something where you can just when an order comes in, 1, 2 day or 2, 3, 4 day shipping. It's something that you really need to have within a few hours, within that same day ordering, and that's a very complex business. I mean, even Amazon, it's taken them close to a decade to get it right, and so I think that's the other issue that's really taken a while for it. And then on top of it too, just changing consumer behavior is something very difficult. All consumer companies have struggled with this in the past, and while Amazon has certainly changed behavior in terms of expectations for 1 and 2 day shipping, getting something within a few hours is still something that a lot of retailers and consumers have honestly struggled with, and not realizing that this is really a benefit that's available to them at this point.
Or didn't even know it existed fee-free in my living in a cave case. RJ Hottovy, consumer equity strategist with Morningstar. Thank you.
In Italy, Facebook is facing a $5.6 million fine for failing to tell users how it uses their data. Yahoo Finance's Tom Belger joins us from London with more on what all of this means. Doesn't sound like a lot, 5.6 million, but fill us in.
Yeah, so this starts back in 2018 when Facebook was first accused of violating Italy's consumer code. It was fined at the time for basically not telling users how their data is used, or that they were giving their data for commercial purposes, effectively as part of the deal for signing up. The authorities at the time also said that Facebook had put undue, aggressive influence on customers to share their data by pre-selecting the broadest possible consent settings. Now, they're having to impose yet another fine, potentially up to 5 million euros, because Facebook has failed to comply. Now, people might take a view on whether that penalty really is tough enough, but the Italian authorities seeing fit to demand potentially that penalty if Facebook doesn't make clear, which apparently it's still not doing adequately, how that data is used. Facebook dispute this. They told me today that they have changed their policies. They've updated their terms of service to show how money is made. They say they are committed to transparency and to giving users control over data. Interesting thinking about the timing of this as well. It comes hot on the heels of a big heated row over tech taxes in Europe that would hit US firms like Facebook. We've seen, may have seen France pausing its plans in the hope of reaching some kind of global tech agreement on taxes, but Italy and Britain are very much pushing ahead with their plans for a new tax, 2% tax in the UK at least on revenues from UK users that would hit Facebook from April. And Steve Mnuchin just this week saying that US tariffs could hit Britain and Italy if those taxes go ahead. So all to play for. And just finally, worth saying, the UK government, interestingly, has been quite defiant, even though you might think that's surprising given how much they seem to be keen on a US trade deal. The UK government is saying this is a matter of UK tax policy. It's not for the US, and multinationals have to pay their fair share.
Thanks so much, Tom. Coming up, calculating credit, how new changes may cause your credit score to fall. Plus, President Trump makes the case for negative interest rates. But what are negative interest rates? How do they work? This week's edition of Yahoo You is coming up.
President Trump targeted the Fed once again in his welcoming remarks at Davos over the week and seemingly encouraged the central bank to adopt a negative rate policy. But what does that actually mean for all of us? It's time for Yahoo You. Yahoo Finance's Brian Chung is here with this week's lesson. Brian?
Well, class is in session, and today we're breaking down the basics of negative interest rates. In Davos just this week, President Trump reiterated his call on the Federal Reserve to push borrowing rates into the negative. Take a listen.
They're forced to compete, and we compete with nations that are getting negative rates, something very new, meaning they get paid to borrow money, something that I could get used to very quickly. Love that. Got to pay back your loan? Oh, how much am I getting?
Trump was referring to the few corners of the world that currently have negative interest rates, like Japan, the Eurozone, and Switzerland. And Denmark actually also had a negative interest rate on certificate of deposits until last month, and also Sweden had negative interest rates. Now, these are the interest rates set by the central banks in these countries. The Sveriges Riksbank, that's in Sweden, was actually the first to implement such a policy in 2009, followed by the others between 2014 and 2016. But the rates that you see here are largely interest rates between banks and the central bank. So when rates go negative, does that mean that you'll see negative rates on your bank deposits? Or how about your car loans or mortgages? Well, let's start off conceptually with the broad idea of interest rates. So here in the United States, we are still in a positive interest rate environment. The Federal Reserve pays interest on money that banks park at the central bank by JP Morgan Chase or Citibank, for example. And currently, the effective interest rate between the Fed and the banks is 1.55%. Now, this sets a benchmark for how banks pay depositors for leaving money at the bank. So that bank may turn around and then pay 1.55% to Julie, who has a 9-month certificate of deposit, for example. But again, the 1.55 is actually just a benchmark. So I was looking across the street, for example, and a community bank here in New York was actually paying 1.85% on a 9-month CD. So to compete for deposits with other banks, some shops will actually bid up the interest rate to attract the Julies of the world that are looking to park their money. So then what happens in negative interest rates? Well, here we have Adam in a country that has negative interest rates of negative 0.5%, like in the Eurozone. Now, in theory, this means that the central bank is charging a bank 0.5% to leave the money with them. Now, this clearly creates a disincentive to deposit money. I mean, it would be better off for the bank to then lend the money out instead of leaving it at the central bank. So in turn, the central bank would turn to Adam and say, we're going to charge you 0.5% for leaving the money with us. But again, just because the bank is paying 0.5% to the central bank doesn't necessarily mean that the rate will transmit to consumers. So, for example, in Switzerland, UBS is actually only applying negative rates to clients with more than $2 million in francs. That's about 2.06 million US dollars. So, Adam, if you don't have that kind of money, you're not going to have to pay that charge. Now, why would a central bank do this? Well, in theory, it's to boost economic activity. So again, we'll use Adam. Adam is currently being penalized to park money at the bank. And if negative rates actually hold over to rates on loans, maybe that means the bank will pay 0.5% for a customer to take a loan out. So go out and spend, right? Go buy a house, go make a business investment, go buy that Studebaker Speedster in Hialeah Green that you've always wanted. And this is actually possible. So in Denmark, we've seen some negative interest rates on some mortgages. And again, this is the point of negative interest rates, to spur more lending to boost economic activity. So if banks and consumers are penalized for saving money, that should in theory boost growth in times where an economy may be faltering. But this raises a bunch of questions. So first of all, penalizing people for saving money may not directly lead to more spending. So people may opt to pull the hard cash out of the banks and just hold onto it, right? Why go out and spend? If you're being penalized for holding onto it, maybe just leave it under your mattress. Secondly, banks would not like this at all. So bank revenues are built on interest rates that are collected on loans, and then bank expenses include interest that's paid on deposits. That model gets turned upside down in negative interest rates, which could actually squeeze bank margins. And third, if there's a higher demand as a result of more lending, what will happen to home prices? What if everyone is then bidding for that Studebaker that Adam wanted because everyone is now being penalized for saving cash? That may drive the price of the car itself up. Adam's looking at the car right now. That's the Hialeah Green right there, by the way. Now, could it spill over into an asset bubble that pops in that case? What if all those car prices end up exploding? What about equity prices? Well, that's definitely a concern. But for right now, here in the United States, we are currently above negative. So we're under 2%. But again, this is the concern. We're not that far away. The problem is that the Fed has historically needed about 5% of interest rate drops. In the 90s, we saw it in the dot-com bubble, and then we also saw it in the great financial crisis. They needed that 5% of easing to actually handle a downturn. So does that mean that we're going to go negative? If we're at 1.5 to 1.75%, we don't have a lot of room. Now, the Fed has said it'll rely on quantitative easing and forward guidance first, but honestly, who really knows? So unfortunately, guys, it's not as easy as President Trump illustrated in that 17-second clip that we just played for you, but it's definitely something worth watching in the central banking space for the years to come.
Brian? Thank you very much, as always, for explaining that for us. Let's also talk about something that is sort of adjacent to what you're discussing, and that's credit scores and people's credit worthiness, because big changes could be coming to your credit score. The Fair Isaac Corporation's FICO score will begin rating customers differently now based on their debt levels and loan paybacks. Instead of relying on a snapshot of your financial behavior, the new score, which will be called the FICO Score 10, will look at your financial habits for the past 24 months and based on that history, decide if you're a risky borrower. But financial technology company LendUp is looking to take the spotlight off of that FICO score, the credit score. LendUp CEO Anu Schultes joins us now to discuss. Thank you so much for joining us.
Thank you for having me.
There are millions of people who don't necessarily have that credit history, even over the past 24 months, to present you with a reliable credit score. So when you guys are determining who you're going to lend money, what kinds of alternative measures can you use?
So our customers actually, new to credit are actually, typically our customer has a credit score and it's below 600. So our customers tend to band it on an average of 550. So in order for us to underwrite and figure out who to give a loan to and who not to, we actually use alternate credit sources. There are, companies that were independent of credit bureaus that gathered alternate data, whether it's, utility payments, how do they behave on other, not non-mainstream loans. But recently there's been consolidation in the industry. So for example, TransUnion bought Factor Trust, Equifax bought DataX. And so those are all data sources that we use and develop our own proprietary scoring model.
Well, I'm trying to, how does this work? What does it look like in the real world? Because I went to the webpage to LendUp, but there's also, is it Mission Lane, which I would think of as a credit card opportunity. How do people who might be unbanked or need these services, what does it look like for them?
Yeah, so Mission Lane is actually, LendUp was founded 7 years ago with the goal of really disrupting the payday lending industry. Our goal is, we're a mission-driven company. We are here to help people get on a path to better financial health. And so actually a year ago, we did spin off our credit card division, and that's the Mission Lane company. You see the tagline still on the website. It's, in the next 90 days or so, that's going to drop off. So LendUp has returned to its focus of focusing on small dollar loans. Since inception, we have given out $2 billion in loans at an average of $300 per loan. And so when a customer comes to us, it's because they don't have a credit card. They have a checking account but have no access to funds. And 84% of our customers actually report income volatility. So we're there as a backstop to help them, give them $200, $300 at a time. And then once they paid back, they can qualify for another loan.
You mentioned their income volatility, bad credit card scores that are below 600. That's something that makes a big bank run the other way. So how do you actually see opportunity, and what kind of credit card rates do you charge customers?
So LendUp no longer focuses on credit cards. That's the company that we spun off. We focus on what we call single payment loans and also small dollar installment loans. And the single payment loan is actually fee-based. So you borrow a fixed amount and it's a fixed fee, and you can pay it back within 7 to 30 days. And then we are here to help the customer. So if they call us and talk about their payment difficulty, we will work with them. And until they pay us back the original amount they borrowed plus the fee they committed to pay up front, they cannot qualify for another loan.
What's the main differentiator from payday loans?
And the default rate.
Right. So the main differentiator with payday loans is that we will not let them borrow again until they paid off the first one. We are very diligent about that. It's core to who we are. We do not allow account rollover because we're here to help them. Once they pay us back, they're welcome to come back and apply for a loan. So we truly are the backstop for the customer who has no place to go, and it's a trusted place, it's a safe place, and we have embedded financial education, so over time they should learn how to manage their money better. We over time help them improve their credit score. It takes time, but we are mission driven, and we fundamentally every single day focus on, if a customer comes to us, how can we make sure that the customer is better off because they came to us?
Default rate?
So default rate, I'm probably not allowed to spell out exactly what it is, but what I can tell you is after a customer has been with us, after they've taken 2 or 3 loans with us, a returning customer behaves, I say there's a little bit of a pause, almost like a regular mainstream customer, because our default rates after like the third loan is in the low single digits.
Okay.
All right, Anu Schultes, thank you for coming in, LendUp CEO. Appreciate it.
Thank you very much.
Coming up, coronavirus spreads across the globe, how Disney is taking extra precaution at its theme parks in China. Plus, before we go to break, take a quick look at some of the biggest winners in the Dow today. According to Wells Fargo, strength in the global economy will help push U.S. stocks even higher this year. The bank's global investing unit published a new note for investors forecasting the S&P 500 will reach the 3,500 mark before the end of 2020. Anybody want to take a shot at this? I mean, coronavirus could be a black swan event, or perhaps not.
I mean, it seems like a lot of analysts are still on the fence about how large the macro impact on the economy is going to be of the coronavirus. But I think largely speaking, if you look at the macro trends, right, it seems like things have gotten better, maybe only marginally, but gotten better on the U.S.-China trade front. The Fed not poised to move for this year. So if that's the case, then it should be things chugging along. It seemed like that was kind of the buzzword that a lot of the, those in Davos were using, that the economy is going to chug along next year. But if it continues to chug along, sure, maybe we'll see 3250.
Right. So, or 3520. 3520 is what they're talking about. They're also talking about PE expansion. Now, we've talked a lot about price to earnings multiples this year growing, maybe, some analysts are saying, at a slower rate. So the forecast now for year end from Wells Fargo is 19.6 trailing PE for the S&P 500. So that's definitely above the historical average, but they think we can get there.
Yeah, I think there's definitely plenty of reasons to be bullish. I mean, when you just look at the economy, look at what's happening. Also, President Trump believes that the stock market could reach even higher highs.
Well, of course he does, but he's not.
If it weren't for the Fed. So, yeah, but I think that the coronavirus, I don't think it's going to have that much of an impact on the global economy, only temporary, as long as China is able to contain it. And in terms of other factors, we talked about the global economic slowdown in 2019. I think that will continue, but I don't think it's going to have that much of an impact on our earnings.
And on the PE front, right, 19 is relatively high. I think the forward PE projections I had seen from Goldman Sachs was around 18. So
this is the trailing one.
Right. Okay, trailing one. So I mean, regardless, it seems like that would be actually be a step down from where we are right now at about 21. So I mean, it does raise questions though about the current valuation of the market. Some would say 19 is already high, right. 21 is even higher. So if you kind of see this as a frothy market and you continue to see things chugging along in 2020, who's to say that maybe we won't see some pressures build up in valuation. But I think largely speaking, no one's concerned that a bubble's going to pop in 2020. But I want to knock on wood before I go any further, because who knows what could happen in 2020. There are many black swans.
You've certainly had the pessimistic voices have gotten a lot quieter coming into 2020 than they were going into 2019.
Absolutely. Yeah.
I mean, I recall a lot of economists talking about much higher probability of recession going into 2019. So does that make you nervous or reassured? I don't know. All right, coming up, big bucks for Broadcom, how new deals with Apple could generate more than $15 billion in revenue for the company. Plus, it is day 4 of President Trump's impeachment trial. We'll have a live report from Capitol Hill straight ahead.
Okay, we're around 12 noon in New York City, 2.5 hours into the trading day. Stocks have fallen into negative territory again. We're keeping an eye on all of this for you. Also, oil has been trading down, and we are now, WTI is trading at $54.19 a barrel. China on lockdown as the death toll climbs. The country has isolated nearly 40 million people as it races to contain the spread of the deadly coronavirus. And the latest for you as the CDC now confirms a second case right here in the United States. Trump on trial, what you need to know as the 4th day of impeachment proceedings kick off on Capitol Hill. And teaming up, what Broadcom's massive deal with Apple could mean for other companies in the sector. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for being with us. Let's get to the floor of the New York Stock Exchange now. We've seen stocks kind of bouncing around a little bit, but from negative to positive today. Inez Ferre is looking at shares of Boeing as well. Inez?
Julie, Boeing reportedly is considering cutting its production of the 787 Dreamliner, trimming that down because of a sluggish demand. This is according to a Bloomberg report. So the executives at Boeing are reportedly considering perhaps cutting production by anywhere from 2 to 10 planes a month. And this would be the second trim of production of the 787 Dreamliner since October. Boeing stock right now is down about 0.7%. Meanwhile, if we take a look at another Dow component, Intel is the best component on the Dow today, the top performer on the Dow and the NASDAQ and also the S&P, despite the fact that the markets are right now in the red. Intel is seeing a pop after beating on the top and the bottom line for its latest quarter. Also, its full year revenue came in at a record high and gave some upbeat guidance for the current quarter and the full year. And then Amex, American Express, U.S. is the second best performer on the Dow today after a solid beat on the top and the bottom line for its latest quarter. Adam, Julie?
Inez, thank you. Our top story right now, the deadly virus emanating from China. The CDC confirms a second case right here in the U.S. The death toll has climbed to 26 overseas, with nearly 890 confirmed cases globally. Authorities in China are racing to lock down more cities in a bid to halt the spread of the deadly virus, and it's having a big impact on business. Disney has announced it is closing its mega theme park in China, and McDonald's also halted operations in several cities in China as well. Also, several drug makers are racing to develop vaccines that could protect against the virus. So let's bring this to our panel. Yahoo Finance's Brian Chung and Sabeel Marcellus. And when you consider the number of people now under quarantine in China, it's 40 million. It's equivalent to the population of California. Is that enough to control this?
I would hope so. I mean, China definitely needs to get this under control. The World Health Organization, they declined to call it a global health crisis right now, an emergency, but it's definitely something that China has to figure out how to squash, because at least 26 people have died so far. There are over 800 cases. In the U.S., there are 2 cases, but they're also monitoring 22 states with over 60 people who may potentially have been contaminated by this. So this has all the signs that this could actually become a pandemic. So hopefully China will clamp down. I'm glad that these pharmaceutical companies, these biotech companies, are actually coming up or trying to come up with some kind of vaccine as quickly as possible.
I mean, we have a flu vaccine, a regular old flu vaccine, and people still die from the flu. And that said, I think more people will die from the flu this year than have died from coronavirus thus far, right?
I mean, it's early, but I mean, if you look at the numbers, yes. But I think that what makes this concerning is that, you know, this is a new strain that we haven't seen before. That's why we're looking and hoping that the pharmaceutical companies or someone can come up with some sort of resolution, some sort of vaccine to address this case. It's not quite equatable to Ebola right now. I think that the concern, though,
is... It's not nearly as deadly.
No, it's not nearly as deadly, not nearly as quick. But I think just people are concerned, people are jittery because of the Ebola episode that we saw a few years ago. But I think it's sobering to remember that, Wuhan, which a lot of people did not realize was as big of a city as it is, it's a population of about 11 million in the metro area. I mean, closing the airports just in that city alone would be comparable to shutting down O'Hare in Chicago. So it's great, I guess, that China was able to clamp down on it relatively early enough. But I mean, there are still people going around. I mean, we have 2 cases in the United States, so a lot of questions.
We should point out, can we pull up the Disney chart if we've got it? Disney stock, because when we talk about the cases in the United States, the woman in Chicago, according to the CDC, had visited in December, came back January 13th. They're actually monitoring family that she was in contact with, and no one has exhibited symptoms. But take a look at what's happening to Disney stock. On the news that, it could be other things, but they're going to shut down it's the park in Shanghai.
Yeah, in Shanghai, yeah.
So is this just an immediate short-term reaction? When do we get the recovery, perhaps?
Well, I mean, I want to mention, too, that it's important to note that the Lunar New Year is actually this weekend in China. So a lot of businesses were actually going to be shut down anyway, likely. But it's actually quite sad for a lot of those families that were hoping to then travel to go meet other families. So there could have been definitely some business activity there as well. But I think just from a human interest standpoint, it's definitely a tragic thing that during this big holiday, it'd be like shutting down O'Hare during Christmas, for example. So, that could definitely be of concern on consumer sentiment, even in the medium term. So, yes, the businesses may have been shut down this weekend anyway, but who's to say that over the next few weeks, because we don't have a resolution yet, whether or not that'll spill over into consumer confidence.
Well, and I mean, to your point about Disney or some of these other companies affected, the longer it goes on, the more they're then under pressure to come out and disclose if it's going to be material.
Yeah, exactly.
This is going to cause a hit to revenue.
This is not when you expect China's censorship to actually be deployed when it comes to a potential global health crisis. So you hope that China is transparent and that they actually do inform the Western world or the rest of the world about what exactly is happening on the ground, and do they have a handle on it, and do they need help from other countries to kind of contain the whole situation. But when you put it in context, you're talking about the world's second largest economy, and we talk about the earnings reports, the CEOs, they're constantly talking about when they see growth, China. They definitely want to tap into Chinese consumers. They do not want them sitting at home, cooking at home. They want them outside in stores shopping.
Right.
So hopefully there can be some kind of resolution to this kind of situation.
Yeah. All right, let's talk about Broadcom now. That company announced it's entered into multi-year deals to supply Apple with wireless components used in its products. Those deals could generate $15 billion for Broadcom. The news, by the way, comes as Apple's set to report earnings results next week. Amazon is reporting next week as well. So a lot going on in the tech industry both today and going into the next week. Intel reported last night, so a lot of different things to juggle.
Intel had a crazy beat yesterday in basically every metric. I think it spelled out actually pretty well for the other chip makers as well. The story largely for 2019, at least for the first half, was a not so great story. You had all these chip makers that were just building up on inventory because there was really no catalyst amid the trade concerns for technology that could actually absorb the chips that they were producing. But I think what we've seen since then is because of, first of all, the trade easing because of the phase one trade deal, but then secondly, just because of all the new technology that seems like it's getting a little bit closer. You talk about 5G handsets, new units, at least for one chip maker, from the PS5 and from the new Xbox. So those are all kind of fundamental catalysts for why you might be a little bit more bullish on this.
So let me ask a personal question here. Do you even have, because some people no longer have a PC or a Mac at home other than a lapbook, and how old is it? Because a lot of this, at least for Intel, we talked in the 10 a.m. hour, was the replacement of devices that are now pretty old and need to be replaced.
Yeah, no, definitely have no Intel devices inside my home. I mean, I actually have a desktop, and it's Apple, and it's like their latest computer. So
because you have a new one, so you don't have to replace.
Yeah, exactly. I have the latest one. And I think that's how most people, consumers, view it this way. I mean, you definitely want the latest technology. We talked about Apple, its earnings coming out next week, and Bank of America is actually very bullish. They expect their revenue to be around $89 billion, which is like on the higher end of what they were expecting. And that's also because tons of people have been buying those iPhone 11s, the AirPods,
yeah.
Right, the AirPods. I mean, you see them everywhere. I mean, it's like the cool thing to have. And it's great because you can lose one and you can go back to the store and buy more. So that's even better for Apple. And also their, services, the App Store. I mean, it's the best marketplace right now, trusted to buy apps.
Our colleague Brian Sazi lost 4 pairs.
I could see how, because I've got the AirPods, they slip right out. There's no way to grip them. They got to go into that little thing. It's magnetized, but...
And you want to wear 2, because if you're wearing 1, people think, like, you lost it.
Or you're just trying to be really cool. Okay. Turning now to Washington, D.C., where Democrats are launching their third and final day of opening arguments that President Trump should be convicted and removed from office. Yahoo Finance's Jess Smith joins us from D.C. with the latest. Jess?
Well, House Democrats today will try to make the case that President Trump obstructed Congress during the impeachment investigation. Yesterday, they focused on the abuse of power charge. They tried to convince the Senate that the president abused his power by pressuring Ukraine to investigate his political rivals. So far, neither side seems moved. I want to show you a little bit of what senators on both sides of the aisle have had to say. First, you'll hear from Republican Senator Tim Scott and then Democratic Senator Mazie Hirono.
The good news is the Democrats have literally bought into that premise that if you just say it often enough, it must be true. And we've heard the same story, rinse it, recycle it, and repeat it.
Well, you know what? They spent all of Tuesday fighting back all of our efforts to present new evidence and new documents. So they're being totally hypocritical.
The president's defense team will take over tomorrow, and President Trump is not happy about that weekend start time. He called Saturday Death Valley in TV. After that, we'll move on to senators' questions and then the debate over witnesses. Democratic lawmakers want to hear from people like John Bolton and Mick Mulvaney, but Republicans could push back, saying they would want to hear from Hunter Biden and the whistleblower. As for today, Democrats' last chance to make their case against the president starts in just under an hour. Adam and Julie.
Thanks, Jess. Let's talk about this a little bit more with the panel as we look to get through this very speedy impeachment trial process. I mean, we kind of, the outcome's sort of a foregone conclusion here.
Yes, so we know what the outcome is, and Democrats at this point, they know that they're not going to be able to convince their Republican colleagues in the Senate to actually remove President Trump from office. They're really speaking to voters. They're trying to continue to make that case, explain to voters why President Trump should not be reelected in November. So today is the last day that Democrats have to make their case. On Saturday, tomorrow, you've got the Republicans who are going to start to make their case, and the battle for witnesses, it seems like Democrats kind of lost because what Republicans have come out and said, well, if you want witnesses, we want witnesses. And the last thing Democrats want is for, front runner Joe Biden to be on the witness stand.
Well, he's already said there'll be no deal. He would testify, that kind of thing. But at the end of the day, when the president talks about ratings, TV ratings, I mean, all of this is now in the historic record forevermore. But it's got the ratings of that movie Cats. And the president's,
it's
the
bombed.
president does like attention, but
Were
he
you a
makes a
fan of
case.
it,
I like the song, but this is, I mean, at the end of the day, this is said and done. Who is truly, other than people depending on your echo chamber, and us? I mean, a lot of Americans are not paying attention to this. Or where am I getting this wrong?
They very deliberately made it bad TV.
Yes, they
Right,
did.
but, and
That was
that's
part
exactly
of the
thing.
strategy.
I mean, even
But
the discussion about the timing of it, right? Having the Defense Council basically begin tomorrow. Some Democrats were hoping that it would actually be pushed off until the beginning of next week, when more people might be tuned in, because on a Saturday people are out living their lives, not sitting.
But when I ask that question, it's Democrats, Americans understand the issue. There was that poll that, they understand
get it.
70%, I think it is, want witnesses called, but it's not going to happen. So the next question becomes, so what's the repercussion of that? Clearly, the Republicans have said there will be no repercussion because that's where they're headed, right?
Well, repercussions, I guess, in what sense?
When you vote. When people go to vote, when American,
It's a wash.
It's an acknowledgement, it seems like, on both sides, that is the end game, is the implications for the 2020 election. Now, I think the effectiveness of this, it's a little too early to tell, right? I mean, we've only heard one side of the story so far televised. We don't know. Maybe the ratings end up being better for the Defense Council, right? I mean, again, it's too one-dimensional just to look at the ratings. I think in the sum of things, you have to be looking at what's going on the campaign trail as well. How are the Democrats meeting, using the rhetoric from what they've seen so far in the impeachment hearings to, basically stump for why people should be voting for them in 2020. So there's a lot of elements to this, but it just seems like people are not tuning. I don't think people are tuned into every hour of what we've seen in the past few days. It's naive to think so.
Coming up, why economic strength could cause a great unwind in safe havens like gold. Plus, before we go to break, take a quick look at some of the top trending tickers on Yahoo Finance. Stocks underwater now. This is On the Move. I am Jared Blickery. Dow is now down 144 points, or about 0.5%. S&P 500 down 0.7%. Here's the intraday price action. This is all coronavirus fears right now. You can see significantly under after it gapped up to about 33.33. Also, the Russell 2000 down 0.9%. NASDAQ underwater as well. So what's up? Guess what? The VIX, of course, because it's inversely correlated with stocks, about 14.5, and we're approaching a level that we're going to keep an eye on, right around 15. That's where it should hold if it's in place with the longer-term trend. 10-year T-note yield, that has sold off even more, or at least gone down even more. It's now down 5 basis points, and we're also going to take a look at the U.S. dollar index. That is up, took another leg higher on the latest scare regarding the coronavirus. Let's take a look at the Dow Jones heat map. We can see Apple is still in the green after hitting a record high earlier. That's up 0.5%. Microsoft down about 0.2%. Intel, the standout, now up 8.5%. Stocks still flying high. And we can take a look at the sectors that are doing well today. Not too many so far. Utilities, they are now in the lead, had been second. They switched place with tech, which is still above ground here. Healthcare is doing the worst, down 1.5%, followed by energy. We have crude oil at about a 12-week low,
And then financials. Let's take a look at some of the earnings stocks that are in play today. So there's Intel again, but we can also see AXP. That's up about 2.25% here. So American Express doing very well at a record high again. It's up 35% over the last year. And what are some of the stocks that are going to the downside? Well, Synchrony Financial, that's down about 10%, had been at close to a 2019, the highest in 52 weeks, up only 10% or 9% over the last year. We'll take a look at Skyworks Solutions because that is one chip stock that is not doing well. Coming off of record high, it is down about 6%, but still up about 75% over the last year. Stick around because we're going to be back in a minute.
Stocks are losing some steam here on news that the coronavirus is spreading into the United States. But if you take a step back, our next guest says investors are seeing less risk in the U.S. economy. That, in turn, could spark what he calls the Great Unwind. Joining us now is Michael Kelly, PineBridge Investments Global Head of Multi-Asset Investments. Good to see you.
Thanks, Julie.
So as we look at what we have seen over the past year, we have definitely seen some alleviation of recession fears. And we've started to see people pull back a little bit from so-called safe assets, right? Haven assets. But you say there's much more of that to come.
Oh, yeah. Last year was, the perfect storm. You had a global recession slowdown, PMIs, China throttling things down. You had the Fed, remember, normalizing and all the fallout from that slowing things down. And then the trade, ever-escalating trade. So you had a trifecta, and we're unwinding all of that. We had very severe within asset class rotation. This is the third mini slowdown we've had. In the first two, I think a lot of investors were burnt. There were these recession scenarios out there, sort of burnt twice. The third time, they stayed a little closer to home and sort of rotated to safety within asset class. And so we're only about a third of that unwind, and it was proceeding, in a typical choppy way. Now with coronavirus, it's taking a half step back, but we think that will be the order of the day for most of the year.
So let's pick up from there. I'm going to pull up gold, realizing that just today's headlines are probably part of why people, because gold is up right now. But let's pull up gold. I think it's like at 15, where are we at 1570. But as we pull it up, I wanted to ask you, what sectors could people get burned if they are ignoring what we're talking about? Is it real estate? Is it gold? We've had guests who've said expect gold to be over 1,600 an ounce by the end of the year. So what should we as investors be careful so we don't get burned?
Well, it's not a real environment where you get burned too badly, right? Because if there's any new norm, it's that central banks panic on the slightest sign of anything and just throw massive doses of money at things. So nobody gets burned in this environment. They
where
just
is the
underperform.
unwind happening, I guess?
It'll come out of the Treasury curve, not to today, but it'll move into other areas of fixed income. It'll come out of large cap U.S. growth stocks and move overseas and move into more cyclical markets. It'll come out of gold. It'll go into copper and oil, which are all down today. But these are the areas that we would expect still very, very early in the PMIs moving back up.
So we've heard concern that because of the extension of this economic expansion into the longest on record, that maybe this is actually allowing some asset valuations to be going past where they really should be valued. When you look at the equities market around 21 for a trailing PE, I mean, is that high, and would you expect that to go higher in this year? And if that were to be the case, does that raise any red flags for you?
Is it high? Yes. Is it surprising that it's high? Yes. Is it high? Does that mean it will come crashing down? Very unlikely. We're living in a world of dual liquidity gluts. One is a naturally formed, once a 70-year financial crisis in the wake of every financial crisis ever. You've had underconfidence for a decade. It's led to underspending, underinvestment. The money goes somewhere. It goes and creates a global savings glut. This is the first time ever, on top of that glut, we have a central bank QE glut. It's not too little demand in the world. It's too much supply of central banks panicking and buying up government bonds on the slightest whiff of anything. And so if you want to compare valuations in the midst of twin liquidity gluts with valuations when you haven't had any in the prior 50 years, yes, they look expensive. The question is, can that change quickly? And it really can change. Yes, people can spend more, invest more. That's called growth. That's not so scary. And the central banks looked like they were trying to normalize, didn't it, about a year ago? But then they've hoisted up the white flag. So we think we're just in a period of high valuations. And again, you don't get burnt. You underperform during this period. You don't go up as much.
And I just wanted to pivot to 2020 because I know that Buttigieg and Biden, for most investors, are viewed as neutral events for markets if they were to get elected, but not Warren and Sanders. And right now, Sanders and Biden are kind of leading the Democratic race. So what are you telling, or how do investors feel about Sanders surging here?
Well, I agree with you completely that Biden or Trump would both be viewed as a continuation of market-friendly policies, whereas Sanders or Warren would really be viewed as this is tremendous uncertainty. They both talk about taking on numerous industries. It's almost half the industries they're going to take on if elected. Now, while Sanders is surging somewhat in the national polls, if New York and California like him that much more than they did yesterday, does that mean anything for the Electoral College? And there, it's, Biden does show better than Sanders, and but it's, it's nip and tuck, Trump versus Biden at the bottom of a global PMI cycle, which is really roughing up the Midwest a little bit more than the rest of the country. So, I think the markets are pretty relaxed that, I think rightly so, from everything we know right now, that Biden still has the Democratic edge by quite a bit, because it's those swing states that he shows much stronger than Sanders.
Yeah, which fits with your overall view of the market. Michael Kelly of PineBridge, thank you so much for being here.
President Donald Trump inking the first phase of a trade deal with China, sending global markets higher to kick off the new year. Yahoo Finance's Julia LaRoche had a chance to sit down with a very special guest at the World Economic Forum in Davos, Switzerland, and discuss the next steps in U.S.-China trade negotiations.
Joining me is Orit Gadish, chairman of Bain & Company. Orit, thank you so much for joining us at the World Economic Forum.
Thank you for having me.
Well, there's a lot of discussion about the China trade negotiations. Is this the beginning of the end?
If you mean is it the beginning and the end of the negotiations and people sort of getting towards what they wanted, no, I think it's not even the end of the beginning. I think it's a small step towards getting what each country wants, and almost by definition, both countries can't have what they want. So there's going to be, I think, quite a lot of negotiations still to come. I think it will take quite a number of years, too. And there is something that's going on there which is beyond just the negotiations on trade. It's really beginning to be and becoming a negotiation for supremacy in certain technologies and on the world stage. And I think that people who think that they can become the single power at this point are probably not helping themselves or the world. I think the way to look at China for the United States is not how to challenge them or how to compete with them, but how to make sure that we have space for us, there's space for them, and there are actually places where we can cooperate, because otherwise I don't think it's going to be a very nice place for all of us.
Wow, I mean, that's pretty, striking stuff to hear. I have to imagine, because in your role, you talk to a lot of CEOs all around the world. Mm-hmm. This is probably top of mind for them, but what kind of conversations are you having with them? What are you hearing? What are they concerned about?
They're concerned about an awful lot of things these days. First, what's going on between China, the U.S., and Europe's place in the world is very important for CEOs, independent of where they are. The tension between the U.S. and China caused a lot of people to have to rethink their supply chain, to rethink markets, to think not only for now, but for the future we're going to be. It means also rethinking technologies in some cases to replace part of the supply chain. That's true for Chinese companies, true for American companies, and true for European companies. There's also a lot of discussion about where will the winning technologies end up being. And even here in the forum, we've heard a lot of people say, well, the United States and China have the winning platform technologies. So where is Europe's place in that, including Europeans? And I think that Europe actually has a very important role to play, because all those technologies are going to be running on 5G. That's going to be the infrastructure. And after that, 6G or whatever comes after that. And currently, China definitely has the capability to do that in a number of companies. South Korea does, and then Europe does. There is no company in the United States that can do it, for historical reasons about choices that were made when mobility started. So the surviving companies that today are actually engineering and selling 5G are in Europe and in China, basically, Korea. And if Europe has in Nokia and Ericsson a technology that is critical for what's going to happen to the way the technologies are going to move around, and to just about every commerce, every interaction that is going to happen in the near future. And if they don't make sure that those two companies, that Europe actually continues with that, and if America doesn't rise to the occasion, I don't know right now who will, then there's a chance that in the next round, when there's 6G, and the Chinese are already thinking about 6G, there will be nobody other than those companies to provide it to the rest of the world.
Could that mean that we're talking about trade, a trade war? Could we also be in a tech war?
We are. We are not in a war, I hope, but we're in a very great competition. President Xi announced several years ago where China wanted to be a global leader, not just Chinese leader, but a global leader in quite a number of technologies. That sort of woke up the rest of the world. Now, if you were traveling to China a lot, as I was for 15 years, you knew that this was coming. But that sort of got everybody to stand up. China has very legitimate reasons to want to compete. And by the way, it has great capabilities. China is not just stealing technology, as people say. China is developing an awful lot of technology. In the war of R&D, or in the R&D area, the West probably still has a leg up on R, but in D, the Chinese are way ahead of the rest of the world. So there is a legitimate sort of spot to talk about how do we compete as opposed to how to become superior. And that is a conflict or a competition maybe that hasn't quite played out. And I think people really need to think about the long term, not just the short term when they talk about trade.
And we're about to wrap up the World Economic Forum. You're part of the board of trustees here. And you've been coming for many, many years. What's kind of your sense right now? What are you kind of reading from this year's annual meeting?
Well, the biggest topic coming out of here really has to do with environmental change. And it is about time. And you hear it's not just the teenagers who are protesting, it's actually in meetings that are not on the agenda, where CEOs were meeting and chairmen were meeting. There have been papers that have been signed really talking about what needs to be done. And there's not that much question left, because if you look at the amount of money that is needed, we're talking about $8 trillion. Philanthropy is less than $1 billion. Foundations about $1.5 billion. The U.S. government budget is $4 billion. We need everybody to be part of this. Oh, we're not going to actually survive the 21st century, which is a panel I just moderated.
Yeah, I heard all about it. Well, Orit Gadish, chairman of Bain & Company, thank you so much for joining us.
Thank you.
Well, coming up, mental health goes digital, one service that gives you access to therapy from anywhere in the world. Plus, before we go to break, take a look at some of the most actively traded stocks by volume on Yahoo Finance Day. Intel, which is up following its earnings, is tops the list. About 12:30 here in New York City, about 3 hours into the trading day. Stocks are now lower across the board, and pretty decisively so after trading in a narrow, little changed range earlier in the session. Also, we've got the 10-year falling below 1.69%, and as Jared Blicker pointed out earlier, at about a 7-week low. The future of therapy. We'll talk to the co-founder of Talkspace about how her app is changing the way people get help. Super Bowl spike, why tickets to this year's big game could set a record. And no more secrets, why Las Vegas is ditching its famous "What happens here stays here" slogan. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Talkspace is a telebehavioral health care company that connects people directly with licensed credentialed therapists via text messaging, audio messaging, pictures, even video messages in a private text-based chat room. Roni Frank is co-founder, head of clinical services at Talkspace, and joins us now for this week's Women and Money segment brought to you by USAA. Thank you for being here.
Thank you for having me.
You're very open about how you and your husband came to the idea of creating this app because you were going through some issues, as every relationship goes through. Correct. And when did the spark say, hey, this is something that would work?
Okay, so it all started when my husband Oren and I experienced a crisis in our relationship. Our marriage was falling apart, and we decided to give it last chance in couple therapy, which literally saved our marriage. And therapy was so powerful for me. It helped me in so many ways, and it inspired me to leave my career as a software developer and go back to graduate school to study psychology. While studying, I learned that the mental health system in America is broken. If you want numbers, 2 out of 3 people who are diagnosed with a mental health issue have no access to care, which is a disgrace. We're talking about tens of millions of people with no access to care. And this is where Oren and I started to explore how technology, how a digital platform can remove those barriers to make mental health care accessible and affordable for all.
So some of the issue with accessibility is geographic or having access to it, which your platform goes away towards helping. Part of it is also financial, right? That some people just cannot afford therapy.
Correct.
So what is the cost of Talkspace? Is it covered by insurance? How does it work on that front?
So the cost of Talkspace is about $65 per week. It depends on the plan. So the most popular plan is messaging therapy, where you are messaging with a therapist 5 days a week, and the therapist is going to respond to you up to 3 times a day based on your needs, and that's $65 per week. You need to compare it with traditional therapy, where you pay around $100 to $300 for 50-minute session in the US, which of course a price point that most people cannot afford. You can also schedule live video session on the platform, and that would make the plan a little bit more expensive.
So you're messaging text messages that you're getting from your therapist to help you out throughout your day, because a lot of people blame what's happening online for causing mental health problems for people. So for example, if you're like going through Instagram and you're seeing all those pictures and you're feeling a little bit envious or anything like that,
exactly.
Does your therapist kind of intercept and possibly, send you like an inspirational message, even if, you're seeing a picture that's making you feel depressed about your own life?
So, it's a good point, because social media use is correlated with mental health issues. And we have a lot of clients that come to the platform because they suffer from anxiety and depression due to social media. And the therapists are helping them to moderate their social media use and to use it in a way that is healthier for them. And by the way, we also launched Talkspace for teens, because teens really affected by social media. I'm talking about 13 to 18. And the therapists really help them to manage their social media use and to use it in a way that is healthier for them.
I'm curious, can you share with us on a weekly basis or a monthly basis how many people are actually engaged with the app? And then the therapists themselves, they're licensed, they're social...
Licensed credentialed therapists.
Not, some people would think psychiatrists. That's not the case. These are people...
So we also launched psychiatry recently, and now we have also psychiatry, and we can prescribe medication on the platform. It was important for us because for some conditions, a combination of psychotherapy and medication is ideal, and so we wanted to offer all solutions on our platform.
How many people engaging on a monthly basis?
So far, we have served over 1.5 million people.
Wow. So it's a lot of, I find it fascinating, though, the idea of remote, you have telemedicine across disciplines, right? It's not just therapy right now. But how effective can it be on a texting basis versus sitting in real life opposite someone so they can see your visual cues? So
So it's a great question. Yeah. So as I said before, traditional therapy is not accessible for most people. 2 out of 3 people cannot access mental health care. Now, what happened is that in the last few years, there is a cultural shift in our society. Millennials are more open about their mental health struggles. We see more and more celebs coming out with their mental health issues. So what happens is that stigma has decreased and demand has increased, and millions of people were left without treatment. So digital health companies started looking for solutions to expand access to care. And that led to the rise of remote care solutions. And this space has grown massively in the last few years, as you said, including telemedicine solution, telepsychiatry solution, telebehavioral health solution, telepsychological solutions, etc.
And when you mentioned celebs, by the way, we've been showing footage of Michael Phelps because he has been very open about his mental health struggles.
And you have Lady Gaga.
And he's a spokesman for your company. Is he an investor in Talkspace?
He's a partner.
Gotcha. Great.
All right. Roni Frank is the co-founder and head of clinical services at Talkspace. Thank you for being here on The Move.
Thank you so much for having me.
Thanks. Coming up, why a satellite owned by DirecTV is in danger of exploding in outer space.
Whoa.
Plus, kicking off the big game, why fans should expect record-breaking ticket prices for this year's Super Bowl.
Let's take a look at the top trending stories on Yahoo Finance right now. TV service DirecTV has 1 month to remove a satellite out of geostationary orbit. The 15-year-old Spaceway 1 satellite is at risk of exploding after the batteries experienced thermal damage back in December. Boeing built the satellite. They helped build it. It was designed to last just 12 years. Again, it is 15 years old. The flight shaming movement is coming to the United States, according to JetBlue CEO Robin Hayes. It began last year in Europe when climate change activists urged travelers should opt for alternative forms of transportation other than air travel. JetBlue says it is already taking action to mitigate greenhouse gas emissions from its aircraft and plans to become the first carbon-neutral carrier in the United States. Racing legend Rick Hendrick paid $3 million for a car he won't ever drive. Hendrick bought the first mid-engine 2020 Corvette Stingray at the Barrett-Jackson Scottsdale auction. Hendrick told the press he hoped the price of the car would not get out of his price range during the auction. Today, Hendrick owns 94 auto dealerships, 15 of which are Chevrolet, and he's got this grand museum. He owns a couple of first edition Corvettes, 56, 57, 55.
Well, why is he never going to drive it?
Oh, because it's a work of art.
Oh, come on. All right. Fans of the Kansas City Chiefs and San Francisco 49ers are expected to spend a record-breaking amount to score a ticket to this year's Super Bowl. Yahoo Finance's Dan Roberts has the details in this week's Business Blitz. Dan?
All right, Julie, thanks so much. It is The Blitz. I'm here with the CEO of ticketing site TickPick, Brett Goldberg. Brett, thanks for being here.
Thanks for having me.
So we know the matchup, Chiefs-Niners. A lot of people are happy. I'm not that happy about it. I wish it were the Patriots. But fine, I understand why it's good for the league, especially this is the NFL's 100th season. You've got fresh blood, two exciting quarterbacks, Garoppolo and Mahomes. How good of a matchup is this in terms of ticket prices?
From a ticket price perspective, it's the most expensive we've ever seen. So even before the teams were announced, it was the highest average, it was the highest get-in price. And typically what we see once the teams get announced, a lot of sales happen and then prices start to decrease. This time, we've not seen any decrease yet, so it's historical highs right now.
Yeah, we have a chart that you guys sent us that we can pull up here, seeing that the prices right now are the highest they've been at this point, but this point being a little over a week before the game. And I know that over the years, when we've talked, you always tell me that it's sort of about how much risk you're willing to take. Like, if you want to go to this game right now, if you're willing to take the kind of scary risk of buying your plane ticket, buying your hotel, but not buying your ticket to the game, am I right in remembering the tickets usually get very affordable like the day before or even the day of? But how risky is that to play that game?
So every year changes. It used to be a very clear trend that prices came down as the game approached, and sometimes the day of game would be the best. Last year, I think because the Pats fan base who knows this kind of trend, everyone started buying late Saturday, and Sunday morning prices actually popped and increased. So the trend is kind of broken now, but the trend of still going to the Super Bowl location with your hotel booked, airfare, and no ticket is here to stay. Last year we saw about 20 to 25% of our sales happen day of.
Wow. And talk to me a little bit about the behind-the-scenes backroom dealings, because I know that it can get very complicated with you guys. I know you go and you set up, you're on the ground there, but there are all these people buying day of. They mostly have to pick it up in person. I know that there's the rise of mobile tickets and everything, but for something like the Super Bowl, people want their ticket in person so that they know it's real, but also there's sort of the commemorative collector's aspect. Just remind viewers how that process works, because it's kind of fascinating and wonky.
Yeah, there's a lot moving around. So Miami is a unique city where the stadium is not quite near the downtown. So unlike Atlanta, we had one location for 4 days. Everyone's picking up the tickets in the same spot. We have a location Thursday through Saturday that's in the downtown near the NFL kind of center. And then game day, we go up to the stadium, and then we have a location where we've rented out the closest commercial location to the stadium. So there's pretty clear instructions that customers will get, depending when you buy the tickets and when you want to pick them will dictate where you have to pick them up. So there's a lot, whether you're buying them on TickPick or somewhere else, you've got to really know what you're doing. So if you buy them on Friday, you'll be able to pick them up on Saturday and it'll be smooth and easy. If you're waiting until game day, there's a lot of moving pieces there.
It's like, how late do you want to push it?
Yeah.
We showed that chart I love that shows where prices are right now. And obviously, when you look at this chart, the 2015 line just stands out like a sore thumb. Can you remind us what happened in 2015? Why was that such an anomaly year with prices?
That was the Seahawks-Pats game, and the demand side was stronger than ever. So for the Seattle Seahawks fans, they were able to drive to that game. It was so close. The way I was told is the way Florida is for New Yorkers, Arizona is for Seattle. And so people drove there. They had a family to stay with. Prices also were at relative, I don't want to say historic lows, but incredibly low prices get in. So many people were able to buy in advance. So the buying was there, and then ultimately the supply was no longer there, and prices ended up kind of popping up.
That was the one Super Bowl I went to. Good result with the Malcolm Butler interception in the end zone. Let me ask you this. What do you think is going to happen for this year right before the game? I mean, if there are people watching this who are tempted to go, thinking about going, they haven't committed yet, what strategies do you suggest?
I personally probably would not wait till the last day. Counter to what most people in my office, I think the last day will be the best price this year. I think because of how hard it is to get to the stadium, there's just not going to be that kind of same surge that we had last year. I think Saturday you'll end up seeing a spike because that pressure will be there. So I believe there'll be a lot of inventory that will come on the market in the next 4 days, give or take. So I think Tuesday, Wednesday, Thursday will be that sweet spot to buy. Pricing will come down because of the influx of inventory. I think then you'll have a ride pop back up from kind of that demand and everyone kind of there on site buying. And I think Friday, Saturday will start kind of getting scary. And then Sunday morning, people, at that point, it's like, hey, am I going to start going towards the stadium and deciding if I'm going to buy or not buy?
Right. All right. Well, wild record prices. We'll see how long it holds. Brett, thanks so much.
Thanks for having me.
Julie, Adam, back to you guys.
Dan, thank you. The private space race heats up from SpaceX to Blue Origin. Billionaires are fueling a new era of exploration. Yahoo Finance editor-in-chief Andy Serwer sat down with Transportation Secretary Elaine Chao to discuss the role the U.S. government plays in the next frontier.
6 years ago, America was not very much in the lead at all. But because of the advent of American technology and innovation and the invention of the reusable rocket, America has now zoomed to #1. So we're we should all take great pride in that. And the number of launches are increasing every year. So we've had about 32, 34 this year, and next year there's going to be about 44, 45. And as these commercial space vehicles go into space and they become more frequent, we at the FAA, at the U.S. Department of Transportation, have to think about how do we integrate and facilitate these launches. So one example, it's still that if a launch goes up, a certain perimeter of airspace has to be emptied. So this is very disruptive. And if indeed there's going to be more frequent launches, what does that mean for operation of the national airspace? So that's a big question. And second of all, we're also licensing spaceports. So there are over a dozen spaceports now throughout the country, and more states are interested. And then thirdly, the FAA is actually in the business, in the responsibility is a better word, of licensing these launches. And as they, again, become more frequent, how can we facilitate these launches, not make the government such a barrier, but still protect, safety and security of these launches? So these are some pretty weighty questions, but I think they speak to the tremendous potential of transportation technology and the benefits that they can bring to our world, to our society, and of course to our country as well.
Coming up, what happens in Vegas stays in Vegas, right? Well, the City of Sin is changing its legendary motto. Uh-oh, secret's out. Plus, fallout from baseball's cheating scandal. Gamblers are suing the MLB for unfair practices. Buzzer beat around, 3 stories, 1 minute each, and we start with this. What happens in Vegas is not staying in Vegas much longer. 17 years after Sin City's famous tourism sign campaign launched, Vegas city officials are reportedly planning to update their famous motto. And the sign goes back to the 50s, but the motto started, about 17, 18 years ago?
But have you seen the reports about what the new motto is going to be?
No, what is it going to be?
What happens here only happens here.
Yeah, that's not.
Which is completely ridiculous.
No, they do that in Long Island City. I mean, it's like, no.
Like there's nothing that New York does not offer that Vegas offers. So I'd love for them to come up with a list within their marketing campaign. They're going to announce it during the Grammys on Sunday and tell us exactly what can only happen in Vegas and not happen in New York.
I don't know why they can't just make it like Vegas, baby, right?
That's a great, Vegas, baby. Yeah, that would work.
When I'm in Atlantic City, I shout that. I go, Vegas, baby, even though it's
Atlantic
and
City.
wish for yourself to be magically transported to Vegas
yeah,
from
New Jersey,
Atlantic
Jersey
City.
boy.
I think but it's
work.
a great tagline that what happens here stays here. It's kind of like Virginia's for lovers.
Well, but they want it to be more family friendly. I think that's
Vegas family friendly.
Yeah, Vegas, Sin City.
That is what they want, though. Okay, on Thursday, a DraftKings user filed a lawsuit against the MLB and Major League Baseball and 2 of its American Major League Baseball teams. The fantasy sports player accused the MLB of creating an unfair gambling platform. It has to do with the Astros, right? And this sign stealing scandal that's been happening. And this user basically says the MLB knew about it. And the teams knew about it and didn't do enough, and so rigged the games effectively.
Yeah, something about like the statistics for players were rigged. So, I mean, we're talking about online gambling, isn't it?
Yeah, well, I mean,
the expectation
but this is a
that it could possibly
fascinating.
be
This is
rigged?
a fascinating derivative of the huge scandal. Is all the people that put money. So if the Astros were cheating, then presumably that means that a lot of people lost money when they shouldn't have.
Except there's probably something on the sites where you're making the bets that indemnifies.
And here's the problem: is that there's no counterfactual to tell you whether or not the Astros would have won or lost the game.
Right, but isn't online gambling kind of like when you go into casinos where you kind of expect the house to win and you expect that you're going to probably lose money? You're not going to come out ahead?
Vegas, baby.
With sports betting, it's a little bit more neutral.
On your mark, get set, go! World Athletics is set to announce its findings of advanced technological track shoes, and it's expected to tighten regulations for athletes that use Nike's Vaporfly shoes. Okay,
Right, this is
you're
according to Reuters, by the way.
These are not the Vaporflies, but the technology within these is really interesting. I love sneakers and I love running. These shoes have a carbon plate inside that almost acts like a spring. So, I mean, it is kind of like cheating, but it's
why
hard
couldn't every athlete who's
Have the
competing
same shoes.
have
That's the
these
thing.
shoes?
Like, don't punish innovation. If Nike came out with a sneaker that helps you go faster, then they should be rewarded
Can
for
we
it.
just
And
go back to the
Adidas and
original-
others should
how
try to
about-
do something better.
If you're really going to, human physical achievement, why not do it barefoot? Didn't the ancients? They did it barefoot. I'm not kidding.
Well,
That's right.
it's physically brutal. Yeah, but you're right. If the technology is
can't win
available
with
to
barefoot.
everyone, it would
Someone
be
would,
even.
if everyone's barefoot.
It would be an even field if everyone just adopted technology. But Nike's not the only player in this
Like
space.
the
A lot
all-drug
of other
Olympics, right?
brands are probably saying we don't like that Nike's coming up with this technology, which is why maybe
it would then
I'm not
disadvantage
creating a
Nike.
conspiracy.
You're not
but
supposed to like it. You're supposed to beat them at the game. So come up with a better sneaker. That's what the others should do.
someone should race me in them.
I don't ever want to cross you.
Julie, challenge?
No, definitely not.
That's a yes.
And by the way, they do have barefoot running races. They exist.
That's brutal, though.
But just not in the Olympics or
Yet.
Yeah. All right. And
Synchronized
yes,
swimming.
the original marathon runs
That's
were, I
pretty cool.
believe, barefoot. Okay.
They didn't have the
Seville,
Vaporflies.
thank you very much. Brian Chung, challenge not accepted. Let's take a last look at the market, shall we? Because we are seeing now a downdraft as we have had some more cases reported in the U.S., confirmed cases of coronavirus, and yet more being investigated. Even here in New York City, there are inquiries being made.
Of course. But Wi-Fi PM is going to take you through the next hour of trading as we sign off by saying, Vegas, baby.
Vegas, baby!
p.m. in New York City, and the major indices are retreating to wrap up the week with the Dow in the red by triple digits. On tap for today, a second confirmed U.S. case of the deadly coronavirus out of China, raising the public alert level as China puts more cities on lockdown. A Harvard Med School infectious diseases professor joins us to rate how quickly the virus is spreading. Plus, earnings season rolling on with Intel and American Express both delivering big earnings beats. We'll have how the overall market is pacing thus far with Q4 results. And Richard Branson's space company surging 170% in just 2 months. Secretary of Transportation Elaine Chao telling Yahoo Finance the U.S. is making great strides in commercial space travel. Her interview coming up on the show. All that and more. This is Wi-Fi PM. Good afternoon, everybody. Happy Friday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Emily McCormick, along with the corporate agent, CEO, and founder, Angelique Ruers, back with us in studio. Good to see you again. Happy Friday.
Happy Friday.
Emily, happy Friday to you as well. Per usual, we will check the market action off the top of the show, and we're seeing red across the board. The Dow retreating a bit in the afternoon trade, off 130 points. The S&P and the NASDAQ in the red as well. You could see the S&P off by the widest margins, about 0.2% right now. But first, the Centers for Disease Control and Prevention is confirming a second case of the deadly China virus in the U.S. A woman in her 60s is hospitalized in Chicago after returning home from a trip to Wuhan, China on January 13th. This follows the first domestic case from a man who was in his 30s after coming back sick, heading back to Washington State. And in China, the government is restricting travel effectively, penning in about 40 million people as officials try to stop the virus from spreading. That's basically the equivalent of the entire population in California. So joining us now to discuss is Dr. Daniel Kuritzkis. He is the chief of the Division of Infectious Diseases at Brigham and Women's Hospital in Boston and a Harvard Medical School professor as well. Dr. Kuritzkis, just want to get your thoughts right now on the way that this virus is being managed when we're seeing cities upon cities in China on lockdown. What's your take on the way that this virus has spread so far?
Well, I think we have to keep all of this in perspective. I mean, the big issue here is that this is a new virus, so there's a lot that we don't know about it, and it obviously is spreading. But in the United States, since the beginning of flu season, there have been 12,000 documented cases of influenza, and that's only the ones that have been reported to the CDC. There are probably 10 times that number that have actually occurred around the country. So now we're looking at 800 cases of a coronavirus infection and about 18 or 20 deaths, which is about a 2% mortality rate, which is obviously a terrible thing. But this is not SARS. This is not the Middle Eastern Respiratory Syndrome virus, which causes a 40% mortality rate. So I think everybody has to take a deep breath and just realize we're always going to see new viruses coming out, and we need to take this one step at a time.
Yeah, no, it's a good point. The 2% mortality rate so far versus 34, as you're saying, plus SARS at 10. When you look at it, though, I mean, what about the speed in which this is traveling? Is that something to cause concern over rather than the mortality rate? Is that something that you look at differently in terms of the response? Because the World Health Organization did not issue a public emergency over this yesterday, though some people were wondering why they wouldn't have taken that step as we continue to see new cases now here, too, in the U.S.
I think they wisely made that decision. And I would say, again, it's 800 cases, but in a population of 30 or 40 million in the cities involved. So what kind of incidence rate is that? Certainly, the virus can be spread from person to person. It appears, and again, we only have limited information, that the spread is mostly among close contacts. So household members caring for a sick relative. There was apparently some spread among healthcare workers, which would really indicate a breakdown in infection control procedures where people were not taking appropriate precautions to protect themselves as healthcare workers from acquiring infection from patients they might be seeing. But it's not like we're seeing tens of thousands of cases appearing. I think most of the concern is because it's new and because there have been some deaths.
Dr. Kiritskis, do you think American citizens should be taking precautionary measures at this point because of the outbreak that we've seen in China? I know the NIH has not said it's going to be issuing any travel bans or anything like that, but do you think that there are precautions that should be taken at this point?
I don't think that the typical American needs to do anything different than what they're already doing. They should remember that we're in the middle of flu season. Everybody should make sure to get a flu vaccine to protect themselves against influenza. And then if you're in contact with people who have respiratory disease, you should be careful about touching your eyes and nose and mouth, and you should wash your hands after you've been in contact with them and before you eat. And that will go a long way to protect you against other kinds of respiratory viruses. But to be concerned that there might be an occasional person who shows up in the United States who might have coronavirus, I don't think that there's anything for people to be worried about here in the U.S. right now.
Yeah, the measured response you're giving us right now is very different than what we're seeing play out in China when we talk about cities on lockdown. Temperature scanners being placed into buildings, especially in Macau, where there are a lot of gamblers in casinos. But when we're talking about the populations in these cities, I mean, Wuhan greatly outnumbers cities like New York City and London. Right. When we just look at the sheer amount of people in these concentrated areas. Is that why you think we're seeing China issue some of these measures? Because it does appear that the case on the ground there, based off these measures, is pretty drastic. So why do you think they're taking those steps and steps that we did not see with the SARS outbreak in 2002?
I think it is a somewhat different situation in China, particularly in Wuhan, where the epidemic began, and also because it's now the start of Chinese New Year's, which begins this evening, and they were expecting, tens of millions of people to be traveling back and forth and potentially aggregating in very large crowds, I also think that at least part of the response now is in order to be more proactive than was the case when the SARS epidemic hit in 2002, 2013. It's hard to comment from here on what is and isn't appropriate to be doing in China. I do think that there are consequences of this kind of lockdown. How do you ensure that medical supplies and food and everything else get into the city that need to get there? How do you make sure that people aren't trickling out? Mm-hmm. I just flew back from Bangkok on Saturday and transited through Hong Kong, and they were checking temperatures there as they typically do since the SARS epidemic.
Yeah. Well, glad you weren't running a fever and able to make it back to work normally. But thank you for giving us the update there, Doctor. Appreciate it. Dr. Daniel Kiritskis joining us this morning. Appreciate it. McDonald's, though, as we're talking about food and getting things into these cities on lockdown, McDonald's is also temporarily shutting its doors to some of its restaurants in China. Yahoo Finance's Heidi Chung joins us now with the details on that front. Heidi, interesting move. I mean, it's not necessarily tied to the health risks per se, but also just the logistical problems of actually getting products in there.
Right, that as well as protecting the employees of those stores, right? That's a very key concern for a lot of these companies. I reached out to McDonald's Asia and I had a spokesperson respond to me, even despite the fact that it is the Lunar New Year holiday over there, so everybody is not working. But they did respond to me in a statement saying, quote, "Since January 24th, we have suspended our business temporarily in Wuhan and its surrounding cities where local public transportation system is suspended. Staff and customer safety is our first priority, and we have comprehensive precautionary measures being implemented to all restaurant operations and office staff. So, of course, these companies taking very early steps to make sure that their employees are not at risk here. But I do want to mention, when we're looking at the business that McDonald's has in China, at the end of 2018, McDonald's had 3,000 stores in China. Now, compared to the US, that was 13,000 stores. So that just puts things into perspective. This is 5 cities within that region, so it's not all of China. It's a very small percentage, and a lot of people are drawing comparisons with SARS, right? That was in 2002 and 2003. Now things really heated up in terms of this region with SARS in March, and things started to subside in July. So I went back, poured through some earnings conference calls to see what management had to say at the time, and back in July of 2003, during the Q2 2003 earnings conference call, McDonald's management actually said that a lot of their Pacific Asia comp sales were impacted, but they saw a bounce back fairly quickly. So right now, the situation that we do have with coronavirus isn't quite as severe yet as SARS. So I think that investors should sort of wait and see what we hear from several different places like the CDC and the World Health Organization before they make any moves here in terms of investments.
Did McDonald's, in its communications so far, give any indication of whether this would have an impact similar to how you just laid out on the top and bottom line in the current quarter, or is this something where it's just too early to tell, it's too small in the grand scheme of things given McDonald's international operations?
Right, so they made no comment on how this would impact them financially, but we do have McDonald's reporting earnings come Wednesday, January 29th before the market open, and I'm sure analysts are going to be asking a ton of questions to see what the latest is in terms of financial impact. But as of now, no news on that. I do also want to point out Yum China. Now, that is the largest restaurant company in China, so that's another company that's seeing their stock decline significantly today. But if we recall back in 2003, when the SARS situation was ongoing, the company actually saw, this was before Yum China spun off of Yum Brands. So Yum Brands saw their sales decline by 20 to 30% in just 3 weeks, but that rebounded again very quickly. So one thing I do want you guys to all keep in mind is while people are a little hesitant to dine in at specific restaurants, that actually gives a boost to delivery.
Yeah.
So that might offset some of the losses that the company does see in terms of sales.
And still, I mean, when we're talking about McDonald's, 20% of your stores in China is still sizable enough to impact all of this, especially if you have temperature screening devices in place as well. Not exactly something that makes you very hungry, I don't think. Thinking about the space around there. But Heidi Chung, thank you so much for breaking that down. Appreciate it. All right, well, Inovio and Novavax are soaring this week as we continue to watch investors react to the coronavirus situation unfolding. And the drug makers announced plans to work on creating vaccines for the coronavirus. And Novavax president of research and development told Yahoo Finance yesterday that there's a big difference in which vaccine companies ultimately invest in. Take a listen.
The other vaccines, the sort of traditional vaccines, really have a market. So companies are incentivized to invest in it because at the end of the day, there'll be a return on investment. The emerging disease vaccines to date have not had any return on investments for the companies that have worked on it. And so that may be changing.
So guys, I mean, when we talk about the timeline too for some of these things, it's not instantaneous. So you're kind of dealing with a need for things right now, but it takes a lot of time for these vaccines and treatments to get FDA approval.
Exactly. And I think the other thing to kind of keep in mind is what the pricing on these eventual vaccines could actually be. I mean, because you don't want to be a company that's charging these exorbitant prices for vaccines that could be life-saving, that would come under a huge amount of scrutiny, a huge crackdown on that. So just the entire logistics of this process is going to be really interesting, I think, to see play out.
Well, we see sometimes with these viruses that by the time they have really sort of peaked, that's when the vaccine is available. But then you're in a situation where they've put all this money into research and development, and so it's a losing proposition for them. But obviously we need vaccines to deal with this, and we don't know what's going to happen. There is some conversation about the fact that if it were to get to the United States, it would be right around the time that we're heading into spring and summer, which would also help to offset the impact here, which is a positive for us.
Yeah, I mean, also, it's hard to kind of correlate metaphors, too. Just we were struggling with this when we were talking about the size of some of these cities in China as well. We don't have any cities that big. And then the Lunar New Year as well, when we talk about travel here in the U.S., it's just a very different situation over there. And I think that's partially behind the reasons why we're seeing such a different reaction in the way this is being handled to what we're used to seeing things handled here on the ground here. But nonetheless, more cases both in China and the U.S., but we'll continue to follow those as they develop. Coming up, though, Intel reaching a 2-decade high after a big earnings beat. We're breaking down the results next. Plus, New York becoming the latest city in the country to turn its back on cashless stores. Why more towns just can't quit cash, right after this. Welcome back. Shares of Intel are hitting a 2-decade high after the semiconductor maker reported strong fourth quarter results. The stock, as you can see there, is up nearly 9% today. The chip maker posted adjusted earnings per share of $1.52 on revenue of $20.2 billion. And guys, Intel got a boost due in part to the demand for the chips used in data centers and cloud computing. Emily, I mean, this is a big turnaround from what we've seen out of Intel lately. We knew that they had struggles to actually meet the demand for the chips that their customers were requesting, but it seems like the CEO is pretty confident that's behind it now.
Right. We have to remember that Intel has an 80% market share over the PC processing unit market. So really a huge dominant position there. So seeing that turnaround here, seeing that revenue in that segment had grown 2% to $10 billion. Yes, that is only marginal gains, but when that guidance was for flat to negative growth, that really is being seen as a positive. And again, it's being driven by these big tech companies, by Facebook, Google, even Amazon, which is trying to develop its own chips as well. But for now, still relying on Intel for these processing units.
Well, and they've made a big point in their announcement this quarter that they have started to figure out the cyclical nature of the way that the cloud community is buying the processors, that it's really in waves, that they're buying and then consuming and then buying again. And so that's going to be a big thing. But they also talked a lot about the fact that it wasn't just growth in one area. They want the market to really know it's across all sectors of their business. And I think that's really important.
Yeah, the strange thing is that we heard Bob Swan talk about insatiable demand for data and that kind of fueling things here. You'd have thought if there was such strong demand, you would have seen other chip makers, I think, boosted in kind off these results, but that wasn't necessarily entirely the case. So
right, and again, I think a lot of it speaks to just the dominance of Intel's chips, sort of being that incumbent component in so many of these companies. So it's something that they've just come to rely on. It's very difficult, as we've seen with a number of companies, to actually shift away from a supplier that you already have a history of using, that you already know your technology will align with, and I think that is something that Intel has really created a moat around for the company.
Yeah, especially when we're dealing with all these things. We've even seen it in the cloud space, too, when we're talking about it's hard to kind of integrate all your products across all the different entities you might be working on. But nonetheless, Intel, a huge surge higher today off those earnings. Continuing to talk about earnings, though, American Express is popping as well today after beating the street's earnings and revenue expectations. The credit card giant posted adjusted earnings per share of $2.03 on revenue of $11.37 billion. Card fee revenues also grew more than expected. That was a big bright spot for what we call Amex, Emily.
Right. It really was this perfect combination of costing lower than expected and then the fees that they were actually getting from the cards coming in higher than expected. So, I mean, especially on the cost side, if we think about that flagship green card for Amex, something that they've really been ramping up the rewards for, but at the same time, those costs were just up 8% to $2.72 billion. That was expected to come in at $2.76 billion. So coming in below what the street had expected and keeping margins strong.
I mean, 70% of their new cardholders are in that fee bracket of type of card. Unlike a lot of the card providers out there, they seem to have cracked the code on the types of rewards that people are willing to pay for and then keep paying for year after year, which is huge for them.
Yeah, I mean, we highlighted that, I think it was last week, talking about all the card benefits here, and we've been seeing that. I mean, you get them to sign up for this card. It's free for the first year, and then you get them in year 2, year 3. So maybe they just didn't expect that much when we were looking at card fees. Again, the beat on that front. But it does seem to be one of those things that all credit card companies are continually competing over is figuring out exactly that, Angelique, as you say. What rewards will people care about? And American Express seems to have that figured out.
No, definitely. And if we think about a company on the other end of the spectrum that didn't do so well, Discover Financial, they're saying that they're going to actually have to ramp up their investment, the amount of rewards that they're doing in order to stay competitive. And we're seeing the stock just getting punished because of that. So you're really getting two sides of the coins here with the credit card company earnings that we've gotten.
Yes, a very, very competitive space. Not for the faint of heart, shall we say. I'm curious, do you say Amex or Amex? This is what
I say Amex.
See, it's an East Coast, West Coast thing. All right, well, New York City lawmakers are cracking down on the cashless trend. The city council voted in favor of a bill that requires all stores to accept cash in addition to any electronic-based methods. New Jersey, Philadelphia, and San Francisco all approved similar legislation last year. Guys, I think a lot of the reason behind some of these votes is because the unbanked, mainly minorities and those without financial means necessary to sign up for some of these credit cards, you still want them to have access to the same amount of stores and amenities that other people do.
Right, and I think that's a fair argument to be made because there is a sizable percentage of the population, particularly in big metropolitan areas like New York, that are unbanked or underbanked. You need to still be able to provide an option for this. Of course, credit card companies want to move in the cashless direction because they get a cut of those fees from the merchants themselves. But it's in order to be inclusive, you do have to provide some sort of cash option.
What about the flip side to that, too, though? Because, you know, it is obviously the trend. The trend is moving in digital transactions. It's easier, it's quicker, and you have a lot of merchants who say that's what we want.
Well, I took a look at what some people were saying on Twitter about this. What was the reaction here in New York? And a lot of people are really happy that they have the choice. The other thing people brought up was privacy, that this idea that everything we do when we use technology is tracked. When we use analog, old-fashioned money.
Yeah.
We can't, people aren't tracking exactly what we're buying. And so people who care about that came up. But every time we move forward in technology, we're leaving a part of the population behind.
Yeah.
And there's going to come a reckoning for that of what are we going to do between the haves and have-nots when it comes to technology.
It is, it is pretty shocking, at least to me, that cash still makes up nearly a third of U.S. purchases and transactions when you consider how far it's been since we actually invented the idea of cash, and yet still it's a third of everything here. I want to play a little bit of the sound that we got, though, from a Philadelphia city councilman that introduced the idea in Philly that kind of sparked all of this that we're seeing in other cities now. William Greenlee joined us on the show back in March. Here's what he had to say on why he fought for the ban on cashless stores.
It particularly bothered me and concerned me because a lot of the people that fall into that what's called unbanked category were lower-income people, minority, immigrants, and it just seemed to be creating a kind of an us and them kind of atmosphere.
Nobody really wants an us and them atmosphere in a big city like New York, like Philly, like San Francisco. But I wonder if the solution here might just be a government-provided digital transaction card.
Well, I mean, looking at an example of sort of a happy medium, I know Mercedes-Benz Stadium last year had actually gotten rid of cash transactions at the actual merchants, but they set up these stations where you could put cash into these machines and get a prepaid card that you could then use for transactions. I mean, that, would be expensive for the companies to have to implement, but something like that could potentially be a medium between these two extremes.
Yeah, a win-win perhaps. But yes, another interesting development, just because we've seen so many cities try and come to the forefront of technology and payments, and yet so many Americans still sticking with cash, maybe because they don't want everyone watching what they're buying. But just after the break, former New York City Mayor Mike Bloomberg surging ahead in a new poll, why it shows his spend-at-all-cost strategy might be working, plus what 4 years of Trump would look like for the economy, 4 more years of Trump, why one firm says it'd be a big boost when Wi-Fi PM returns. Welcome back. We are checking the market action here with the red across the board. You can see the Dow off by about 150 points, the S&P and the NASDAQ joining in that move as well. The S&P off by 0.75% right now. Well, a new report finds if President Trump wins a second term, the overall impact would be positive for the domestic economy. And joining us now with the details is Yahoo Finance's Kristen Myers. And Kristen, what can you tell us here? I mean, that has been, I think, the general takeaway when we look at the tax cuts he got through and the way that he's been bashing the Fed into keeping interest rates low. Is that what would be expected in 4 more years of Trump?
Yes. Thank you for stealing all the reason. Okay.
That's just what
I'm kidding. Okay. So those 2 big things that you just mentioned are part of the reasons why the economy would continue to do well under a second Trump term. So let's take the Fed first. Jay Powell up for... Well, he's probably going to get the boot based on how the president has been hammering him. That's in early 2022. He needs to be replaced, so he has to step down. So it's likely that the president will elect more dovish members to the Fed. So from the FOMC, we can probably expect further lowering of those interest rates, which, as we all know, as we've been seeing, the markets really, really like. But then also continuing a loose monetary and financial policy, deregulation. We've already seen some deregulation, particularly like with the energy sector on environmental regulations, and that has definitely provided a boost to that sector. And so Capital Economics, which wrote this report, believes that deregulation could continue, especially as the president has to keep nominating more federal judges to the courts. So that could provide more regulatory rollbacks. Also experiencing, and we talked about this the other day. What day is today? Friday? I guess yesterday.
Short week.
I know. I don't even know what day it is anymore. We heard Treasury Secretary Steve Mnuchin saying, or pledging rather, more tax cuts. And as we've seen and as we know, that can really provide a boost on the front end. So this is just some of the reasons why the economy will continue to run hot, so to speak, if we have a second Trump term. However, there is one very large downside risk that is going to be trade. That's coming from an overseas problem here. One, U.S. and China, while we did sign that phase 1 trade deal, we still haven't, signed a final trade deal.
Yeah.
There is no phase 2, as we know, in the works right now. Or it's in the works, but we have no phase 2 trade deal. And it's likely that those tensions are going to continue. And then, we also might see like tariffs and also trade tensions expanding with other countries. So that's that's the main downside risk that we're seeing. Although the other positives,
even the positives, though, I mean,
they also have risks. They also have
I don't
risks.
even know if those would be necessarily proven and taken for granted here, because we've seen President Trump's nominees for the Fed not get through before.
So that's a very good point. Herman Cain, for example, was very clearly not going to make it through, and the Senate kind of made that clear. So he never even got nominated. But if he can pick, if the president can pick, very well established, dovish, people to the Fed with more credibility, it is potentially likely that those nominees will be able to go through. And again, while these positives we do see on the front end, we saw, on the front end with the Tax Cuts and Jobs Act, TCJA, which was passed back in 2017, you see those positives on the front end. On the back end, they don't really exist. So just for tax cuts, for example, the economy has not continued to grow at the same pace as we saw after we did get those tax cuts. That would likely probably happen again if we saw another tax cuts, and then we would just see the deficit continue to grow. And as Capital Economics points out, we might see some of these positives to the economy, but in the long run, we really might be setting ourselves up for a financial crisis or some sort of bubble that we are not as well prepared to tackle.
Yeah, and proposing the tax cuts makes a lot of sense if you're trying to paint 4 more years as very similar to the first 4 in the way that the economy did increase in growth right when Trump came into office and got that tax deal done. But politically speaking, it is interesting to see things shaping up on the other side right now, with Michael Bloomberg making some serious moves in the polls here as he continues to spend an egregious amount of money, depending on who you ask. The 2020 presidential hopeful has reportedly spent more than $250 million on campaign advertising since joining the race. That's according to data from Advertising Analytics. But guys, I mean, he's seeing that pay out in the polls here as he continues to move up, polling about, what is it, I think 4th or 5th behind Warren and Yang in the latest Emerson poll nationally. So, I mean, he's spending a lot of money, but it's clearly paying off here.
It is. I mean, I've talked about this before. It usually does happen when we see not just presidential races, but, congressional ones, gubernatorial races. The candidate that spends the most wins. And Mike Bloomberg entered this race pretty late. He's actually already ignoring some of the early voting states like Iowa, which is coming up on the 3rd. And he's putting all his money behind some of those later races, California, New York. And look, his strategy is actually working. I mean, he is spending a ton of money on commercials, on Facebook ads, on radio ads, and he's
if you watch the NFL,
outspending.
he is on every single ad break.
Exactly.
The playoffs were all Bloomberg all the time.
So here's the thing. President Trump himself, his campaign came out and said that he wants to spend $1 billion in order, and he's an incumbent, and incumbents have a pretty good shot of winning. I know you, Emily, had written about this recently. Presidents tend to be reelected, which means I think Mike Bloomberg's strategy is, okay, I have to outspend the president. And with nearly $60 billion, he absolutely has the money to do that because he is completely self-funded right now. So, I mean, the fact that he's able to jump in the polls that much without doing massive rallies and town halls that we've seen all the other candidates doing just by spending money on commercials, essentially, is
and
pretty
not even
incredible.
be in the debate so far.
Exactly, and to not even be in the debates, I think, is a huge part of it. So, I mean, is it really, to your point then, about visibility then, even more so than getting across the ideological tenets of your campaign? Because I don't know that advertisements are the best way to actually get that across.
So Michael Bloomberg has an advantage in the sense that his political ideology is actually already pretty well known, first from his time here in New York City, but then also just he's done a ton of interviews, ever since he was the mayor, so people, I think, already kind of know politically where he lies on the spectrum. But I think right now, when the candidate pool is so large, visibility first and foremost is important. There might be some candidates that not a lot of people know about that they actually might agree with their policies or with their campaign proposals. But if you don't know them, then it doesn't really matter.
Yeah, which is why I think you were surprised, Angelique, to see Andrew Yang there sitting in 4th off that latest poll, because he's one of those names that hasn't gotten a lot of attention, and nor does he have as much money as Bloomberg, but he's still sitting there.
He's still sitting there. He also is somewhat of a quirky candidate that doesn't have that sort of household politician characteristic, that likability factor. He talks over people's heads sometimes, I certainly think. How much do you think Bloomberg's announcement, though, that even if he doesn't win the nomination on the Democratic side, he's going to turn over basically his machine and his money to support that Democratic? Because I know certainly anecdotally, people really responded well to that he's not only going to use his money to support him, but really to prop up the Democratic side of the ticket. And it seemed like that eased people into how much money he was spending.
Right. And to the point that he hasn't been on the debate stage, he hasn't torn down really any of the other candidates. We've seen Bloomberg use his money before to really throw it behind Democratic candidates. We saw him do it in the midterm elections. So I actually do believe that if he feels very strongly that, listen, I have to put as much money behind into defeating President Trump as possible, either by myself winning, I can imagine he will, if he's willing to outspend $1 billion or spend $1 billion just to defeat President Trump for his own campaign, you have to imagine that he is absolutely willing to spend a couple $100 million to support whoever the Democratic nominee is.
Absolutely.
Yeah, and right now, I think it's fair to say that it's anybody's race heading into the Iowa caucuses because.
Well, that's not true.
Well, I still think you got.
It's not
you got
Tulsi
Sanders.
Gabbard's race, for example. It's not anyone's race.
All right, maybe not anyone's race, but the names that we showed on that last poll, we cut it off at 4%. Those names I would call anyone. But Kristen Myers, thank you so much. Appreciate it. Next, though, on Wi-Fi PM, women now hold more jobs than men in the U.S., but the story does not stop there. Why more women are making inroads in traditionally male-dominated fields like construction. More Wi-Fi PM right after this. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Emily McCormick, along with the corporate agent, CEO, and founder Angelique Ruers, back with us in studio. Want to just highlight the market action we've been seeing right now as we see red across the board. The Dow extending its losses, now off more than 200 points. We want to check in with Ines Ferre on the floor of the New York Stock Exchange for more on the move. And Ines, Boeing seems to be one of the big movers today.
It is, Zach. Boeing down more than 1%. This is after a report that the company is considering perhaps cutting production of its 787 Dreamliner because of sluggish demand. This is according to a Bloomberg report saying that this would be the second actually slowdown of production for the 787 Dreamliner since October, and that executives are considering perhaps cutting the production by anywhere between 2 and 10 planes a month. Boeing down this afternoon, down more than 1% at the lows of the session, actually. And then just taking a look at some of the airlines that are at the lows of the session today. This is after the CDC confirmed the second case of the coronavirus in the U.S., that one being in Chicago. That's really when you saw the airlines taking a hit, airlines with routes to Asia. So you're looking at Delta, that's down more than 2%. United down more than 4%. United earlier this week in their earnings call, executives had talked about the coronavirus. They said that they were in touch with the CDC over safety measures. And American also down more than 4% this afternoon, Zach.
All right, a double punch as we highlighted earlier this week. More updates impacting the airlines. But Ines Ferre, thank you so much for bringing us that. We'll check back in with you later on in the show. But today, new analysis from Moody's Analytics is out with some interesting findings, including that women are gaining more traction in the workplace, with females even gaining ground in male-dominated jobs like construction. And for only the second time in history, women have the largest presence in the U.S. workforce compared to men. And what's also interesting here, guys, is that, it's not just the fact that women are getting the jobs. I think one of the things that people like to point out, of course, when it comes to the pay gap, is that some of the women working now more might actually be contributing to what a lot of economists have been confused by, which is stagnant wages and maybe not seeing wages rise as much, which is kind of disheartening, I guess, on the flip side of this. But more women working, something that is not something we've seen happen earlier in history.
Right, and more women working in these fields that are some of the fastest growing in the U.S. labor market. So, I mean, if we look at the most recent jobs reports, healthcare, education, leisure, and hospitality, those industries have really been seeing the biggest gains, and that's where women have disproportionately outnumbered men just in these fields. So that's something that is probably going to be continuing. But to your point, again, something that economists are pointing to as because of this entrenched gender wage gap, something that potentially is to blame for at least part of the stagnant wage gains we've seen.
Yeah, I think the other thing we're seeing is the impact it's having inside the workplace. So you're seeing more women asking for bigger culture changes inside these companies, better work-life balance, better programs to offset the issues they have in terms of childcare and still the disproportionate responsibility that women often carry at home. So on one hand, I think this is really great news. On the other hand, I'm hoping to see that it'll drive some of those culture changes that we've been talking about for, 2 decades now.
It's been a while, yeah. A lot of things have been highlighted increasingly, it seems, as well. Just the numbers specifically I want to highlight when we're talking about Moody's Analytics numbers here. Reducing growth in earnings by 0.1% when we talk about the share of women working in some of these industries. More important, that drag is increasing. Previous research found a downward wage pressure in industries that were increasingly dominated by women. So it's again one of those things that is not exactly heartening to see, but exciting to see women moving into some more male-dominated fields. And that is increasingly becoming important because Goldman Sachs announced that they're looking to diversify the workplace through their own efforts, saying the company will no longer allow IPOs for companies with all-male boards. We've seen California make this push to diversify boards, but now a bank actually saying they won't take a company public unless there is a female or someone of diversity on the board.
Right, and not just any bank, but a bank that venture-backed companies very highly value to put on their prospectus as a company that is underwriting their IPO. So because of this, it really is putting pressure on JP Morgan, Morgan Stanley to potentially also step up to the plate, make a move like this in order to really drive a big change in the industry.
I think it's hard to, this is a big move.
It's a big move, but they didn't do it lightly. They went back and they looked at their IPOs over the last 4 years, and they saw time and time again that when there were women on the board, specifically, that they had a better result here in the U.S. So they're doing this for business reasons too, and then they look at the fact that there's stronger return of equity to shareholders that have a diverse board. So I think there's a really good story to be told there.
Yeah, we've seen, I highlighted this in the cannabis sector. There's a lack of diversity in that sector specifically, but you also run into governance issues when you have people who are all thinking the same way.
Absolutely.
You need a change in perspective, I think, is healthy, and we've seen that from companies that have done well, especially this year. Even just in the cannabis space, even beyond that, I'm sure you see the same results, but it's just...
Absolutely. But I think, and of course, we can say WeWork here, right? We can drop that in. Obviously, that factored into their decision in terms of that diversity of thinking. But there's another piece to this, too, and that is Goldman Sachs is saying that they're going to help open up their Rolodex, if you will, to these companies that don't necessarily know diverse potential board members to join. And I think what it's really going to force these companies to do, these startups, is to look beyond their personal connections. So many board positions are given out based on who knows who, when there's a lot of talent out there that's untapped. So I think it's really about looking broader and being more strategic in who goes on your board. And then that's going to drive down those governance decisions. Hopefully we have more transparency and more ethics, and even just better product design that takes into account more diverse customers.
Right, and I think just Goldman Sachs really has been shepherding in this era of trying to change the profile of Wall Street. I mean, CEO David Solomon has really been at the forefront here of trying to hire diversely at some of the lowest levels, because that's kind of where it starts, and then they can actually move up the ranks, starting their career at a company that does have a very good reputation, of course, on the street. So really setting the trend here.
Yeah, and as we know, David Solomon also DJ Dettol. So he also DJs. It's a very different culture within Goldman Sachs as well. So maybe, as you said, might push some of these other banks to follow suit as well. Coming up, though, with Richard Branson's speculative space travel IPO up 170% in 2 months' time, we're talking space travel with Secretary of Transportation Elaine Chao, why she says the U.S. is notching big strides in getting Americans up in space when Wi-Fi PM returns. Welcome back to Wi-Fi PM. We are checking the market actions as losses are accelerating. You can see the Dow off more than 200 points. Right now, the S&P teetering on being off by about 1%. Right now, sectors-wise, energy and healthcare dragging the overall market lower, the two worst performing sectors so far today to wrap up the week. Well, the space race is increasingly getting out of this world. Shares of Virgin Galactic have skyrocketed over 45% in the last 30 days, driven in part by investor excitement about the future of space tourism. And Yahoo Finance editor-in-chief Andy Serwer sat down with Transportation Secretary Elaine Chao to discuss how her office is working with major players in the industry to regulate the growing industry. Watch.
They have to get licenses to be able to launch their rockets. And 6 years ago, America was not very much in the lead at all. But because of the advent of American technology and innovation and the invention of the reusable rocket, America has now zoomed to #1. So we're very, we should all take great pride in that. And the number of launches are increasing every year. So we've had about 32, 34 this year. And next year, there's going to be about 44, 45. And as these commercial space vehicles go into space and they become more frequent, we at the FAA, at the U.S. Department of Transportation, have to think about how do we integrate and facilitate these launches. So one example, it's still that if a launch goes up, a certain perimeter of airspace has to be emptied. So this is very disruptive. And if indeed there's going to be more frequent launches, what does that mean for operation of the national airspace? So that's a big question.
It is a big question. I mean, increasingly, as we see more and more of these rockets get fired off, maybe not the ones carrying people, but the ones carrying satellites and all these other goods up to the International Space Station. I mean, it is a question of at what point do you have too much going on? And I know you live in Florida, so you watch some of these.
I do. We watch some of these. It's going on all the time now. This is not rare. It's sort of a weekly occurrence. And, look, where humans go, lawsuits go. So we're going to have this entire burgeoning industry of outer space law that's going to be here. There's a lot we don't have figured out about this. I mean, it's great to see the stock doing well and the technology moving forward, but there are a lot of unanswered questions about this space.
Right, and just looking at Virgin Galactic, I mean, this play is completely speculative at this point. I mean, this company doesn't have revenue. Yes, they said they had 600 people with 60 countries that already made reservations to go up in space, but at this point, it is completely a bet on this future performance without any historical performance to base that on.
Yeah, no, absolutely. And I guess, because you can have people looking at this space and say, why are we wasting our time with this? But it's not, we've seen the cost come down, clearly, so it's not crazy to think that, yes, Virgin Galactic might be the one issuing weekend trips up to space shortly, but also just that it might be good to actually answer some of those questions ahead of time to make sure that we are the country that will be attracting the investment dollars because we have regulations in place that would want to do that. We've seen this on the crypto level. And Mark Zuckerberg's made that argument all the time, that when we're so far behind the curve, you're going to have money flowing into other countries, mainly China, and do you want to be on the losing end of a battle in tech like that?
Definitely
the answer
not.
Would be no.
Yeah, you don't want it to be. And you also need, I think, more players in the space. Right now, Virgin Galactic doesn't really have anyone to compare themselves to that's out there. SpaceX isn't public yet. So, from that perspective, a valuation perspective, it's very difficult. But we're going to see breakthroughs in mining asteroids. I mean, there's all sorts of things that we're on the cutting edge for. I think this is a pretty exciting time. I think that's why investors, more than anything, are in this, is because it's pretty exciting.
It is exciting, and that's what their whole IPO is about. They brought out the flair to be expected with the Richard Branson Company of saying you could be the first to own a space tourism company, but very exciting for the time being. Those shares today off about 8% as we're watching them fall. Well, before we go to break, want to take a look at the Dow leaders so far today. Got to highlight the names. Intel, we talked about their big earnings beat, as well as American Express, 3M, Travelers, and P&G rounding out the leaders. And on the flip side, the Dow laggards, much easier to find those names on a red day. Dow Inc., Merck, JP Morgan, Walgreens, and United Health rounding out the laggards on Friday. Well, after the break, the Super Bowl just a week away, why it might cost you more than ever to attend the game in person this year. We'll get the latest update on pricing. Wi-Fi PM is back in 2. Welcome back to Wi-Fi PM. We are checking the market action again. Losses accelerating here. The Dow close to about a 250, now past 250 point loss so far to wrap up the week. The S&P and the NASDAQ in the red as well. You can see the S&P, the biggest loser so far, off more than 1%. Energy continues to be the big drag right now. Utilities, the only sector in the green as we see oil off by about 2.5%. Well, Super Bowl 54 is fast approaching and tickets to the game are shaping up to be super expensive. According to ticket price data compiled by SeatGeek, the matchup between the Kansas City Chiefs and the San Francisco 49ers is pacing to be the most expensive Super Bowl ticket in history, averaging about $7,100 a pop. If that price holds, it'll top the second most expensive game on record, the 2018 upset staged by the Philadelphia Eagles to top the New England Patriots by more than $2,000. So the question is, guys, is that worth it to go to the game? I mean, $7,100 is quite a bit of money to be dropping on one day.
Definitely. I mean, you're asking the wrong person because I'm always going to say it's not worth it as someone who isn't a huge sports fan. But really, I mean, look at it. Like American football, professional football, it's really that, and then there's everything else when it comes to sports. This is just big business. It's not just ticket sales for the NFL. It really is, it's ad sales. It's these partnerships with, TV distribution and broadcasting networks, sponsorships from companies on the ground. So really just a huge amount of revenue streams and seeing these continue to grow.
Well, I, for one, would have said it was worth it if my Baltimore Ravens
you'd be there.
in there. I would absolutely be there. If it was $7,000 a ticket, I wouldn't care. I'd get there. But I think what's interesting is the trend this year is actually counter to what it's been in the past. You've actually seen tickets come down as you get a little closer. People are trying to offloading. There's a lot of excitement around this season, and the prices are staying up.
Yeah, that is the trend. It is interesting because Ticket IQ went through the data to try and figure out what is the best time to buy. And we saw in 2015, I think prices spiked as they got closer. That was kind of the odd scenario there, but we'll see what happens as we get closer because these averages could change. But right now, pacing to be the most expensive, and I think that's something to watch. I, for one, think it's worth it. I went and saw my Bears lose in 2007, and even though they lost, I got to see Prince sing Purple Rain in the rain.
What'd you pay for that?
I was in Miami too. I will not say. Don't remember entirely, but it was worth it. Emily McCormick, thank you so much. Angelique Ruiz, thank you as always for coming back in to sit with us. Let's check in with Ines Ferre on the floor of the New York Stock Exchange. Ines?
Zach, I'm here with Tim Anderson from TJM Investments. Tim, we're looking at the lows of the session right now. The coronavirus, how big of an effect is this on the market? And should this be of concern for investors?
Well, it's clearly having a big effect today, and I think that this is just a classic risk-off trade under the uncertainty that we just don't know yet where we're going with this. I mean, we came in this morning, and there was an embargo on 4 cities in China. Now it's up to 16. So there's no way to define what we might see over the next 2 days when the markets are closed, and it's a typical reaction by investors to just say, you know what, some of these stocks that have had really big moves, we're going to lighten up on those, take some profits, not really going to buy anything new today. Let's see what kind of news headlines we get out of this virus story over the weekend, and we'll take it up again on Monday.
Right, because how much of an impact could this really have? I mean, we're looking at the airline stocks today, which are under pressure. Delta, United, American, those are in recession lows because of this. So how much more before investors start really getting more concerned?
I mean, look, this has really only been a big story for maybe a week, maybe a week and a half. If you go back to other similar situations, it could go on for a month and a half until, I'm not saying that will happen. I think it will probably be less this time, but we just don't know. And that's part of the thing. The market can handle bad news, but it just has a tremendous adversity to uncertainty. And that's what this story just has, uncertainty every way you look at it. So investors are just going to say, you know what, let's just take a powder for a little bit and see what comes out over the weekend.
And oil is getting hit as well today as well.
Oh, sure. And oil is just, look, the fundamentals for the commodity with West Texas at 55 and Brent at 60 are bearish. You've got Libya and Iraq almost totally offline. You've got tremendous sanctions on Iran and Venezuela. And we're pumping 13 million barrels a day in the U.S. So where the commodity looks bearish, for some U.S. drillers and refiners, it could be positive.
Thanks so much, Tim. Zach?
Coming up, the CDC confirms a second case of the deadly China virus in the U.S. A healthcare policy analyst weighs in on that next. The ticker starts in 2.
Good afternoon and welcome to the Ticker on Yahoo Finance. I'm Shauna Smith. As we check in on the markets in the last 2 hours of the trading week, losses look to be accelerating. We have the Dow up 229 points. The S&P is down 1%. If the S&P closes down 1%, it will be the first 1% decline for the index in just about 3.5 months. We are also seeing some weakness in the NASDAQ, that index off just around 1% as well. Well, first, let's get to the big story of the day and what a lot of investors are watching, and that is the fact that the CDC has confirmed a second case of the deadly coronavirus in the U.S. Now, a woman in her 60s is hospitalized in Chicago after returning home from a trip to Wuhan, China on January 13th. And in China, the government is restricting travel for about 40 million people as officials try to stop the virus from spreading. And just to put this in perspective, that is basically the equivalent of the population in California. Joining us now is Chris Meekins, healthcare policy analyst at Raymond James. And Chris, thanks for joining me today. As we try to sort through this, we obviously see the losses in the U.S. equities today. How big of an impact do you see this being on a global scale?
I think we don't know what the impact is. I think one thing we do know, and I do believe based on conversations I've had with individuals, both in the U.S. government and more importantly, with relationships in China, is that the number that have been reported out of China on this disease are really a fraction of the number of people that have probably had the disease. So if China's reporting about 800 with 25 deaths, we think the number is probably 10 times that number in China right now, because you had a lot of misdiagnosis early. And people with minor symptoms from this, kind of the equivalent of the cold rather than the pneumonia, may not have actually gone to a hospital and gotten diagnosed early on. So I think in China, it is a much bigger issue than people even realize now. In the US, I think it's still not going to be a big issue, though I do anticipate in the coming days we're going to see a notable increase in the number of patients that actually have the virus here.
Chris, the biotech sector has been in focus because of this. We had the Novavax president of research on the show yesterday. He was talking about the fact that the company is trying to develop a vaccine for the coronavirus. When you take a look at all that, take that into account, how likely or how successful do you think these efforts will be?
I think it's important to know that from a commercial standpoint, we don't know how big the potential universe for any vaccine would be, right? We didn't have development of an Ebola vaccine for all those years because there wasn't a commercial market for that. And yet when the government then put up additional money to help develop it, then companies were willing to step forward. So companies that have a partnership with the government, like let's say Moderna, which is partnering with Tony Fauci at the National Institutes of Health to develop a vaccine, those would be areas I think would be better to invest in than companies that have no real government funding for this, because I just don't believe there's a sustained investment. And there's a long history of companies, as soon as a new disease pops its head up, claim they're going to do stuff, raise a bunch of money from investors, and never actually finish the job.
Chris, do you think that we will see, do you think the U.S. government will at any point start contributing money, start funding this, or does it have to be much more widespread in the U.S. before that happens?
Well, the National Institutes of Health have already said they're going to fund it to a certain degree. I think the big question we have now is, will the U.S. government decide to invest through a supplemental funding bill from Congress? Will Congress pony up additional money, as it did for pandemic influenza, which we're not there yet, as it did with Zika, as it did with Ebola? But it did not do that during SARS in 2003. So I think it's possible the U.S. Congress could do that. But if you don't see the U.S. Congress doing it, I think that it's unlikely the administration has additional money available to reprioritize and move to this in a meaningful way.
Chris, you say that the situation in China is likely significantly worse than what the government is saying. If that in fact is true, how big of a risk do you think this is to China's economy, and then also just on the global scale here, just to put it in a numbers perspective?
I think it's difficult to tell, and it's difficult to compare it to previous viruses, because China has a long history of not fully disclosing and not accurately counting the number of people with certain diseases, especially when there could be, it's attempting to save face on the global scale. So from my perspective, I think that anytime you restrict the travel of 40 million people, and as you said rightly, the size of basically California, that is going to impact the economy in a meaningful way. These restrictions are not just going to be a 1 or 2 day restriction, it's going to be 5 days a week, maybe even 2 weeks in these areas. And the question then becomes, how many production facilities in those areas shut down completely, and how long are they shut down, as we saw during SARS in 2003.
And Chris, real quick, I know you covered the healthcare space. It was a huge underperformer sector-wise in 2019. Do you think things will change this year?
I think it really depends on what the outcome of the Democratic primary is. If Bernie Sanders or Elizabeth Warren is the nominee, healthcare is going to underperform. If it's anyone else, I think healthcare overperforms. We went back and looked from 1980 to present, and half the time in an election year it overperforms, half the time it underperforms. So really, flip of a coin, if it's Bernie Sanders or Warren, it's probably not going to be a good year.
All right, Chris Meekins, thanks so much for joining me today.
Thanks so much.
Well, let's get to our big three tickers. We have American Express giving a rosy outlook for 2020, Intel soaring to new highs in the wake of its latest quarterly results, and Broadcom signing a lucrative new deal with Apple. Let's kick it off with American Express. The financial sector is in focus after the company reported quarterly results that beat the street's forecast, boosted by card fee revenues that grew more than expected. I have Dan Roberts here with me. And Dan, once you go through these results, it looks like it was a pretty strong quarter for American Express.
Yeah, it was. 11 million new card signups and also 20% hike in card fee revenues. So what we're really seeing is that for all the hue and cry over the death of plastic, and this is something I've been saying for a while, people say, oh, credit cards are moving mobile. We're talking about Apple Pay. Well, Apple Pay hasn't really caught on at quite the speed we expected. But I think the trend here is Amex can still have a huge, successful, growing every year business by having a card that comes with fees and has certain rewards and perks. And actually, there's a specific note in the earnings report that 70% of the new card signups Amex saw in the year, it was either in the fourth quarter or in the year, were people choosing the fee-based cards. Now, Amex, it's a newer thing that they do have a card that doesn't have fees, because in the past, what Amex was always famous for was, yes, there's high fees, but there's perks. And yet, even now that they have that option, most people signing up for new Amex are still taking one of those proprietary Amex cards that comes with a fee. Now, of course, sometimes you see that merchants and retailers don't accept Amex. Sometimes it's restaurants, typically. I find that a lot, and sometimes it's frustrating. It's because it comes with high fees. But usually, there are perks and rewards for having an Amex. And so I think it still is kind of seen as the premium card, and it's doing very, very well. Raised its profit forecast for 2020, so things there look pretty good.
And it also really speaks to the strength of the consumer, though, too, because we talked about the fact that there's so much uncertainty out there. Maybe investors, maybe Americans will start maybe curbing some of their spending, staying on the sidelines in terms of investing. But when you take a look at results like American Express, clearly there's still demand there.
Yeah, and the Amex CEO in an interview said, we saw a great balance in the fourth quarter of spending, lending, and fees. So there's Amex's lending business, consumers spending more. As you said, we saw a great holiday shopping season. Remember all the experts who rolled through here and said, the trade war, trade's hurting the economy, trade's hurting the consumer, and you're really going to see it in the holiday shopping season. We're going to see weak numbers. We didn't. We saw great numbers, great e-commerce numbers. So people are spending, and in many cases, they're using Amex to spend with. And then, as I mentioned, the fee revenue has been very good for that company. Of course, we also got Discover earnings, and then we want to hit on those, and those were a very different story. So it isn't the case that, like with, say, the airlines, where, all the airlines have seen, record profits. It isn't the case that all the credit card companies are just doing terrifically. Discover, of course, its own unique problem. Discover has a ton of debt that it has to work out.
Well, yeah, I want to ask you about, because Discover, that stock, we just had it up on the screen, is off just around 10%, obviously under an extreme amount of pressure today. Their earnings disappointed. They had 2 downgrades. What do you think the huge difference is between why Discover is underperforming, and then you look at American Express, and obviously it's meeting what the street wants to see?
Yeah, Discover is its own problem. The company has a lot of debt. Now, it was always known in the past to be very forgiving of when customers couldn't pay off the debt they have to Discover. Discover did a lot of special programs that allowed people to either reshuffle, reorganize, or delay that debt. But now the pigeons are coming home to roost. So it's a company with debt. It's a company that is saying that it's going to spend a lot. That's part of the reason the stock is down so much. In the earnings report, Discover warned that it's going to be investing more in technology and analytics. It has to boost and kind of rebuild and refresh its dated tech. You never want to hear that from one of these companies, especially in an age when all the credit card companies like to consider themselves tech companies. Oh, fintech. Every company is a tech company now. So Discover and Amex, 2 very different stories in the same business.
All right, Dan Roberts, thanks for breaking that down for us. Well, let's move on to Intel. They reported earnings after the bell yesterday. The stock today, though, is surging, trading at its highest level in just around 20 years. Now, it beat the street's expectations. And drilling down into those earnings, Intel got a boost due in part to the demand for the chips used in data centers and also cloud computing. We have Dan Halley here to break this down. And Dan, Intel, the top performer in the Dow so far today, up just around 8%. When we were digging through the numbers, how important do you think that cloud business is to the future success of Intel?
It's incredibly important. This is where a lot of companies are going to continue to push, and I know we talk about the cloud very often, obviously, with the chip makers as well as the service providers like Amazon, like Microsoft. But really, the cloud is only just beginning to take off. The companies that do have it right now are still building out data centers, and there's a ton of companies out there that haven't even thought about the cloud. So this will continue to be something that Intel, AMD, its biggest competitor, NVIDIA, again, the software providers through Amazon and Microsoft continue to benefit. But for a company like Intel, it's a double-edged sword because we have what we see now, where we see data centers or data center sales surging. That's all well and good, but that kind of sales cycle is in itself a cycle. So what happens is we get these purchases. Companies then have to integrate these new systems into their general workflow, and then we have a kind of hold off where they don't purchase any new systems until the next year. And that's something that happens and happened for Intel last year, as well as NVIDIA and AMD. We saw a lot of companies saying we're seeing sales kind of slip into the second half of the year, and that is what Intel is warning going forward now. So while the stock is surging at the moment, in the future, it's going to hit a snag, potentially, based on their own guidance saying that companies will not be purchasing as many data centers or data center chips as they are now.
Yeah, Dan, is that the big concern going forward? Because I was reading some of the analysts who were a little bit skeptical, like you're saying, about the future. And they were saying just in terms of Intel's business plan, how they plan to continue to turn a profit, it's a little bit hazy in terms of where exactly they're focused on.
Yeah, they have the consumer side and then they have the data center side. They need to continue to do both. That's really important for them because obviously consumers purchased Intel chips in any kind of PC that you might think of outside of the ones that are now being built with AMD. And I'll get to that in a second. But the data center side will also continue to be incredibly important. But again, it's a cyclical kind of sales cycle, that happens with these kinds of centers because, again, they have to be digested by these companies, taken in, updated, running, and then they go ahead, hold off on buying, and then purchase new items for the next year, for the next fiscal year. For the consumer side, what we're seeing, and a little bit on the data side, is that AMD is slowly creeping up. Now, they've done incredibly well this year, much better than Intel, and they're going to continue to do well because they have a technology called 10 nanometer chips. Now, when we talk about processors, we talk about nanometers. That's the distance that you see between the individual transistors on these chips. AMD has managed to get to 10 nanometers. Intel has been struggling to get there. They do have chips there, but they're not really at the commercial level that AMD is. And that's why you're seeing AMD do much better in the commercial space and increasingly on the service side with the cloud providers.
All right, Dan Halley, thanks so much. Well, let's take a look at Broadcom. Shares today of the chipmaker are popping after it disclosed new deals with Apple worth about $15 billion. Now, Broadcom has signed 2 multi-year agreements with the tech giant for components that will be included in new Apple products. We had Jared Blickery with us, and Jared, we could see the stock moving just around 0.5% higher today. But when you take a look at what this means for Broadcom and for Apple, how significant is this deal?
Well, it's significant because Broadcom wants to sell this unit. It could be worth about $10 billion with these latest disclosures. And some of the buyers, potentially Qorvo, Skyworks Solutions, that's all speculation at this point. We had an analyst on earlier on the Move, and they speculated that Apple itself might buy the unit. We'll have to see. But yeah, the stock hit a record high on the open. It's sold off a bit. I think a lot of that is just because the general market and the chip space in particular is selling off on coronavirus fears, so I wouldn't read too much into that. But you look at what it's done over the last year, it's not bad. It's up 22%, kind of underperforming the market. And if we take a look at the entire chip space and we go to a 1-year sort here, we can see AMD at the top, 138%. Broadcom basically tied for last place here, so underperforming a bit, but they're going through a transition stage. They want to be enterprise networking and software. That's where they're going. And so these consumer units, especially RF chips that go in these Apple phones, trying to get away from that.
Jared, how critical is Apple's business to Broadcom? Because I was going back through some of the numbers, and Broadcom said in a December filing that Apple's business comprised about 20% of its net revenue.
Yes, well, especially considering the divestiture, it's important because, again, they want to get rid of this unit, and this helps the valuation of that. So not surprisingly, the stock's popping on that. Long term for Broadcom, getting back to the transition, it's all about enterprise networking and now software as well. Software kind of stabilizes their revenues, whereas the networking part, which is the chip part, the hardware part, that really gives them a growth engine. You put those two together, Broadcom could be in the middle of the pack or maybe even leaders in a year's time, but that transition is in progress right now.
All right, Jared Blickery, thanks. Well, coming up, Apple and Facebook will be among the big companies headlining a huge upcoming week for earnings. A top expert joins us to weigh in on how investors should prepare next. earnings season is well underway with more than 21% of the S&P 500 companies reporting results. Now, according to Credit Suisse, earnings are beating by an average of 5%, with 58% of the companies exceeding their bottom line expectations. We have Jimmy Lee, CEO of the Wealth Consulting Group, joining us. And Jimmy, when you read how earnings are doing so far, a bit of an underperformance compared to what the street was expecting, how do you see this shaking out?
I really wouldn't worry about it too much right now. We have the majority of the companies in the S&P 500 yet to report. I mean, I looked at this report 1 week ago, and we're in the 70 percentile. So now it's been a little bit lower. This last week hasn't been that great, but I wouldn't be that concerned. In fact, I think that we might get some earnings surprises to the upside for the remainder of the year, and that's what I'm looking for, actually.
Jimmy, at this point, we have tech, utilities, real estate, those three sectors not too far from the all-time highs. Technology in particular, that sector is up just around 52%. When we take all of that into account, what do you think of the market at these levels?
Well, some argue that it's a bit expensive, and so earnings need to catch up. But I think I've seen some data that are researched actually this morning that manufacturing globally is actually picking up. So an early report on manufacturing data for the month from Market, I read that in Germany and also here in the United States, that we might be getting a turnaround in manufacturing, which has been the area that's been really slow. And so the phase one of the trade deal actually might be working. And the consumer is still very strong. So, you know, while certain sectors are certainly rich, and I do always recommend a diversified portfolio, the way that we're playing this is to have not just growth, but also value, and make sure that you do have some defensive sectors and you're not underweighted there.
Jimmy, when we take a look at the markets today, obviously we have the Dow, the NASDAQ, and the S&P all under pressure. The Dow off 280 points right now. A lot of this is because of concerns of the coronavirus, reports that it could be spreading. Maybe the number is higher than what the Chinese government is reporting. What do you think the macro implications are of this?
I think it's yet to be seen, but this is a story that we've seen before. I mean, with Ebola and some of the other viruses that we've had in the past. I really would view this, though, from an economic standpoint as a buying opportunity. It's uncertain, actually, you know, in terms of what kind of an effect it will have on the economy on a global basis. Certainly for China, it'll make an impact on a short-term basis. But if we do get a larger pullback and maybe even a correction that's like we did with Ebola, because of this, then I really would view it as a buying opportunity and a way to get some cash in the market. A lot of investors last year exited equities into cash, and this might be a way to get back in.
Jimmy, say you could view it as a buying opportunity. What do you like?
Well, we again, like I said, we're using a barbell strategy where we still are overweight in tech and some of those sectors that you mentioned before, utilities, real estate, financials. Right now, actually, the pundits are expecting kind of modest returns for the S&P 500 this year. I think we could get a surprise to the upside and maybe not back, but continuing into cyclical stocks. And maybe if we get this global growth theme to return, cyclical stocks should probably do well.
Jimmy, at the Fed meeting next week, largely aren't expecting any changes to policy, but do you think we could see any revision in terms of guidance?
I really don't. I know I've seen some people that really believe that, or some experts say that we might get a cut in rates a couple of times. I think we'd have to see some bad economic data for the Fed to do that, and we would have to see some robust inflation, which I don't think we're going to get anytime soon, to see them raise rates. And so I think because of also the pressure from being an election year, the Fed might just stay put for longer than what most people think. So I think they're going to stay pat or stay put with what they said in the past, and I don't see major changes from their viewpoint right now.
All right, Jimmy Lee, thanks for joining.
Thank you.
Well, coming up, the biotech ETFs that stand to see the biggest impact as the coronavirus outbreak intensifies. We got those details. Don't go away. It's now time for our ETF report brought to you by Invesco QQQ. We are watching the SPDR S&P Biotech ETF under the ticker symbol XBI. Now, the sector is getting a lot of attention this week as various companies are working to develop vaccines to fight the deadly China virus. Joining us now is Phil Bach. He's the founder and CEO of Exponential ETFs. And Phil, thanks for joining me today as we try to dig in and figure out how investors could play this, what companies maybe could benefit because of this. From an ETF perspective, what are you looking at?
So before I answer that, I just want to, it's so horrible that this happened right during the Chinese New Year, which is today. So Happy New Year to everyone. It's a time that people in China travel domestically and spend time together, and it's just heartbreaking. From an ETF level, we're looking at CHNA is a local China biotech company. There's also an ETF, BBC, that's got stocks that are in clinical trials right now. And of course, those have some real asymmetry, some real upside. If they rush through some of the clinical trials, and we think there are some companies where that might happen, then we could see some real pop in some of those stocks. But it's very volatile depending on the situation. We don't recommend that people start trading biotechs on the news. I think probably better to wait a little bit and see what happens if they can contain the virus, and let's all hope they do.
From stepping back and just seeing the demand now for maybe over the last 6 months, last 9 months, have investors been steering clear of biotech? Because we know it's been a very volatile space.
It's been volatile, but it's also, there hasn't been quite as much activity as we've seen in years past. I think a lot of the tag of innovation, or a lot of the focus on innovation, has been more in the straight technology plays and not in the biotech space, despite the fact that there have been some incredible developments when you look at some of the stem cell technologies, the gene therapies that are happening. There's been amazing advancements in the biotech space, but it hasn't really gotten the same headlines that the technology space has. And I think a lot of the tech companies have really taken a lot of the air out of the room from the biotechs.
You mentioned the tech space. Let's drill down into that, because tech obviously has been a huge outperformer. The tech sector alone is up over 50% in the past year. When you take all that into account, do you still see demand or still an opportunity to invest in some of these bigger names?
So what we're seeing now, there is a lot of enthusiasm. There's the kind of enthusiasm that you see at market tops is what we're seeing now in these tech names. You look at the top 5 tech names, they've reached a level of valuation and a level of market capitalization that is almost completely unsustainable. The valuations are so high, they reflect the market expectation that there will be growth in those names. And you look, where is that growth going to come from? Can they penetrate the emerging markets with the same market share that they have domestically here in the US? In the case of Apple, we're very skeptical. Can Facebook continue to grow their ad revenue? They make 95% of their revenue on mobile ads. Is that a growing segment? Hard to imagine. Have you ever clicked on a Facebook ad? Because I haven't. So you look at these valuations and you look overall in the market. The top 2 companies now, Apple and Microsoft, have a higher market capitalization than the entire Russell 2000 combined. The entire Russell 2000, 2 companies. Yeah. And you have to start to think, is there too much risk on the table? Are investors, specifically index investors that are in market cap weighted indexes, are they too heavily concentrated? And should they start thinking about taking some profit and diversifying away?
Well, and also because we haven't talked about it too much recently, but over the last year or so, we've been talking about the fact that this sector can be exposed to potential regulations. Lots of questions about how that will be done, not so much if, but more so when. Do you think that's another risk that investors need to keep in mind when addressing this space?
100%. And not only here in the US, but also in Europe. There have been some antitrust rulings against some of these companies, but it hasn't been that much. And I think investors have been lulled into a sense of complacency where they've heard about this for a long time, but it hasn't impacted, it hasn't really hampered their growth. So investors say, okay, yeah, there's antitrust risk, but I don't think people really recognize how much risk there is. There's been a focus on monopolies that has been bubbling up under the radar that I think is going to really start to become a major issue as we get into an election year here in the US. I think people are fed up with some of the monopoly powers and some of the monopoly and antitrust behaviors that are happening across all sectors in the economy, and it's going to directly affect those companies.
Phil, how do investors protect against some of the downside risk at this point?
There's a few ways. So if you look at it, the US to global globally, the U.S. right now has a 55% weighting versus the global market by market capitalization, which is way outsized of their gross domestic product. So you want to think about diversifying internationally. Here in the U.S., you want to think about getting away from market cap weighted, where you're just buying at peak valuations. You want to think about maybe equal weighting. We have a strategy called reverse cap weight, which can give you more of that diversification for your buck if you're doing it to even out the portfolios. And think about, quality, valuations, fundamentals. Fundamentals still matter. They will always matter, even if it seems for a little while like they don't. Fundamentals will always matter.
All right, Phil Bach, we'll leave it there. Thanks so much for joining me.
Thank you.
Well, let's get to Inez Frey. She's standing by on the floor of the New York Stock Exchange. And Inez, we just had reports that the French health minister reportedly confirming 2 coronavirus cases in the country. We can see the Dow accelerating those losses from earlier today, off just around 300 points right now.
Shauna, that's right. That we are at our session lows after France has confirmed its first 2 cases of the coronavirus, one being in the city of Bordeaux, the other one being near the city of Paris. So we're seeing accelerating losses here. The Dow is off about 300 points. And also we're looking at some of the airlines which have been under pressure on their session lows as well, with Delta down more than 3%, American down more than 5%, definitely at session lows today, and also United down more than 5%. United earlier this week, executives on the earnings call for United had talked about the coronavirus, saying that the company was in talks with the CDC, very much on top of this issue about safety measures and screening. And also, I just want to mention Dow component Boeing off about 1.5% after the company is reportedly considering trimming its production of the 787 Dreamliner because of sluggish demand. This would be the second time it cuts its production since October. This is according to a Bloomberg report. And the company is considering reportedly to cut its production of the 787 Dreamliner by anywhere between 2 and 10 planes a month. Shauna?
All right, Inez, thank you. Well, coming up, new details on how the coronavirus outbreak is helping trigger a rally for shares of Netflix. We got those details. Don't go away. We're checking the closing price of oil. Crude is tumbling off almost 3% on concerns, as concerns are growing over the deadly China virus. Now, investors are worried that the spread of the virus could undercut demand for oil. This comes as prices are already under pressure due to fears about a potential oversupply. Well, let's get to our next group of tickers. The spread of the coronavirus may give a boost for Netflix. Apple stock is getting a rare bearish recommendation, and Walmart is making a major announcement about pay for some of its employees. Well, first, let's get to Netflix. Now, the streaming giant is making gains, or it was moving higher earlier. Right now, it's relatively flat. Now, this comes after due to the coronavirus outbreak, according to the Wall Street firm MKM Partners. Now, the firm says that fears of a pandemic will cause more people to stay home and binge their favorite shows. Dan Roberts is here with me. And Dan, this is an interesting call because we know Netflix is not available in China, but they're more speaking about the Asia Pacific region overall.
They are, and parts of Asia are huge for Netflix, not China, but other parts of Asia. And Netflix often in the past few quarters when it has had to share troubling news and data about U.S. subscriber numbers, has been able to kind of say, well, look over here in Asia where we're growing very nicely. So that's what we're really talking about here. Under Armour is another example. You know, has seen big losses in the U.S., but has grown very nicely in Asian markets. So MKM Partners, I think, in part, was talking about Asia and surmising based on anecdata what was already happening, but also maybe a little bit was looking toward the future. And unfortunately, we hope it's not going to get worse, but if it does, suspecting that maybe more people, even in other countries, concerned about the virus, whether rightly or not, might stay in and watch more Netflix. Now, why it is specific to Asia as well is because, as your previous guest mentioned, this coronavirus outbreak is happening right before Chinese New Year, and those celebrations often involve going to movie theaters. That's a big thing around this time in China and parts of Asia, and so the thinking is that instead of going to movie theaters, they'll stay home and watch Netflix. It's a little bit of a stretch to me, but it is a stock a little bit like Tesla that can sometimes move based on just little kind of either assumptions or momentary trends. So we saw Netflix, this theory kind of first came out yesterday. We saw Netflix move a little more than 3% higher. Now, of course, as you mentioned, it's in the red. So for now, I think the effect of this, if it even was real, is done. But there are some interesting trends to look at with Netflix this week after the earnings report that disclosed that Netflix is under some pressure due to competition.
They are. And what's interesting, so we've had a bunch of analysts come out after their results were revealed and kind of had different takes. Now, Guggenheim Partners, they were out yesterday. They actually raised their price target on the stock, raised it up to $420 a share. They're bullish, obviously, about international subscribers.
Just what we're discussing.
The fact, though, that domestic subscribers is not meeting what the street was expecting, not meeting what Netflix even had been forecasting, how big of a concern do you think that is for the company going forward?
Well, I think it is certainly a concern. I think you can't brush it off anymore. Now, that said, Netflix is the incumbent in the streaming wars. I think that they have such a lead that they can stand to have a little bit of attrition, and they are going to have some attrition. Also, we've had some analysts come in here who are big bulls on Netflix saying they can even have losses because there's churn. There are people who are going to unsubscribe because they're distracted by the bells and whistles of the hot new thing. Ooh, Disney Plus. Oh, Hulu now. Hulu's owned by Disney, and all the FX shows are going to be on Hulu. You might see some people cancel one thing, subscribe to another thing, then they come back. It's all about what platform has the one or two or three shows that you feel you must watch.
Yeah.
And even with all the different players right now, that's still what I see happening in the streaming wars. And by the way, you know I love talking about this stuff. I think the streaming wars is the most fascinating story there is in business right now in any category because the spending is just insane, the spending war. But point being, every platform, every OTT app has made its name on one or two or three shows that people feel they must watch. So you could say, I'm done, I'm cutting Netflix because I want to do Disney Plus. But then if there's a new Netflix show and everyone's talking about it and it's the next Stranger Things, you'll come crawling back to Netflix.
Yeah.
Because that's how this streaming wars thing works. Each platform only has, or every show, every hit show is only on one platform. Now, when might that change? If we see a platform come out that bundles other platforms, a bundle of bundles. I don't think we'll see it yet, but it could happen.
Yeah, that would be interesting. And I think that would actually be really successful. I don't know how exactly that would work, but it would definitely be something that I think would have a lot of demand.
They'd have to get a nice cut. But it's like, you want to watch Maisel? You got to have Amazon Prime. You want to watch Handmaid's Tale? You have to pay for Hulu.
And
that's how
true.
it works. So.
It is. All right, well, we'll leave it there. A lot more to discuss on this. All right, Dan Roberts, thank you. Let's talk about two calls on Apple. We had Wedbush's Dan Ives. We actually talked to him this morning with Dan Roberts, saying that Apple is bound for a $400 per share. And then we also had Rosenblatt Securities, on the other hand. They're actually a bit bearish, noting that the tech giant's 5G expectations are too high. Dan Howley is back with me. And Dan, when we take a look at these two calls, totally different. One's a big bull, one's a bear on the stock. You cover it so closely. Which one do you think is the more likely scenario?
Ooh, that's a tough call for me. I think, you know, when you're looking at Apple right now, everybody is constantly talking about this 5G super cycle, and that's what Dan Ives is pointing to. He's mentioned it in previous notes as well, and other analysts have too. This is something that's been predicted, where 5G iPhones come out, and then we'll see Apple sell boatloads of them compared to previous generations. That's really all a super cycle is just a huge amount of iPhone sales. What we're seeing now is some of a pullback from that kind of strategy of thinking where, you know, we have this new bearish remarks. Now, prior to that, Nomura had released a note with similar bearish sentiments saying that maybe this 5G supercycle isn't going to exist. Maybe it's not really the 5G that's going to push the iPhone out the door, but features that come along with the new iPhone. And you kind of seen that with the iPhone 11. They introduced the new cameras on the back. That really made people go nuts, and so they went out and purchased these. They're selling a lot better than analysts had originally predicted because they were banking on people holding off on buying them for the 5G phone. And I think 5G to a lot of consumers is probably still this weird nebulous idea of what does it do for me? I already have 4G LTE. I can already stream movies on the bus or, from the back seat of the car. Why do I need something faster? And I think people don't really see the real benefit of what 5G will offer, and they might not until we get apps that take advantage of it. And that's where that sentiment is coming from, where you hear, well, maybe this super cycle won't occur. It's because consumers might not yet have a firm grasp of what 5G will do for them, so they might not necessarily go out and purchase these new iPhones in droves.
Yeah, Hallie, what was interesting was when we were talking to Dan Ives, he was saying that there's 925 million iPhones worldwide. And of that, from his perspective, he was saying that roughly 350 million of these iPhones are in the, quote, window of an upgrade opportunity. So I know you're saying that maybe 5G won't be enough to have some of these people who are in that window of an upgrade opportunity actually force them to upgrade their phones. But if there's any traction, maybe one or two cool new things, maybe that will be enough to get more people than some of the bears are expecting, getting them off and actually buying the new phones.
Yeah, and that's exactly the kind of scenario that the bears are looking at. The bulls will stick to the 5G commentary, and they very well could turn out to be correct on that. We're seeing 5G proliferate faster than we saw with 4G as far as the network rollouts go. It took a long time for us to get from 3G to the current ubiquity that we have with 4G LTE. It's still going to take a while to get the same level of ubiquity that we have from LTE from 5G. It's not going to happen overnight. It's probably going to happen in the next 2 or 3 years where we get true ubiquity from 5G. We still are dealing with the issue that there's two different types of 5G. There's what they call sub-6 gigahertz. That's the kind of 5G that will give us large areas of coverage at higher rates of speed than LTE. And then there's that millimeter wave that you hear. That's that super fast, insane 5G that's being advertised right now. So we have these two different levels. Will we have two different types of iPhones that work with two different ones? We don't know yet. We'll have to see in September.
All right, Dan Hallie, thank you. Let's move on to Walmart. It's boosting its starting wage to $12 per hour from $11 for some employees. This is according to a report by Bloomberg. Now, the bump in pay will apply to front-end employees, including cashiers and deli workers. Jared Blickery is here with me. And Jared, we can see the stock off just over 1% today. I'm not sure that that's exactly correlating with this story. But in terms of the larger impact that this could have on Walmart, how do you read that?
Well, this is part of 500 stores called the Great Workplace, kind of a test center for Walmart. And these are the lower end employees who would probably be out of high school, out of college. Front end means you're basically packaging groceries. That was my first job, by the way. It's not like Walmart is being nice here. This is a competitive workplace, not a lot of slack in the labor market. They have to attract talent on all different levels, even at the entry levels. And so this is what it is. And by the way, yeah, the stock being down over 1% today, don't read into that. The general market is having its worst day in over 3 months. We can look at a longer term chart. Here's a 1-year look at Walmart, up 16%, so underperforming the general market. S&P is up close to 30%, at least the high 20s. And then we always talk about Amazon as well, its e-commerce competitor. And here's the same over the last year. We can see Walmart's up 16, Amazon is up 12%. Both have kind of underperformed and languished here. We take a broader look, we can look at 5 years. And Amazon, that's when we see the outperformance, up nearly 500% versus Walmart's 30%, but still respectable.
All right, Jared Blickery, thank you. Well, coming up, how the U.S. being in near full employment is likely making this flu season far worse. The author of a new study joins us with details next. Welcome back to The Ticker. The Chinese government is restricting travel for about 40 million people as officials try to stop the coronavirus from spreading. Now, this comes as the CDC confirms a second case of the deadly virus here in the U.S. Joining us now is Eric Nesson. He's an associate professor of economics at Ball State University. And Eric, we're going to get to one of the studies that you specifically focused on here in just a second. But first, I just want to get your thoughts on the coronavirus, its potential impact on the global economy. How do you see that?
Well, certainly we see that there's a strong relationship between spreads of illnesses and trade. So I think certainly we all hope that this new outbreak is able to be contained and it doesn't have strong effects on our economy. And we certainly hope that all of those who are sick are able to get better.
Now, Eric, your study was pretty interesting because what you studied was how strong employment affects the flu rates and in terms of the correlation between the two. Break that down for us, and what exactly did you find in terms of the relationship between these two things?
Sure. So what we had come into the study thinking is that there are a lot of aspects of employment that seem to be conducive to the spread of communicable diseases. So if you're in an office with a lot of other people, there are a lot of shared surfaces that people touch. A lot of people are shaking hands. And if more people are working, then they're more likely to put their children in daycare. And all of these things aid the spread of the flu. So what we did was we collected data from the CDC on the prevalence of the flu in different states in different months. And we looked at the employment conditions in those same states. And what we find is that if employment improves in a state, then the next month we see a higher than expected increase in the prevalence of the flu.
Eric, we had Novavax's president of research and development. He joined the Ticker yesterday. We were talking about the flu, talking about the coronavirus. Let's hear what he said just in terms of how bad the flu could be this year and how bad it's been in previous years.
We have a very good seasonal vaccine that we're about to unblind, a phase 3 trial. And it's relevant to this topic because these are very similar proteins to what we have in our flu vaccine, and we need a better flu vaccine. And you may know this season's the last 5 seasons have been very bad flu seasons.
So, Eric, it sounds like that pretty much correlates to what you found in your studies as well.
Yeah, it's certainly consistent with what we find. We obviously, there are a lot of different factors that go into play with how severe a single flu season is. So, we can't say too much about this current flu season, but certainly across the flu seasons that we study, which is about 6 or 7 different flu seasons, we see that as employment gets stronger, the prevalence of the flu goes up. So the fact that we have a strong employment conditions right now, and this flu season is worse than expected, that's certainly consistent with what we find.
Eric, what sectors would you say are most at risk of this?
That's an interesting question. So one thing that we did was we looked at sectors that have higher than normal levels of interpersonal contact, and those turned out to be the retail and the healthcare sectors. And then we looked at sectors with very low levels of interpersonal contact, and that's manufacturing and construction. And what we found was when employment changes in the retail sector, we see that that's strongly related to the spread of the flu. And when employment changes in the manufacturing and construction sectors, that's not as related to the spread of the flu. So it certainly seems like, interpersonal contact in the workplace is definitely something that aids the spread of the flu and likely other communicable diseases as well.
All right, Eric Nesson, thanks so much for joining me today.
Oh, thank you very much.
Well, coming up, how the spread of false information on Twitter may be having negative consequences for the economy. Details on that next. Welcome back to The Ticker. Let's give you a quick recap of what we've covered in the show so far today. Our first ticker was American Express. It posted better than expected results in the fourth quarter, driven by significant growth in revenue from card fees, along with spending and lending. Second was Intel. It's hitting new highs after reporting strong results in its latest quarter. Despite warning about mounting competition in 2020, Intel boosted its forecast for the first quarter of this year. And our third ticker, Broadcom. It's signing a significant new agreement with Apple to supply it with wireless chips. Now, a slate of recent deals between the two companies could now be worth up to $15 billion for Broadcom. Well, it's time for our last tick of the day, and it's Twitter. A new study from MIT tracking the spread of news from 2006 to 2017 found false stories were 70% more likely to be retweeted than real ones. We have Dan Roberts, Jared Blickery, and Dan Howley all back here to weigh in. And Dan, this is interesting because it's data from MIT. Now UBS took this and put this in a note. They were analyzing what exactly this data means. And they were saying that the rise of social media is changing society, and therefore that means that it's changing the economics. What do you make of that argument?
Oh, you're talking to me. I thought you were talking to Dan. I think, broadly speaking, false stories are more interesting. And if you look at why people are clicking on things, it's probably because they haven't seen it before. It has an interesting angle. And you go back to the premise that robots aren't doing this. It's really the humans, because the robots are disseminating false and true stories at the same rate. You know, how does this affect the economics? I think it's really particular to social media companies. I don't know that it's affecting the entire economy, but it speaks as to what kind of information people want to convey in general. And it's something with a twist that they haven't seen. And unfortunately, it could be false.
Dan?
Yeah, you know, it's interesting, Shauna, because partially this shouldn't be surprising. Like, of course, salacious news and exaggerated headlines get spread more quickly and more zealously and with more interest and engagement than the often more mundane, less exciting real news. Now, of course, in the last couple of years, real news has at times been crazy enough and fascinating enough as it is. There's no need to make it fake. But I mean, Twitter and social media and the speed at which stuff goes around has just exacerbated the issue. But I'm not really surprised to see that the news headlines and tweets that spread the fastest is the incorrect stuff.
Dan Howley, do you think there's any way for Twitter to somehow regulate this, or do you think that they are responsible for this in any way?
I mean, they run the network where this kind of news or fake information is spreading, so of course they have responsibility for it. They're the ones that are making sure we're helping it along. I think the only way that they can really take charge of this is if they do something involving some form of machine learning that can help them find and pinpoint these types of instances, or have a combination of that and self-reporting. Obviously, they're trying to do it. Facebook is doing it to a degree, as well as Instagram, but it's something that's going to continue to be an issue, especially when you have these social networks with millions of users.
All right, guys, well, let's go beyond the ticker. Yahoo Finance's editor-in-chief, Andy Serwer, sat down with the Transportation Secretary, Elaine Chao. Now, the two spoke about regulation and the future of autonomous vehicles.
So in conjunction with the White House, I announced a report that we did at CES, and it basically puts forward certain principles, and very top line, we want to talk about safety and security. We want to ensure that innovation is not hampered, and also that whatever guidelines and policies that come from the federal government, that they are consistent, so that there's consistent policy emanating from all these different government entities. And I think that's really important, because the government's role is to create the environment through which innovation can flourish.
Dan Howley, how important or how necessary do you think federal regulation is for autonomous vehicles?
It's, frankly, something that is long overdue. This is something that many of the companies, in fact, all of them, have been asking for some kind of blanket federal regulation for self-driving cars. And the reason is, right now, they're going by a state-by-state basis. So they have to function in one state differently than they function in another. And if we did that with regular cars, it would be completely ridiculous. That's why if you have a car that's California certified for its exhaust, they just do it for every state, because it's just simply easier to do that way. They want something that blankets the entire U.S., allows them to test wherever they can, and this way we'll get self-driving cars much faster because they'll get the road experience that they might not get in Arizona, that they would see in Maine, for instance. This is something that is going to happen, should happen, and it's quite frankly ridiculous that it hasn't yet.
Jared, what do you think the timeline is on this? Because as Dan Halley just kind of alluded to, we've seen a back and forth as to when exactly we're going to see these on the road.
Long way out. You know, you hear about these deaths intermittently, and this spooks the public. So the public's going to take a few years to get used to this, maybe 10.
Dan Roberts, what do you think just in terms of the timeline?
I feel the same way as Jared. I still think it's very far away and that people have kind of been over exuberant. I know that it's coming eventually and that it's in testing stages with trucks, etc. But I don't love the idea of cars being on the road right now without a human driver at the wheel. I don't want to get into one yet. Maybe if the technology gets there, we'll see. But in terms of regulation, be careful what you wish for, because a lot of industries have said, hey, regulate us. We're ready for official regulation. And then sometimes it can be draconian and it can restrict innovation. So we'll see.
All right, well, we'll leave it there. Dan Halley, Dan Roberts, and Jared Blickery, thanks so much for joining the show today. One more quick look at the markets before we let you go. We're still seeing the Dow well off its lows of the day, actually, off just around 194 points. The S&P and the NASDAQ, both of those indexes off just around 1%. Well, gearing up for the last hour of trading, KeyBank raised its price target on Facebook ahead of the tech giant's earnings next week. We have the final round, breaking it down next.
Hello, everyone. I'm Jen Rogers in New York, and this is the final round. Stocks rolling over as the second U.S. case of the deadly coronavirus is confirmed.
Miles, other stocks now on pace for their first weekly loss of the year as virus concerns overshadow better than expected earnings on Wall Street. We'll have more on all the market action coming up in just a bit.
Plus, Wall Street turns bullish on big tech names ahead of earnings next week. It's our call of the day. And the latest FICO changes putting your credit score in danger. We're breaking down all the implications coming up. Plus, Tinder's latest safety push. We're talking to the company making it all happen. With us now, Yahoo Finance's Heidi Chung to talk about all of today's market action. We are off the lows of the session, but still in the red after the CDC confirms a second case of coronavirus in the United States. Stocks on pace for the first weekly loss of 2020. All S&P sectors in the red. Most Dow components in the red. We've got J.P. Morgan, Merck, Dow Inc. seeing the biggest declines. And turning to the NASDAQ, the NASDAQ hitting a record high today before turning negative. We've got Skyworks, American Airlines, and Trip.com Group all lower there. Interesting thing here is I think we could be on track to lose our streak of days where we haven't moved 1%.
We had it earlier.
Right?
October 8th, the last time we moved more than 1%.
So this could be it.
Could be it.
We're on watch to break that streak. I mean, we've been noting it, that we've had sort of this lull in activity. Today certainly seems to be a little bit of a different move. We're also seeing a move in yields here, a little bit of a flight to safety, gold up here.
Yeah, I mean, I think a lot of things in play just in terms of every consensus call that said we expect higher volatility in 2020 gets to be right.
Today.
We're above 15. Today we get to be correct. And I think coming on the Friday after Davos wraps up, and this is my own pet thing, right? But we do have a chance to see Davos once again be a great contra, right? I mean, cash is trash on Tuesday, melt-ups in this market, and here it is. The first time we lose ground this year on a weekly basis and our worst day in 3 months, right as the consensus comes together, does some skiing and says this is perfect.
And yet again, it's something that you can't predict. I think coronavirus coming sort of out of the blue somewhat. What we're seeing today is a lot of action in names that, like the airlines, just
Groups, exactly.
watching those companies, watching the hotels. I mean, talking about the impact of Disney, Starbucks. I mean, big cap, blue chip American companies sort of taking a hit on that today.
Right.
A one-day little blip here, the people getting a little nervous, or is this something we've got to keep watching?
I think we definitely have to keep watching. I mean, a pullback is going to happen, right? So stocks taking a bit of a breather. I don't think people are too concerned there. We hadn't had these kinds of pullbacks a lot last year, right? So this was sort of expected. But like you mentioned, a lot of the groups that are under a lot of pressure today, the hospitality groups, the restaurants, a lot of multinationals that have exposure overseas in the Asia Pacific region. That being said, I think a lot of people are sort of still waiting to see what happens because it's too early to assess the economic impact, right? No one knows how much this is going to shave off of China's GDP. That all remains to be seen. And I think it was a little bit of good news yesterday when we had the World Health Organization say that they weren't going to make this a huge, huge thing so far. So I think we still have to wait and see.
And remember, like anything that inverts the VIX board is that, right?
I wrote it down right here. It's exciting.
I mean, but that's the whole thing, right? I mean, when you have second month VIX futures trading ahead of front month VIX futures into a weekend, that's the bad thing. So it can be coronavirus, it could be literally anything else you make up. The only thing that matters is if that trigger is in place. That's certainly something to watch. All right, for more on today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
Miles, a turnaround for Boeing stock today. Boeing up more than 2% right now after a Reuters headline just dropped saying that the FAA chief, Steve Dickson, said that he's pleased with the progress that Boeing has been making, and approval for the MAX, according to this report, could come before mid-year. You'll remember that earlier this week, Boeing had touched a 52-week low after it said that it was expecting the ungrounding of the MAX to happen around mid-2020. Well, now, according to this report, the Reuters report, Steve Dickson, the chief of the FAA, saying that the approval could come before mid-year. So you're looking at Boeing that's now up more than 2%, flipped into the green on that news. Meanwhile, we're also watching another Dow component, Intel. Intel has been the best Dow component today, reaching new highs after a strong, better than expected earnings report. And then Amex also today was seeing a pop, one of the second best on the Dow today, after beating on the top and the bottom line for its latest earnings.
All right, Inez Ferre live on the floor of the New York Stock Exchange.
So business is taking action in the midst of the deadly coronavirus in China. McDonald's has suspended business in 5 cities throughout China's Hubei province, while Walt Disney's Shanghai Disney Resort will be closed until further notice, all due to the coronavirus outbreak. And just breaking in the last hour, Starbucks saying that it has closed stores in some locations in China, then it's working closely with the local health authorities. So we first saw news of the virus affect airline stocks. We've been talking about that. That's been happening all week. Look, now this spilling over into the travel companies, McDonald's, Disney. Do we have all the companies? Starbucks. Heidi's, her trip has been canceled.
I know.
She's not even going to China. She was going through China.
I was supposed to transfer at Wuhan. That is no longer happening. They canceled that leg of the flight, so I have to reroute myself. I think I'm going to try to fly a totally different airline, so I'm not even going near that region to begin with. I mean, better safe than sorry, right? But yeah, McDonald's actually closing down several of its stores in 5 different areas, and that's, of course, because they're trying to be cautious here. They want to make sure they're keeping their employees safe. They don't want to endanger them. I reached out to them actually for some commentary on this, and I was surprised that they even got back to me, given that it is the Lunar New Year holiday, and I know a lot of people aren't working, but they said in a statement, quote, "Since January 24th, we have suspended our business temporarily in Wuhan and its surrounding cities where local public transportation system is suspended. Staff and customer safety is our first priority, and we have comprehensive precautious measures being implemented to all restaurant operations and office staff." Now, as of the end of 2018, McDonald's had 3,000 stores in all of China. That compares to over 13,000 stores here in the US. Now, this is just a small percentage of McDonald's stores, so as investors, I don't think it's time to hit the panic button. I don't think you need to sell here. But that being said, it's very concerning because, you know, we had the SARS outbreak in 2002, 2003, and if that's any indication, it did definitely hit the top and bottom lines for the company. But then again, these companies also rebounded very quickly afterwards. So right now, this doesn't seem like this epidemic is as severe as SARS yet. But of course, that remains to be seen, and it'll be interesting to see how these companies sort of deal with that. And we have McDonald's reporting on Wednesday, so I'm sure analysts will be getting a lot of questions in about it.
Roots are green, though. It's fine.
What's green?
Utilities are green.
Utilities are green.
Yeah.
All right.
I feel better already.
You're good with that? I mean, so what is the, look, there's the whole human element of that, and that's, you know, look, we get that.
It's bad.
That's bad. What's the upside, though? Yesterday we were talking about Netflix. We've had the biotechs.
Yeah, sure.
Look, no, I mean, it's...
biotech stocks have been rallying sharply today, and I think that is something that you would absolutely expect in this kind of instance.
Yeah, I mean, there is a flip side to every story. Whenever there's a situation, there are ramifications.
Specifically, when we talk about the restaurants, though people are fearful about dining in, that means it gives a boost to delivery. So that's also another aspect to think about.
Do you know what always happens? Also, the birth of kids goes up about 9 months
People
later.
People are staying in.
People are staying in. So that always happens too. So I don't know, maybe there's a trade on that. I give you that to ponder as well. But so the airlines, I mean, it's like, is there anything that we really haven't touched yet? I don't think so, because we're already getting to the global growth trade with, you know, treasuries and copper's down 7 days.
That's what I was going to say.
We touched on that.
I mean, I think that's sort of the most interesting part of this, just in the sense that while we can all kind of look at the charts, and as we did yesterday, right? Yeah. What happens when there's a virus? Well, stocks go down very slightly, and things, the risk-off trade happens very quickly, and then we move on, and that's all fine and well, and you know, we can speculate on how long that really lasts, but it's something to note just to see a flattening of the yield curve, to see a rally at the long end, heading into a Fed meeting next week. I don't expect that the Fed is going to be building this into their framework, as it were, but you know, the job of the bond market is to always worry about what's the worst case scenario. Certainly this is not great. There are plenty of risks associated with the outbreak of a virus that's now on at least, 4 continents, right? North America, Europe. Asia. I don't know if it's been confirmed in Africa or not, but at least 3 continents we have this virus. So certainly there's some global concern there, but it's always difficult to say how much should one be reworking their view. I mean, a 6 basis point move in the 10-year is not nothing, but the moves in the 10-year have gotten larger. So.
It was interesting. Rick Newman was here yesterday just talking about the China supply chain. And it now having been through...
They're building a hospital. Did you see this?
They're building a hospital in a day. I mean, there's all those factors in there. But that we've now been through the trade war for 18 months. And we've dealt with disruptions before. Companies have kind of figured out how to manipulate that. There's the pictures we just saw with all the tractors there trying to build this 1,000-seat hospital over the weekend, try and get it up by Monday. I mean, you wonder how Tesla went from shovel to car in a year. They're going to get this hospital together in record time.
But to your point,
Go grocery shopping.
There have been a lot of situations that a lot of companies have had to face, and it'll be interesting to see what these companies do in the face of this kind of virus.
All right, coming up here, one Wall Street firm turning bullish on big tech right ahead of earnings coming up next week. Why KeyBank is betting on Alphabet and Facebook. We're back with that right after this, but first take a look at where European markets settled on this Friday.
Now, here are some stocks we are watching right now. DirecTV, after the company revealed that its Boeing-built satellite may explode in orbit after suffering major damage to its batteries in December.
And even the Boeing adjacent news is bad.
Yeah, it's like, it's just, that was a Mad Libs of.
That's great.
Yeah. JP Morgan, after the bank revealed it paid CEO Jamie Dimon $31.5 million for his work in 2019. That includes $6.5 million in cash, including salary and bonus, and $25 million in stock grants.
At that level, a lot of people just live off the bonus, but you can do a lot with $6.5 million cash.
Yeah, well,
really, it's more like 3.5.
You know what you can do? I was going to say you can pay a lot of taxes, right off. $6.5 million cash is like, that's $3 million. Probably had to think about how much he has to pay to even file his taxes. His accountant.
Yeah, but he still has $3 million left over. It's like
no tears for
so
Jamie
much money.
No tears.
So much money.
No tears. Broadcom, after the chip maker struck a deal with Apple to supply wireless components for the company's products through 2023 in a transaction estimated to be worth $15 billion. And General Electric, after the FDA warned hospitals and healthcare providers that a third-party cybersecurity firm identified flaws in some of the company's medical products. Kind of scary.
All right, time now for our call of the day. Today we got KeyBank out raising some price targets on big tech names, specifically Facebook and Google's parent company Alphabet. We're just going to call it Google from now on. I really hope that in 2 weeks, Sundar Pichai comes out and says, all right, I run the whole place now. It's all called Google. Anyway, let's go to earnings next week. Facebook results, they are due out on Wednesday. KeyBank expects solid ad spending across major internet platforms in the fourth quarter, as well as solid top-line performance across the space, specifically here calling out commerce opportunities both for Facebook and for Google. And I can't help but read these as maybe a negative for Amazon.
Ooh, a negative for
Really?
Amazon. Why?
Yeah, why?
Well, I mean, new products in Facebook and Google should help enable the trend of increasing commerce, like direct commerce from users on Facebook buying stuff, users on Google. If you've gone to Google search recently, it's all ads now.
Yeah. It is.
So if those companies are going in for a slice of the e-commerce experience, which we have discussed has gotten increasingly messy, even with Amazon, and I mean, remember, the retail business is like kind of Amazon's fine running at zero margins, but you sort of just wonder, like, are they ceding some ground to Facebook and Google that are looking at opportunities outside of advertising and saying, well, we already own the entire ad pie between the two of us. What else can we do?
It's
That's my
interesting.
view.
I hadn't thought about that at all because I buy completely different things. Since this is a show just where I discuss what I do.
That's correct.
I'm shocked, but I buy completely different things when I'm on Instagram than I'm buying on Amazon.
You've actually
and I'm not
purchased through
getting.
Instagram.
I'm not getting that's clothes and shoes or things like that. I'm not getting fed any ads for, I don't know, dog
Essentials?
food or buying
Not yet.
a calculator, but maybe I will. And I guess so. Maybe you're right on that because the key point that I actually took away from here is in the Facebook part of this note, and that they are really increasing publisher automation systems, and as that relates to the success of stories. So the story that we tell ourselves and we hear a lot is, well, they took stories from Snap and they put it in, and now they've got all this traction. And it's just like a fun part where they're really having a lot of engagement. They're putting some ads in there, but I don't think we really appreciate, and this note kind of drove it home, how sophisticated they are becoming across their different platforms, Facebook to Instagram, and giving those tools to advertisers. That it's not just like, oh, throw an ad in the middle of stories. It's, okay, how do we get in your feed, we got in your story, we're also putting you on Facebook, but we don't want to overwhelm you. It's like there's a lot of tools that they've figured out how to drive.
You know, it's interesting that there's no mention of the headwinds that these companies face from Washington at all. Nothing about the election, nothing about anything.
Didn't fit in the Excel model.
Yeah.
But I was like, there's not even one line in here that mentions that. And that's, I mean, it's 2020. It's an election year. It's going to be a big year.
Yeah.
I feel like they're not concerned at all. Wall Street just doesn't care at all. Investors don't seem to care. At the end of the day, their ad revenue is good. Their ad impressions are strong. So I guess the momentum keeps going from here, right?
They can grow the top line. I mean, I don't envy this having to put Twitter in this note. That was the only other.
Right.
That was really,
it's one of these things that's doing its own thing, and that's Twitter.
And it's not doing as well.
It's not doing it. He's not, Andy Hargreaves is not as optimistic on Twitter. Says, it appears.
Which, speaking of 2020.
Rich relative.
Like that's a pure 2020 trade, right? Everything that happens politically really happens on Twitter these days. But I mean, just thinking about where Facebook fits in that stack of how you reach advertisers. Jen had me thinking about our conversation in the meeting this morning, which was our conversation about Evan Spiegel's take on the way everything fits together. Did you see this, Heidi?
No, I didn't. I missed it.
He was asked at a conference about TikTok.
Okay.
And he ended up sketching out this worldview of it's basically a pyramid of social networks as Spiegel sees it. And Snap's at the bottom because it's us talking, right? That's what Snap is for, talking to each other. I guess it's a camera company, but it's a text app company. So everyone can do that, that's fine. Instagram and Facebook are in the middle of this pyramid, middle of the stack, where it's all about commerce. It's about being an influencer. It's about performing a self, right? That's what advertisers are after. And then the top is TikTok, where you have to have a certain amount of talent, and you have to get it in a kind of a way you don't have to on Instagram. And I think Facebook wants it to be that way because, to your point, Jen, they're dealing with corporate B2B partners. They're dealing with big companies like Yahoo Finance or others who we're never going to be cool. We're never going to get it in a way that a TikTok kind of influencer would get it. We just want to have advertisements that are strategically placed so that we can have an ROI for our partners, right? That's what Facebook wants to enable. That's where I think the street sees the opportunity. And I think it's just interesting that Facebook may end up finally ceding ground to someone, and it might be TikTok because they just don't have a tool set for combating that.
Yeah, he's more bullish on TikTok.
Absolutely, yeah.
Spiegel is.
I think he's
a lot of sense.
I think he's bullish on it like as a pure network.
Yeah.
Right? Because like maybe the business, we could argue about what has the best business upside and whatnot, but like the network of what TikTok does is really strong and I think has a pretty big moat.
And so far,
as they would say,
they don't need to spend that much on hiring people. That's pressuring their margins.
Right.
Which Facebook, we're going to get more data on that next week with earnings.
You know who works at TikTok is like the whole Chinese government works at TikTok.
So the margin pressure is not so bad.
There you
Although the margin outlook, they do believe is going to remain consistent at KeyBank. Coming up, are you retirement ready? Why you shouldn't stop saving even after you retire. But first, let's take a look at today's trending tickers on Yahoo Finance. Now it's time for our retirement segment brought to you by Fidelity Investments. We're always discussing ways to save up and make sure we hit our retirement goals. But what if you've done all the hard work and you are happily retired? Does that mean you are done? Joining us now is Smart Assets VP of Content and Financial Education, A.J. Smith. So I want to make sure I understand this, because when we teased it, it was like, you still have to save. But what do you save because you're retired or not making any money? You still want people to save even when they don't have a job?
You know, I think the key is to think about it holistically. Your retirement plan isn't just the leading up to retirement and then I'm done, I can spend, I don't need to worry about my budget, I don't need to worry about things. You know, I think the key is to really have that be a built-in part of your plan, and to remember that retirement is long. The average U.S. retirement is 18 years. That's a long time to plan for, and that's a long time to still be kind of thinking about your money, thinking about if you have any income coming in, and prioritizing how you're spending that money.
So from an investment standpoint, I think the generic way that we would all frame it is you take more risk when you're younger, and then you take less risk as you approach retirement. But are you saying that instead of viewing 67 or whatever as the cutoff date, it's more like you can maybe begin ramping down at 67, and you need to find a way to make it to 87, because realistically, if you're in good health, you should expect to get to your 80s at this point.
Absolutely. You know, I think you should think of it as kind of that spectrum, and this isn't the end point. This isn't the take everything out and put it in cash moment. This is kind of, start ramping down. You still probably want some of your money in stocks still at 67, 66 years old. that 18 years, it's a long time. And for some people, it's more like 18 to 30 years. So it is a long time period.
Do you think we're too, I guess then, are we too conservative, like as an industry perhaps, discussing strategies for saving for retirement, right? Do we not view the retirement age as a long enough time scale? Like really it's your whole life, not just like the 40 years you work.
The first 40 of work. Yeah, exactly. I think in the past we have been. I think that's changing. I think people are starting to think about that and realizing how long that is and how they really need to factor that in as well. And I think it really depends on your situation as well. I mean, some people will still have some income coming in. Some people will have pensions. Some will just have Social Security. It really depends on your situation. It depends, and it's important to know what your individual situation looks like.
So for the people that are like a year or two out from retirement and they're looking to start changing their investments, how early should they be doing that, and how should they be investing at that point?
Yeah, well, hopefully it's been a part of the plan. Hopefully it isn't just this one moment where you're suddenly making a ton of changes. Hopefully it's part of the plan that you're thinking about it throughout even your working years as you get closer. Hopefully it's something you examine on a yearly basis. What do you want your retirement to look like? How are you getting there? What are you living off of? And probably it involves talking to some experts as well for the average person.
So you had a couple of ideas that stood out to me that I feel like some of them I've heard before. So just live off the interest. Okay, sure, that'd be great if I have enough. Cover the basics. I get that. But what I really liked is this bucket idea.
Yeah.
Can you run that down for us, how it would work? Because it kind of made sense to me, like if I got to spend that first bucket,
absolutely,
but I would know what my budget was, right?
Right. I mean, I think, interest only is like everyone's dream, right? You have enough money that it's just sitting there and you're living off that. You never even touch your nest egg. It's what you get to give to your heirs, or it's what you get to spend on one final hurrah of, a cruise around the world or something like that, right? We'd love to do that. But I think, the bucket approach can be helpful because it really does split your savings. It's more of kind of how you think about that spectrum of your retirement into a beginning, a middle, and end. And one thing that we do see is that, people start to get freaked out in that first year or two that they're spending too much too quickly. But really, that's when you're still likely on the healthier side. That's when you should be taking maybe some trips and some of those things you've been waiting for. It may be okay that you're going to spend a little more in the beginning. Chances are you're not going to be taking those trips at the end. You may have higher healthcare costs, so you need to be kind of balancing that out. But it really does allow you to kind of think of your retirement in 3 different sections or buckets.
And then where does Social Security fit into all this? Because so often our conversations assume that Social Security does not exist, except it actually still does.
Right. It does, and is it going to exist as it currently is? That's a question for all of us, right? But I think, the best strategy, of course, is to plan for if it's not going to be there. But it's probably realistic to have a few different scenarios. And that's probably how we should all be thinking about our retirement. What am I comfortable with factoring in? And, what if I had 100% of what I would expect to get now? If you're 40 years away, maybe that's less likely. Maybe it's more likely that there's going to be some changes. But have a plan for kind of different versions of Social Security.
All right. We're all aiming for the interest-only approach.
That's right. Or Social Security. I think we're all going to get 100% of Social Security. I think the notion that we have to change it is ridiculous. There's no constituency out there that says, except people who are about to die, that think they should cut Social Security.
I just worry, is it going to be enough? That's all.
Well, let's think about what you can control, right? What you can control is everything but Social Security.
Yeah. Here's how it becomes enough. They print the money.
Yeah.
Then it's enough.
I don't think it's enough right now for people.
Right, so Jay Powell is going to have to call up, say, hey, we need more money, and then they're going to print the money.
Yeah.
When Brian Chung is Fed chair, he will make sure there's enough.
I hope Brian Chung is Fed chair. I will be so happy. AJ Smith, Vice President of Content and Financial Education at Smart Asset. Great to see you.
Great to see you. Thanks for having me.
All right, coming up here on the final round, Super Bowl just about 1 week away. Why fans should expect record-breaking ticket prices for this year's matchup between the Chiefs and the Niners. But first, take a look at some of the most active tickers during today's trading session. back to the final round here on Yahoo Finance. Miles Lithman with you in New York. I'm joined as always by my co-host Jen Rogers. Also stopping by on this Friday is Yahoo Finance's Heidi Chung. 28 minutes to go in the session. Let's take a look at where we stand right now. All three majors are lower on the session. The S&P right now off just less than 1%. We have not seen a 1% decline for the benchmark index since October the 8th. For more on today's market action, let's go to the floor of the New York Stock Exchange where we find Inez Ferre. Inez.
And Miles, this week, oil has been under pressure over the concerns of the coronavirus and oil demand in China. So you're looking at WTI, which today was off by more than 2% for this whole week. WTI lost more than 7% for the week. Also, Brent down more than 6% this entire week. This is, of course, over fears of the coronavirus. And also, that has put pressure on the airline stocks. Now, the airline stocks did move off their session lows, but you're still looking at Delta Airlines, which is in the red, also American in the red, and United. United Airlines executives during their earnings call this week had talked about the coronavirus, saying that United was in contact with the CDC, making sure that they're on top of everything, and also as far as safety measures and screening measures are concerned. And then just taking a look at some of the China stocks, like Luckin Coffee. Luckin Coffee has been under pressure today. This is the competitor to Starbucks in China. They have more than 4,000 shops in China, and a lot of them focus on delivery and pickup. And also, Starbucks today said that they have been closing some shops in China in some areas, and that they're working very closely with local authorities. Miles, Jen.
All right, Inez Ferre live on the floor of the New York Stock Exchange.
Fans of the Kansas City Chiefs and San Francisco 49ers are expected to spend a record-breaking amount to score a ticket to this year's Super Bowl. Yahoo Finance's Dan Roberts sat down with TickPick CEO Brett Goldberg to see just how much fans are willing to spend on the big game. Take a listen.
It's the most expensive we've ever seen. So even before the teams were announced, it was the highest average, it was the highest get-in price. And typically what we see once the teams get announced, a lot of sales happen and then prices start to decrease. This time, we've not seen any decrease yet, so it's historical highs right now.
Yeah, we have a chart that you guys sent us that we can pull up here, seeing that the prices right now are the highest they've been at this point, but this point being a little over a week before the game. And I know that over the years, when we've talked, you always tell me that it's sort of about how much risk you're willing to take. Like, if you want to go to this game right now, if you're willing to take the kind of scary risk of buying your plane ticket, buying your hotel, but not buying your ticket to the game, am I right in remembering the tickets usually get very affordable like the day before or even the day of? But how risky is that to play that game?
So every year changes. It used to be a very clear trend that prices came down as the game approached, and sometimes the day of game would be the best. Last year, I think because the Pats fan base who knows this kind of trend, everyone started buying late Saturday, and Sunday morning prices actually popped and increased. So the trend is kind of broken now, but the trend of still going to the Super Bowl location with your hotel booked, airfare, and no ticket is here to stay. Last year we saw about 20 to 25% of our sales happen day of.
Wow. And talk to me a little bit about the behind-the-scenes backroom dealings, because I know that it can get very complicated with you guys. I know you go and you set up, you're on the ground there, but there are all these people buying day of. They mostly have to pick it up in person. I know that there's the rise of mobile tickets and everything, but for something like the Super Bowl, people want their ticket in person so that they know it's real, but also there's sort of the commemorative collector's aspect. Just remind viewers how that process works, because it's kind of fascinating and wonky.
Yeah, there's a lot moving around. So Miami is a unique city where the stadium is not quite near the downtown. So unlike Atlanta, we had one location for 4 days. Everyone's picking up the tickets in the same spot. We have a location Thursday through Saturday that's in the downtown near the NFL kind of center. And then game day, we go up to the stadium, and then we have a location where we've rented out the closest commercial location to the stadium. So there's pretty clear instructions that customers will get, depending when you buy the tickets and when you want to pick them will dictate where you have to pick them up. So there's a lot, whether you're buying them on TickPick or somewhere else, you've got to really know what you're doing. So if you buy them on Friday, you'll be able to pick them up on Saturday and it'll be smooth and easy. If you're waiting until game day, there's a lot of moving pieces there.
It's like, how late do you want to push it?
Yeah.
We showed that chart I love that shows where prices are right now. And obviously, when you look at this chart, the 2015 line just stands out like a sore thumb. Can you remind us what happened in 2015? Why was that such an anomaly year with prices?
That was the Seahawks-Pats game, and the demand side was stronger than ever. So for the Seattle Seahawks fans, they were able to drive to that game. It was so close. The way I was told is the way Florida is for New Yorkers, Arizona is for Seattle. And so people drove there. They had a family to stay with. Prices also were at relative, I don't want to say historic lows, but incredibly low prices get in. So many people were able to buy in advance. So the buying was there, and then ultimately the supply was no longer there, and prices ended up kind of popping up.
That was the one Super Bowl I went to. Good result with the Malcolm Butler interception in the end zone. Let me ask you this. What do you think is going to happen for this year right before the game? I mean, if there are people watching this who are tempted to go, thinking about going, they haven't committed yet, what strategies do you suggest?
I personally probably would not wait till the last day. Counter to what most people in my office, I think the last day will be the best price this year. I think because of how hard it is to get to the stadium, there's just not going to be that kind of same surge that we had last year. I think Saturday you'll end up seeing a spike because that pressure will be there. So I believe there'll be a lot of inventory that will come on the market in the next 4 days, give or take. So I think Tuesday, Wednesday, Thursday will be that sweet spot to buy. Pricing will come down because of the influx of inventory. I think then you'll have a ride pop back up from kind of that demand and everyone kind of there on site buying. And I think Friday, Saturday will start kind of getting scary. And then Sunday morning, people, at that point, it's like, hey, am I going to start going towards the stadium and deciding if I'm going to buy or not buy?
Right.
All right, coming up here on the final round, our next guest says, buckle your seatbelts for a bumpy year ahead. Wealthwise Financial's Laureen Gilbert on how you can survive and profit from the coming volatility. And as we go to break, check out some of the stocks making new 52-week highs during today's session. All right, let's take a look at some of today's winners and losers in the stock market. Stocks in the red include JP Morgan, bank trading lower with financials broadly. JP revealing that CEO Jamie Dimon earned $31.5 million for his work in 2019. That includes $6.5 million in cash and $25 million in stock. Let's take a look at shares of Sonos under pressure here. CEO Patrick Spence announcing that certain older products would lose software support this coming May. Then Spence walked back those statements, saying the products would work past May, issuing an apology on behalf of the company in a blog post saying, "We did not hear you." Now they do.
I was fascinated by the stories.
Were you upset to find out?
When I first got the email, I thought, oh, how could they do this? This is terrible. But then I also thought, of course, everybody does this. This is what Apple does. My computer, I can't do updates to, and that's just what business is. But Sonos realizing, I guess, that they, need to treat their customers differently. So I don't know, they're a different kind of company. No more planned obsolescence there. Stocks in the green right now. Check out American Express after the credit card company reported better than expected revenue for the fourth quarter. Broadcom shares popping after the chip maker struck a deal with Apple to supply wireless components for the company's products through 2023 in a transaction estimated to be worth $15 billion.
All right, well, the S&P could be looking at its first 1% move since October 2019. So should investors be prepared for even more volatility in the months and weeks ahead? Lorene Gilbert is the president of Wealthwise Financial, and she joins us now to discuss. So we have heard, Lorene, from yourself and many others, they expected more volatility in 2020 than we saw in 2019. Is today's kind of market action what you expect to see a lot more of, or is there something in the news flow and how the markets behave today that makes you change your view one way or another?
Well, I think the short-term volatility that we're experiencing right now, a lot of that has to do with the coronavirus and concerns about that globally. Certainly, we're in a late cycle of this bull market run, and we would say in a late cycle, we expect to see more volatility. And we're in an election year. So I think as we get closer and closer to that election, we will see some volatility in the markets. We would also say that that's a buying opportunity because overall we see no recession in sight, and this should be a good year for the markets.
It's kind of funny because politics is really all around us right now. It looks like Lorene might have dropped off there. And, to your point earlier, we were talking about, when we're talking about Twitter and Facebook, people are ignoring the regulatory challenges there. Yeah. It didn't even come up in the Twitter note, politics. Yeah. And sometimes, look, the impeachment's going on, and we're not paying attention to that. The market's not paying attention to that. Are we a little bit complacent when it comes to politics? Looks like we've got Lorene back. So, Lorene, are we a little complacent right now on the political front? Do you think investors are kind of forgetting that this can be a market-moving event?
It certainly is, because when you look at the political rivals, we're looking at two very different scenarios for the U.S. economy and the markets. And I think as we get closer to seeing who's going to be on that Democratic side of the ticket, then we may see some volatility around the markets, concerns around the financial sector, concerns around technology and looking at monopolies, those kinds of things. So yes, right now I would say there's complacency, but as we get further down the road, I think we're going to see these two very different pictures.
Hi, Lorene, it's Heidi here. I just want to get your thoughts really quickly on small caps. It's been a part of the conversation a lot just beginning this year. We've seen a lot of underperformance from the small caps, but a lot of folks out there saying that maybe 2020 is the year for small caps to sort of shine. Do you think investors should start taking a look at the small caps here?
Well, we're actually saying we think it's a time to go upward in capitalization and move more towards large cap stocks. And that's somewhat of a late cycle defensive position. Certainly, there could be some opportunities in small cap stocks, especially that now we have a phase one trade deal and there's less uncertainty. So there are some opportunities there. But we would say for investors to think about moving upward in capitalization towards the large cap sector. So we've seen quite a bit of momentum. If we look at the $1 trillion club, and some of those stocks that now have $1 trillion in market capitalization, those are some of our momentum movers that we're seeing move forward.
And then in terms of international stocks, been a very hot trade or hot recommendation, I guess I should say, in the last few months, people liking a larger allocation to international markets. What are your thoughts there, and what are you seeing in terms of that thesis?
So we would agree that investors need to increase their exposure internationally. And the reason they haven't is that there hasn't been movement in the international arena. So investors have shied away from that. Plus, we tend to focus in the United States on our own companies within our borders. But if we look at diversifying a portfolio and where the opportunities are right now, from if we look at 20-year averages and where we see some opportunities trading at a discount to those 20-year averages, we would say look internationally, especially in the area of emerging markets over what I would say would be developed markets internationally.
Lorene, let's talk a little bit about the different sectors. Utilities continuing to be a strong performer, though, but you say it's not a sector that you're looking at here.
Well, both technology and utilities have been on a tear. And so certainly they've done well. But when we look forward from where we are today and we look at utilities and their relative valuations, we would say that they're pretty frothy right now. And we think there are other opportunities that might be better. Areas that I would look at, one area would be industrials, that we see the next big legislative push will be around infrastructure. And with infrastructure, that should bode well for the infrastructure sector, as well as that we do have that phase 1 trade deal, which also will help with the industrial.
Do you think there's any chance on the industrials that it's just we're like waiting for Godot? I mean, it's infrastructure week all the time, and nothing actually seems to happen. Why would 2020 be the year that something will get off the ground?
Yeah, well, sometimes it's better to be early than be late. We saw that before last year. We were talking about healthcare all year. We still like healthcare as a sector. It might underperform for a while, but if you're in it and we see that opportunity coming around, we'd rather be early.
All right, Lorene Gilbert is the president at WealthWise Financial. Thanks so much for joining us.
Thank you.
And Heidi Chung.
It's time to say goodbye.
Have a great evening.
Have a good weekend.
We should sing that Boys to Men song when you leave.
You should do it.
No.
We'll do it in the break.
I won't be doing that. I won't be doing that.
Now I'm going to have it in my head. Coming up, well, we've got the closing bell on Wall Street, less than 10 minutes away. First, so we're going to get technical. We've got Jared Blickery at the Wi-Fi interactive touchscreen. Will we see falling iguanas this time around? We'll find out after the break.
All right, 9 minutes to go in today's trading session. Jared Blickery joins me now at the Wi-Fi interactive touchscreen. Jared, we're looking right now at the S&P 500, a 1% decline. The first time, if we close here, we'll see that since October 8th, 2019.
Yeah, hard to believe. You know it's going to come sometime. We can see kind of get better a look here if we look at a candlestick chart. And so this really sticks out here. October 8th was this candle. I think it was this one down here. But are we going to fall back down to those levels? Most likely not. We got support right around 32.60 to 70. That comes in right about here. And then several other levels all the way down. I don't think this is going to go more than 4 or 5%. In fact, if it got to 4 or 5%, I might be surprised at that. This, I think, is going to blow over. There's going to be some scary headlines with respect to coronavirus. But overall, this should be over in a few weeks at the very most.
All right, so let's take a look at the VIX. Certainly a 15 handle now on the volatility index. You and I have been looking at this chart for a very long time, and you have noted the consistent downtrend we've seen from this high back in August. That was sort of the peak tension around trade, around what was going to happen there. You can see the October sell-off, and then we've seen this crush in vol. Does today's relative breakout in the VIX say anything to you that changes the thesis on vol continuing to get pressured lower?
Not exactly. So we stuck, and this isn't to scale, but as they say in, what was that movie about time travel? Oh yeah, something about the future.
Interstellar?
Back to it? No.
Back to the future? Sure, we'll go with that.
Anyway.
80s friendly show here.
Exactly. We'd have to close at or above about 1550, so we spiked above that. I don't think we're going to close at those levels. So this would technically be a buy signal. I don't know if you want to do that into the close on Friday, see what we do Monday, but this could continue to get squeezed in this triangle if we extended this all the way to the right until about May, potentially, but I don't think that's going to happen either. I think eventually we're going to get some news item. 15 is not an extremely elevated level on the VIX. Look at, in the 20s over there. So I think we're going to get some kind of spike next week, and that will be the bottom.
And as you see in today's chart, not even holding the top of today's range, so certainly not the strongest candle we've ever seen. Of course, all this action in the VIX, in the stock market, leads us to the Treasury market. We're seeing another bid in the 10-year, up about 6 basis points today. What stands out to you about this chart, if anything? Because we continue to see kind of this indecision, I think, on where the 10-year wants to go, what the 10-year wants to say about the global economy right now.
Exactly. So we've been tracking this consolidation, and this is a pennant, and we broke decisively to the downside through it this week, towards the beginning of the week, and we can see it accelerating. So this flight into bonds is causing the yield to go down here. I think it's going to continue. I think it has room to run, maybe test the 1.43 low that we saw last year, maybe even test the 1.33 low. All of this has investment implications. We're going to talk about this after the bell, but this is kind of like the beginning of last year. We saw deterioration in interest rates, at least on the long end, as they were coming down. So everybody was going into these growth stocks, momentum stocks, and at the same time, they were going into utilities and real estate plays because those were benefiting from lower long-term rates as well. Well, we're seeing the same thing here. If we look at the leaders, what's up today, we can see TLT, so that's because it's inverse to rates, but then we see low volatility. That would be the utilities and such, also the real estate stocks. Then we have momentum doing well, so that's part of the growth. Tech software, same plays as last year, except the difference is we have commodities declining. So if we go back to the major markets.
Yeah, we see copper having its worst day in 7 years.
Yeah, copper.
Worst week in 7 years.
Yeah, worst week. Crude oil, that has kind of fallen off of a cliff here. We can see that was a spike on the Iran news. And anytime we've had a spike like that going back over a year, it got sold off real quick, kind of like the Saudi Aramco attacks with the drones. So the commodity complex is taking a hit here. And guess what? We could even take a look at Bitcoin.
I was just going to ask. I was thinking, if we're going to talk about risk-on, risk-off trades, we always like to conclude this segment with just a check of the coins. What's happening in the real safe havens?
Yeah, so I actually haven't even checked Bitcoin today, if you can believe that. So we're going to take my first look. This is a 1-year chart, so this is going to be on a weekly basis. Let's actually get this down to a 6-month so we can see what happened today. And we can see that there's a little bit of a bid on it. So we had this breakout, and we finally we broke out above this trend line here. And when that happened, I said, I want to see how it reacts because there are so many false moves with Bitcoin. Well, it's actually handling itself quite well, not really selling off too much. It could come all the way down to the 8,000 level, maybe to this trend line here, but I do want to see that hold. I don't want to see closes below this. So constructive action overall. We'll take a look at Ethereum because that has been behaving pretty nicely too. This has its own negative trend line that it has broken out of. So Ethereum, haven't checked Litecoin in a while. We'll take a look at that.
Boy, this makes me feel old.
We used to talk about this
is
stuff
like
10
3
times
years
a
ago.
day.
It's 2017 vibes right here on the show.
Remember the crypto corner under the stairs, Jen?
That's right.
Oh, I was there.
And we got Ripple, kind of a similar story. So we could take a look at the heat map, which we haven't done quite yet. And we're going to see a lot of red, which we haven't seen in a long time. And I think the standout stock today is probably Boeing because we finally got some good news. You know, it was kind of breaking down here, and now it's on its way up again. So it might be a false breakdown.
All right, Jared Blicker at the Wi-Fi Interactive Touchscreen. We'll see you over at the desk in just a couple of minutes. On the other side of the break, we'll have the closing bell here on Wall Street. Plus, is your credit score in danger? CreditCards.com analyst Ted Rossman joins us to break down how the latest FICO changes could impact consumer lending. We'll be back with that conversation right after this break.
Welcome back to the final round. We're about 30 seconds away from the closing bell. I'm joined with Miles Udland and Jared Blicker here to watch the last bell and possibly the first day of action with a 1% move in the S&P 500 since before Halloween.
Ooh, scary, spooky.
Spooky, scary.
Not going to have it.
Really?
Here it comes.
Really not going to happen? Ugh.
That's good news. This is good news. We shouldn't be rooting for
Don't
this.
ruin my narrative.
But I'll tell you what, S&P is down 91 basis points. That's good enough for the lowest level since October 8th, even though it wasn't 1%. So, you know, your narrative isn't totally destroyed.
Okay. So it is the largest move we've seen since October 8th, but it's not larger than 1%.
Right.
Not the 1% move there at all.
It's more like the 99% move, Jen.
That's it. Off the lows of the session, I will also note utilities looking like it's going to pull out a small green arrow here. XLU up just marginally.
Yeah.
We are seeing
and record high in utilities, by the way. I mean, we've seen so many of those. The sector has just really broken out, responding to falling yields on the long end of the curve. Real estate kind of picking up again as well. And so we have this situation where we got tech rallying and utilities at the same time, which happened for about roughly 8 months last year, on and off, but roughly 8 months. And so that's what I was kind of talking about at the touch screen. It's that weird situation where you have defensives and the growth names rallying once again. And it took, as a catalyst, it took the coronavirus, but even before then, the move had kind of started. So I got to ask, is this now the default? Is this the new norm? Because we had that brief rotation, and by brief, I mean a few months into value, and cyclicals as the 10-year yield was rising. That was from basically September to December at various times, but that's out the window in the new year. So kind of looking like a mirror image of last year, with the exception, commodities are not rallying. And commodities are falling in response to the coronavirus, decreased demand, copper having a terrible day.
7 days in a row? That's right?
It could be. I could type it in here. But so copper and crude oil and just about the entire complex, except for precious metals, which caught a little bit of a bid today in response to that, flight to safety, you want to call it. So the commodities acting a little differently, but a lot of parallels to last year.
Well, and I guess the question is, we can see these kind of moves on a one-day basis, right? Obviously, the market goes up and down. But there's just a growing sense, at least from the sentiment that I kind of can feel out there. We can all kind of feel out there, right? We're all reading the same stuff on Twitter, that people are like, well, eventually the market has to go down, right? People have this just insistence the market has to go down. But you say it reminds you of last year's market in a lot of ways. Guess what? Market didn't go down at all last year. So I guess the question is, what do we need to see in this? Like, do we need to see those big caps roll over? Because we've already seen momentum names get crushed for a couple of months, and the market did, oh, by the way, just totally fine. We continue to see this rotation in the market. Is there something on your radar that would say, okay, now we've got a market in a corrective phase? Obviously, we've got to go below the 200-day, the 50-day, all that kind of stuff, but just from a single stock basis.
Perfect question. I was concerned last year in late July and August when some of the big software names like Apple, well, I don't think Apple was at the time, but some of the Microsoft, Adobe, Autodesk, a lot of those started going down. They peaked, they started hitting stops, and it looked like things were starting to roll over because those were those big cap software leaders that had responded so well because they were momentum and growth names. But then, even when interest rates, the 10-year yield started climbing again, we saw values and cyclicals doing well. Guess what? They picked up again. So I think they've been kind of impervious to the interest rate environment, but if something big like that started to roll over, Apple is a perfect bellwether as well. That's the most heavily watched stock in the world, and people got its valuation so wrong for so long, they didn't realize the bull case in it. Well, that's going to come to an end. So, there are individual stocks that you can look at and sectors, and so, I'd watch those software names again, especially.
And it's funny, Jared, just pulling up the software portfolio that I have here. With the exception of your Box, Dropbox, Workday, which I think have some, and Workday is maybe the exception, but Box and Dropbox have some structural issues in terms of people understanding what the business model is. All these names, Paycom, IBM, ServiceNow, Fortinet, Citrix, they're all within 10% of their 52-week highs. Zendesk is less than 10% off its 52-week high. Autodesk, a name you mentioned, was green during today's session. So all these stocks, to your point, fully repaired themselves and then made new highs, in many cases, record highs, and they're still basically at those levels. And so maybe that trade, and we talked so often about the Philly semis rallying and how that cyclical trade was so constructive for so long. So
and that's another sector industry group that did so well regardless of the interest rate environment. I'd watch the SOX, see if that rolls over. And as far as software, I watch IGV. That's the expanded tech software. That's a great one to watch. And so we have these things we can watch on a daily basis, but one day a trend does not make. So I wouldn't get too worried about today. And again, it's responding to macro news. People were just itching to put, take some money off the table here, and there's a good excuse. So I don't see this as the top.
Love taking money off the table, right, as housing makes 15-year highs with some of that recent data.
Yeah.
Because the economy obviously in a terrible state when the housing market continues to be red hot. All right, for another time. For more on today's market action, though, let's go to Inez Ferre, live from the floor of the New York Stock Exchange. Inez.
Miles, Intel was the Dow leader today. Intel ended the session up 8% on the heels of its quarterly earnings. Also, Amex, American Express, up more than 2%. Boeing today flipped into the green. It ended the session up more than 1.5%. That's on the statement, the FAA statement, saying that it is very pleased with the progress that Boeing has made over the last several weeks. And also a Reuters report that the FAA chief told the airlines that approval could come for the MAX could come prior to a mid-year. Meanwhile, Boeing earlier had been in the red earlier today after a report that perhaps it was considering cutting its production of the 787 Dreamliner. Meanwhile, taking a look at some of the laggards today, Dow Inc. Extending its losses from earlier this week. Also Merck, JP Morgan Chase, Walgreens, and United Health as healthcare and financials led the losses today. Today, oil was under pressure as well, of course, over concerns of the coronavirus and what that could do to oil demand. Miles, Jen.
All right, Nez Ferre, have a great weekend.
You too, guys. Have a good one.
Do you know your credit score?
Sounds
like a song. FICO, it would be a bad song. FICO has announced updates to its credit scoring algorithm, which could change where your credit score sits. Joining us to share what we will all need to know about the changes is creditcards.com analyst Ted Rossman. So Ted, what exactly, I mean, I've seen all these different headlines and stories. Just break it down for us. What did they actually change here?
The big change here is that FICO is introducing trended data for the first time. So one way to look at that is, are you getting better or are you getting worse? They're going to put more weight on recent behavior. So if you're somebody who's been paying off debt, that's going to reflect more positively. On the other hand, if you're somebody who's been taking on debt in recent months, they're going to view you more negatively. So it's really, what have you done for me lately?
And I guess compared to the old paradigm, and how often, I guess, a two-part question here, how often does FICO kind of change the way they're looking at consumers? And then two, how different from the way that FICO had been judging credit scores, and we can see their credit scores up sharply along with the broader economy. How big of a change is this from where we were, I guess, last year?
They do a big software upgrade like this every 5 or 6 years. And what's interesting is that not everybody upgrades at the same time. So it's just like your iPhone. You know, some people still use the 6 or 7, other people have upgraded to the 10 or 11. The most common FICO system in use with lenders is FICO 8, which came out in 2009. FICO 9 came out in 2014, and then now we have a new one coming out later this year. So the bottom line for consumers is, do the right things. Pay your bills on time, keep your debts low, don't apply for too much credit all at once. If you do that, you'll be just fine regardless of which algorithm's being used.
I want to go back to the financial crisis because there's one story in particular that just stands out to me, and that was entire zip codes were defaulting on mortgages almost regardless of what their FICO score was. Do you guys back test these algorithms, or are they back tested? And I'm just wondering, would this have changed FICO scores, the evolution heading into the great financial crisis?
Well, you bring up a good point here, and Miles referenced it earlier about credit scores have been rising. And some of that is an improving economy, low unemployment, but it's also that all these defaults and delinquencies from the Great Recession have come off the books because those stay on for 7 to 10 years. So we're pretty much past that at this point. FICO says these new revs will improve defaults, lower defaults by 9 to 17%, depending on the financial product. So this is really a fine-tuning. It's maybe not as apparent as some of the other recent revisions, like when they took off paid collections and they deprioritized medical debt and they took out public records, and that stuff was a little easier to point to. Today's changes are a bit more nuanced, but still meaningful to lenders.
So if you do all the right things, as you said, you'll be okay. But what if you can't do all the right things? What if you've already made mistakes? I mean, is this going to hurt the credit score of people that are lower income or having more issues with their own personal balance sheets right now?
Big picture, it's neutral. It sounds like about 60% of people will see a more or less unchanged score. 20% will go up by 20 points or more, 20% will go down by 20 points or more. So writ large, it's about the same. At the household level, it will matter. your individual behavior. So that's where you can do things like bring down your credit utilization ratio. So that's credit you're using divided by total credit limits. And then also look into new programs like Experian Boost. This is huge, especially for young adults who may have trouble establishing credit. Experian Boost lets you opt in. You can share your bank account info. They're looking for on-time cell phone and utility payments, stuff that didn't used to count in credit scoring. Most people who opt in are seeing a benefit. The average boost is 13 points. That's actually a big deal.
So we're talking about an environment where, and this kind of goes beyond the most recent news, but credit scores overall are higher. You say that this latest tweak is kind of a neutral development for credit scores in general. This is more of a speculative question, but do you see, FICO and some of these other companies, Experian, in the credit game trying to develop an entirely new system to judge consumers, to figure out new ways to sort us? Because everyone kind of understands now through sites like yours and many others, here's how you do a good job with your credit score. Do banks want a new way to rank their customers to kind of increase those, increase the rates they can charge to a variety of consumers?
It's a very traditional industry. So something interesting about this week's changes, they're unveiling two parallel systems, 10 and 10T. 10T is better because it includes trended data. 10 is out there because it's less of a technical lift. A lot of these lenders are wary of upending the systems that they've used for years and years. And by the way, mortgages typically use FICO 4 because that's something that's accredited by Fannie and Freddie. So change comes slowly. There's stuff going on around the margins like trended data, alternative credit. Even the stuff, though, that's hitting the mainstream as alternative credit, like Experian Boost, it's not that alternative. I mean, looking at cell phone and utility payments is not that different from other loans. There's wacky ideas like, if you shop at a discount store, or if you shop, for groceries more than restaurants, or you have a well-organized phone contact list. That's experimental. That's not mainstream at all.
Well, the fact that FICO 4 is the mortgage thing kind of says it all, right?
Yeah.
They should put in your Uber rating.
Well, that's the thing. It's like fintechs want to hack everything, but obviously it seems like these companies have a pretty good stranglehold on the sorting of all of us.
Ted Rossman, creditcards.com industry analyst. Have a fantastic weekend.
Thanks, you too.
And coming up, Tinder introducing a panic button as it tries to beef up security. We're going to talk to the head of the company who's making it all happen. The Noonlight co-founder will join us coming up right after this break. take a look at some of the stocks that were making moves during today's session. DirecTV, the company revealing that its Boeing-built satellite may explode in orbit after suffering major damage to its batteries in December. That stock down fractionally today. JP Morgan, after the bank revealed it paid CEO Jamie Dimon $31.5 million for his work in 2019. That includes $6.5 million in cash and a bonus of $25 million in stock. And Broadcom, the chipmaker, struck a deal with Apple to supply wireless components for the company's products through 2023 in a transaction estimated to be worth some $15 billion. And GE, the FDA warning hospitals and healthcare providers that a third-party cybersecurity firm identified flaws in some of the company's medical products.
Just when it seemed like that stock was gonna
That stock, I think it outperformed the market today. So,
yeah. But I thought it was gonna go to like $15. We had a note this week that said 14.
Yeah, 11.71, stock down 0.5%. Earnings for them was next Friday.
Next Friday. Mid to upper single digits.
I'll take your word for it. You may have heard about Tinder adding a panic button to its dating app this week. How does it actually work? Joining us now is Nick Draghi. He's the co-founder of Noonlight, which is making all of this happen. So, Nick, Match Group revealed it's invested in Noonlight with the hope of rolling out this safety feature across all of its apps, but it's starting with Tinder. How does it actually work?
Yeah, so first off, thanks, Jen. Thanks, Miles, for having me. Really appreciate it. So the first version of the experience that we're launching allows Tinder users that have recently matched with someone to proactively share information about their date. And so profile of the person that you're matching with that has a picture of them, some description of them, as well as the location and time of the date. And then in the event that you are on this date and you feel like something is awry, or maybe you are in an emergency and you trigger an alarm, we have all of that information and we transmit that to the appropriate first responders and dispatchers so they have that context when they're responding.
So then I guess, and this is just a basic question here, Nick, this is going to be a functionality inside of the Tinder app. I'm not going to have to download Noonlight to have this. This will be, they'll integrate your technology into Tinder, so this will be available for users?
No, it's a great question. So you will have to have both apps. And the Tinder experience is where you'll be adding feature or adding information from that particular date or match. So you'll be adding it to Timeline, but then that'll pipe that information over to our servers. If you want to trigger an emergency, you will need to launch our app or trigger an emergency with one of the various integrations with hardware products that we work with. And the reason that we sort of thought through that is the ability to, the reason to sort of keep them separate is it doesn't make a lot of sense if you're on a date that you're going to be going back into a dating app. And so in the sense of trying to keep it discreet and enable that, it makes sense to keep the products separate.
Jared Blicker here, and of course I'm asking for a friend. So let's say that somebody presses the panic button. What happens to the other person? Does that information get fed back to Tinder? Does it trigger any kind of consequences other than just alerting the authorities?
Yeah, it's a good question. So we will be sharing with the users' consents that have experienced an incident. We will be sharing those incidents back with Tinder so that they can take the appropriate action for those bad actors on the platform.
So, I don't know, I'm kind of like sometimes obsessed.
I watched your segment yesterday, and I knew there was some skepticism coming.
Sorry.
So Nick knows I'm pro Noonlight, and Jen, who's a big safety guy, skeptical.
I didn't have enough time. I was going to get a Miles shirt.
Team Miles. Don't worry, we have a lot of Team Miles people come on the show. So, no, I am very pro safety. I have that Citizen app. I don't know if you guys have that in Los Angeles or St. Louis, and it goes off, and then I know what's happening around me, and I get all freaked out. But then the New York Times had all these stories about being the location services and how people people know where you are and the threat of privacy around that. And so I just wonder with this as well. I know Gizmodo had a story out today saying that you guys are sharing your data with ad tech companies, which I saw you disputed in the story. But can you what are the privacy restrictions on here? How do I know that if I'm using this, it's really just for my safety, nothing else is being done with it?
Yeah, it's a great question and a fair question. And I think it's something that all technology companies in today's landscape need to answer. And, for us, we do take privacy very seriously. We are not sharing any user's data or selling any user's data with third parties. The companies and the technology platforms that were cited in that Gizmodo article are used for attribution, so we understand information about where the users are coming from. And then we're using that information to essentially improve in-app performance and messaging. Again, there is no monetization that is happening off of that user data. For us, the primary parties that we're sharing data with are the first responders and dispatchers in the event of emergency. And that data is only available for the duration of an alarm. So the minute that alarm is closed out by our monitoring centers and we know that a response has been sent, then there's no one else that can access that information.
So I guess then a more broad question about where you think the space might be headed, right? Because, a lot of companies have a lot of data on a lot of consumers, and it seems now that every view of that at least from the press side of it, is kind of a hostile view towards why does everyone have all this? What are they going to do with it? Where do you see the data world headed? Because everyone, I think 5 years ago assumed, great, everyone has all the data, it's going to be all friendly, we can sell the data and that's going to be fine. And clearly that paradigm has shifted pretty sharply in the last few years. So as you guys at Noonlight look at your journey over the next few years, what kind of assumptions have you made? Where do you feel like that industry and how you treat data is headed?
Yeah, well, I'm not going to pretend to be an expert on data and privacy across the entire tech space. I can speak to it from a public safety and emergency response and personal emergency services platform. And for us, data is important. It is the difference between someone potentially getting the help that they need and or not. And so when we partner with companies like Tinder or whether it's hardware devices in the home, the data that they're transmitting to us is the data that we're using to take actionable steps to respond to that particular emergency. And there's no other purpose or use case. We're not looking to monetize that information. And so from our perspective and in our space, I don't see that changing. I can't really identify any secondary or tertiary monetization streams off of a user's data in the public safety space. And the data that we're using is really meant to for the best interest of that particular user and the people that they care about.
You guys have a lot of different partners that are out of there. And in my house and in my life, I have a lot of different places that I could use this, right? I've got Alexa, but I also have Google Home, and I have Nest Cams, but I also have Blink Cams, and I take Uber and I take Lyft. How can you guys make this something that could work for people outside of a dating app, but across all of these platforms? Or does it, to succeed, do you think, need to be in an ecosystem? Like, is the best thing for you guys to be bought by Amazon and live in an ecosystem?
Yeah, it's a good question. The way that a lot of people, when they talk about us publicly or they write articles about us, they want to try and bucket us into being a safety app. And I think it makes sense because that's where the millions of users are and that's how people know us. But really, we're a safety platform, and it's the technology that is underpinning and underlying that safety app that we have turned and opened up and allowed other companies to integrate and use to enable safety and emergency response features of their own. And our vision is to try and bridge all of these spaces together. And so that you have this same company that you trust that's protecting you when you go on dates. And it's the same company that you trust to connect to your home security hardware and systems. And that's why you're seeing us work with some of those home devices, because we think that the best experience for safety protection in the future is actually going to be one that has the information across all of your various sectors of life and the technologies you use and the hardware that you have.
Interesting stuff. Nick Draghi is Noonlight's co-founder. They've got a new partnership with Match. We'll stay in touch, see how this all develops. Have a fantastic weekend.
Thanks for having me. I appreciate it. Bye.
All right, first, it was Elon Musk smoking weed. Now Joe Rogan has done it again with his latest move. I guess he'd say sending the internet into a frenzy, but sending the Democratic caucus into a frenzy. We'll talk about that coming up right after this break.
And now here's Miles with a look ahead at what will be making headlines next week.
All right, we got the busiest week of this earnings season on deck. Over 30% of the S&P's market cap is going to report results this week, according to data from Bank of America. This means it's a great time to be a stock picker. Now, obviously, all active managers think it's always a good time to pick stocks, but when the market offers more volatility in individual names, the opportunity to find a winning or losing bet does expand, and this is what the week ahead will be all about. BofA highlighted in a note to clients this week that when more than 40 members of the S&P report results on any given day, the average performance dispersion widens by almost 20%. In plain English, it means that more earnings is more big stock moves. That's it. So on Wednesday and Thursday, we'll have more than 40 members of the S&P reporting their results. And as the old saying goes, shoot or shoot. And this week will offer investors the most shots. Now, in terms of the actual calendar, things are really going to heat up on Tuesday. Apple, eBay, Starbucks, AMD, all out with their earnings after the close. On Wednesday before the open, we'll get earnings out of Boeing, MasterCard, and McDonald's. Then after Wednesday's closing bell, Facebook, Microsoft, and PayPal set to report their results. Thursday morning, Coke, GE, UPS, and Verizon set to report earnings. After the bell, we get Amazon, Visa, and EA. And it's not done yet. Friday morning, Caterpillar and ExxonMobil among the highlights there. You can see in logoed form here. Tesla also reporting their results on Wednesday. But that's not all, folks. On the economic data side, we get the first look at fourth quarter GDP. That should show the economy grew at an annualized rate of 2.1% in the final 3 months of the year. Also on Wednesday, we have a Fed meeting. Central Bank expected to keep their policy rate unchanged. Could get some comments from Jay Powell. Of course, the phase one trade deal signed after the Fed's last meeting. Now we've got the coronavirus. We'll see if the housing market could come up. And then we've also got pending home sales, personal income, Case-Shiller home prices, and 2 readings on consumer confidence due next week. Full 5-day week, folks.
Yeah.
A lot of stuff. Really fun.
It literally does not get any bigger than
Seriously,
that.
this is...
Throw in impeachment.
This has got to be one of the 3 or 4 best weeks of the year.
Yep. When you
Maybe
get
5
the
or 6.
Fed with the Super Bowl of earnings.
Tremendous stuff.
And headline risk from coronavirus.
Right.
No, it is
into the weekend with a messy tape. It's great stuff.
It's always interesting when earnings are coming out, but we've moved along to something else because the earnings are from the last quarter.
Right. I see.
Yeah, but you got guidance.
Yeah, we're going to get the guidance. I know Jay Powell got a question on coronavirus. Something will happen.
Yeah.
He will.
He will, yeah.
Man, I mean, you get 8 questions a year with the guy. You're gonna ask him about coronavirus.
By the time
There'll
we
be
get to
3
the
or
end,
4.
I know.
he will get a coronavirus.
I know.
Well, I think.
Brian Chung will not ask him about
ABC News, don't
coronavirus, I'll tell you
disappoint me.
I will take the bet. Bernie Sanders has gained an unlikely endorsement. Popular podcast host and TV personality Joe Rogan, and it set the internet on fire. Rogan said on his podcast that he will probably vote for Bernie, and that the senator from Vermont has been consistent throughout his career. Bernie supporters criticized him for accepting the endorsement due to previous controversial comments from Rogan. Lit the internet on fire. That's where you live, so.
Yeah.
Was it literally on fire? It's a big deal because Joe Rogan is closely watched.
I mean, Joe Rogan's following, for the folks out there who are uninitiated, is not only massive, but it's dedicated, it's rabid. He has tens of millions of downloads on every one of his podcast episodes, which, Jen, as you know, since you listened to the Elon Musk episode,
one. Very long.
They're all several hours long, and I think there's multiple of them a week. There's been like 1,500 episodes, and I mean, you know, I don't mean to whitewash like Joe Rogan's past commentary. It's not like he's always been the friendliest to certain marginalized community, but he has a huge base of fans that will mobilize, and I think it's a big deal that he said he likes Bernie.
I'll tell you what, interesting thing to me is always watch who signs on to Bernie, because he came on my radar after the GFC, and he was critical of the big banks. And at the time, there was this strange allegiance in certain idealistic ways between libertarians and the socialists. And so the extreme left, and you could call them not necessarily extreme right, but at least the libertarian faction. And so that's where I think he's coming from. I don't follow his podcast. I'm not a podcast guy, but that's where I see it coming from.
Absolutely. There's always been so much crossover between libertarians and Bernie. I agree.
And you can see from the last election, politics makes strange bedfellows. And to get elected, you need to come up with an interesting coalition of people.
10 days from the Iowa caucus, folks. 10 days, then it gets real. I'm excited. All right, coming up here, we're going to quickly preview some of the biggest tech earnings next week. Plus, Reggie Wade stopping by for an unboxing of the newest Chinese New Year sneaker collection from Jordan. We're back with all the merch right after this.
Just can't ship them in.
Back to the final round here on Yahoo Finance. Miles Ludlam with you in New York. I am joined, as always, by my co-host, Jen Rogers, for the final 25 minutes of today's program. Also, stopping by on this Friday, Yahoo Finance's resident technician, Jared Blickery. What's your official title? Do you have a title?
Sometimes I go by Global Markets Reporter.
Great, we'll go with that. Yeah, we like to give everyone the full title treatment here.
Officially, it's Markets and Data.
But Global Markets
Reporter.
Correspondent?
Liaison?
Chief Correspondent?
Liaison.
Chief Data Technician. All right, let's take a look at where the market settled on this Friday. Worst day for the S&P in 4 months? 3 months? 3.5 months. 0.9% decline. We were on track for the first 1% drop we've seen since October, but this 90 basis points drop, still the worst drop we've seen since October 8th. Kind of a sloppy tape out there all day. We opened in the green. The NASDAQ actually hit a record high earlier in the session before retreating. We've got the coronavirus concerns. We had an inversion on the VIX board. We have a lot of earnings next week. We have the Fed. We have treasuries rallying, a whole mess of things. So it'll be very interesting to see where this market goes, though. As viewers of this program know, about 40 minutes ago, Jared and I were discussing the market over at the touchscreen. And Jared, I guess, broadly speaking, technically the market's still in pretty good shape.
Yeah, and we were looking at that long-term 6 months trend downwards in the VIX, and so of course that's negatively correlated with stock prices. And even today, VIX did not close at or above a level, but it probably will soon. It could be next week, it could be in the coming weeks. It has to do so eventually. That's going to be the sell signal that I think will lead to a larger correction, not even necessarily 10%, but I think this was just an excuse to take money off of the table heading into a weekend when we have some legitimate fears about this coronavirus, which is just kind of dabbling its way, at least the confirmed reports, into the US, into France, and of course, China is closed for a week. We're still going to get headlines, but their market is closed.
And news like this doesn't stop for the weekend.
Yeah.
Let's turn now to our top takes, the stories we're watching today in today's market. Tech earnings are front and center next week with reports coming out of Amazon, Facebook, Apple, Microsoft. So, I mean, it's a slew of companies, but these four are huge. There are big market cap companies. These are some leaders here. We've had Netflix. Who do you think is the most important one out of this batch to be looking at?
Well, I think Apple, because of its sheer outperformance from the market, it's up 90, 100% over the last year. It's a bellwether. Everybody wants to be long it if they're not already. They want to be long some more. So if Apple rolls over, that's going to be a problem for the market. But notice what happened last year, a year ago, they pre-announced when they had something really negative to say. I don't think they're going to shock the market. If anybody's going to shock the market, maybe Facebook, because they're so dependent on that average. They're really a one-trick pony. They're not going to monetize WhatsApp. So we'll see there. Yeah.
Facebook.
I think the company we didn't list is Tesla. That's going to be the most interesting report because we talked about the bonus structure.
I want to see that up another 100%.
That's going to be
all that stuff. But I think the story here that is been happening in the background of all the tech noise, because the company is doing relatively well and it's not the most exciting thing, is the Azure versus AWS battle. So I think those two companies, does Azure, and then I guess we'll see Google Cloud products next week, or the week after next, if they continue to take some market share away. But, AWS has a huge lead on the cloud space, but there's more and more money moving into the cloud, and we've seen on an absolute dollar basis, AWS leads by quite a ways. But, one, you have a few questions here. How penetrated is that market? What's the actual TAM of that market? And how much more can Azure and GCP take away from AWS?
And that raises another question that's very much related. How much does Amazon have to spend to maintain its lead? Because Microsoft growth is quite a bit faster in Azure than AWS, which is, what you would expect from an up-and-comer. But I think margins are going to be first and foremost in investors' mind with respect to Amazon, not only the AWS side, but also in its e-commerce business. That's come under pressure too.
And also remember the whole search story there in advertising, which we've been talking about with the note today.
That's another $8 billion right there. What are they going to do with that?
And the trouble for Amazon there is, there's been some commentary that Amazon's actual experience buying stuff is worse because they're addicted to the money they're getting from the advertising, right?
That's sponsored.
So everything becomes sponsored. And to your point about profitability, Jarrett, more than 100% of their profits come out of AWS. That's the whole thing. They still end up net losing money on the retail business because of how unprofitable the international operations are. And so, Amazon's doing fine. It's just their free cash flow is still great. That's all Bezos cares about. But it is, how does that kind of look? And do they get rid of Whole Foods?
I'm
not going to. I know that's my pet thing, but it's to see how that's doing.
I'm excited for the AirPods number on Apple.
You think you're going to get one?
I already have them.
I guess to Jared's point, if it's good, they'll say it.
They'll say it. They'll get something in there that quarter. It's going to be, I don't know. There'll be some commentary, and I want to know what it is. It's a huge week. You're not going to want to miss it.
Yeah, we'll be here.
We'll be here. You'll be on the 9th floor.
Oh, yeah.
You'll be breaking the results. We'll be here.
Well, in other shows, I will be down here.
If you are the chief liaison for global markets, you need to be in the newsroom.
Would that I be able to hold up to that title, yes.
That's right. All right, well, Jared alluded to it earlier. The Chinese stock market closed next week because it is Chinese New Year. And celebrating Chinese New Year has become an annual tradition for Nike's Jordan brand. This year, the brand is releasing 3 sneakers, getting inspiration from Chinese paper cutting and the Chinese ancient coin graphic design. Reggie Wade stops by now with all 3 models here arrayed before us. So, Reggie, I guess we'll just start with the shoes we're looking at here and how Nike tends to approach this holiday.
Well, it started in 2016. Nike decided to do its first Chinese New Year collection. They did models such as the Jordan 12s, the Jordan 3s. So now we have 3 sneakers. We have the Jordan 1 right next to Jared. We have the 13 in front of Jen, and in front of us here we have the 34. And these are actually the pair that Zion Williamson wears. Not the same colorway, but the same style here.
He wears these?
Yes, no, those are Nike 1, so no NBA player wears those.
I really like those.
Yeah, those I think everyone's favorite, and those are limited, only sold in China, and only 5,000 pairs. So to have a pair here at Yahoo Finance is a rarity.
So I guess, we can kind of go a few ways. What stands out to me is I love the pink accents, and I love that that's what Nike went with this year. But there's also that detailing, and I don't know if we can quite see it on camera, but there's that circular detail, which is, as you told me, to me it looks like the Louis Vuitton logo, but it's actually inspired by Chinese coins?
Yes, by Chinese traditional coin currency. We have it here on the 34. We also have it embroidered on the 13 in suede. I really think this gives it, like you said, a really luxurious couture look, and really excited that Nike decided to go this route because we haven't seen this in their Jordan line of them taking from a currency. So I was like, that's right up our alley here at Yahoo Finance. But these 3 shoes, they're priced at $130 for the Jordan 1s. $200 for the 13s, and $180 for the 34s. And I really think that they're going to do well. People are attracted to these kind of holiday offerings. We have next month Black History Month, and a slew of shoes will be out to honor that. So I think it'll be a pretty good seller for the swoosh brand.
Yeah, so just thinking about what's happening in China right now, are they going to be able to get these into the country, at least to a lot of the cities there, I think 46 million people are locked down right now. Is this a longer term thing they're trying to appeal to people over there, or is this kind of a short term push?
I think it's a short-term push. I think a lot of the supply was already in the country, so it's there now. If people are going to be able to go out to the stores and get them, that's a different story. You might be right with that, Jared. So Nike might not actually see the fruits of this labor till well after the holiday.
Are these all only in China?
No, just those pair.
Just the ones that you want, Jen.
Only in China, 5,000 pairs.
So you're saying that you can't get these?
No, can't get these in the U.S. anywhere, only in China.
Those will sell out. I don't think they're going to have a distribution.
I have noticed a trend, though, Reggie, when you come on and do these reveals with us. Jen really likes the 1 structure. So these are low.
Yes.
These are low Jordan 1s, but you like the highs with the clock on the lace.
I have something, that I'm going for. These are cool, though.
Sneakerheads always have a certain silhouette, especially with Jordans that they gravitate to. Mine are the 12s. So Jen, I think you're a 1 sneakerhead.
I'm a 1 sneakerhead.
I like 1s. I like my 4s. The 4s kind of. I do like the 13s though. And
I think you could definitely.
I am a
rock that
12,
model.
so I was kind of looking at those and I was thinking like, should I take them?
Yeah, those are size 12.
I think you could wear these.
Well, these are only 5,000. I can't just.
No, but I mean,
as Reggie said, they're like, we would need these.
Theoretically, though.
I don't think this is. I don't think this is me. I'm not a low top kind of 1s kind of guy. I have a pair of high 1s that I like quite a bit, but I like this shoe a lot. I just don't.
I think Jared could pull that off. Jared, you're a low top guy.
Jared was more of a skate shoe kind of guy. And
I've gotten into Vans, I got to say.
Yeah.
I like them Vans.
And what I love here is it is the year of the rat, and rats aren't. I don't know if it's that marketable to put the animal. It isn't as cool looking as a dragon or any of the other animals, but so they have kind of the furry print over here, the gray of the rat, because the year of the metal rat, so a lot of gray tones that we're seeing here. So this is, especially on the internet, this is the one that gets the most buzz.
Yeah.
Are sneakers going as crazy in China as they are here? Like, is that it's the hype beast thing is real over there?
Experts say that China will become the #1 market for sneakers in the next couple of years.
So somewhere over there, there's the Reggie Wade of China, and his desk just has sneaker boxes 8 feet high.
Yes, and not only sneaker boxes, sneaker bags.
All right.
We've done a lot of unboxings here at Yahoo Finance, but this is the first ever unbagging or unzipping, if you will. Nike and Gatorade have collaborated on this. This is Paul George's signature shoe, the Gatorade.
Ooh.
Nike, Paul
there we
George's.
go.
With Gatorade branding all over. And little specks of liquid, that is the Gatorade, that is splattered on. Yes,
yep, I see that.
Lots of effect. And this is the first PG4 ever with full-length zoom, so very comfortable.
Full of electrolytes.
And they have there's a zipper here. Is this a standard PG4 design?
Yes, there's the new design with the zipper. And Gatorade also sent a little towel with the packaging and water bottle with a sample of a Gatorade flavor. So
this is how you can tell all the real athletes, Jen. They have Gatorade towels.
This is a so it's a tie-in.
Yes.
Nike and Gatorade.
Gatorade collaboration, because I mean,
Paul George is a Gatorade athlete as well as a Nike athlete.
They're refueled with Gatorade, so
These are
drink
nice.
it, have
I
it
like
on
that
your
shoe,
feet.
actually.
Yeah, I feel like the PGs are a shoe people like playing in.
Yeah,
It's a very popular shoe for other players.
That and the Kyries. And I always found it strange because if you're playing against Kyrie, like you have his shoes on, so it's kind of that mental thing, like, oh, you're wearing my stuff.
Yeah. All right. Funny how that works. All right, Reggie Wade, fun as always, stopping by with a little bit of product on a Friday, looking at the PG Gatorades there. Jared Blicker, you can go try them out. Have a great weekend. See you back here. Busy earnings week.
Yes, it is.
Rest up.
Get some sleep.
Get some rest. Coming up, Yahoo Finance's big interview with Transportation Secretary Elaine Chao from the slopes of Davos, Switzerland. You won't want to miss it. We're back in 2 minutes.
The 2020 World Economic Forum in Davos has officially wrapped up. But before it did, Yahoo Finance editor-in-chief Andy Serwer sat down with the United States Secretary of Transportation, Elaine Chao. The two spoke about the importance of the annual event and supporting innovation.
Well, number one, I'm always a person who loves to learn. And if you're that kind of a person, you would learn so much by being at the World Economic Forum, because there is such a diversity of experts in practically every subject area that you would want to know. From my point of view, I've just outlined some issues that we are facing with new emerging technologies in the transportation sector. So we want to share our thinking as to what the proper role of government is and what we are thinking in terms of regulating some of these new technologies. And we look for feedback. This feedback will also occur in a more formalized environment, but we're always looking to make sure that the government is doing the right thing. And our posture at this point is, number one, we're tech neutral. We are not into industrial policy in this country. We're not into command and control, and we're not top down. We want the consumer, the consumer to decide how best they want to use these new technologies. So last point, I've talked to a lot of innovators on self-driving cars, for example, autonomous vehicles. And I say to them that they need. I challenge Silicon Valley, I challenge the auto manufacturers, I challenge them to share their enthusiasm, their confidence, and their excitement about this new technology, because it does have certain benefits. It liberates people with disabilities who can now regain their mobility. It helps to restore freedom to people, to the elderly, so that they can be independent. And 94% of accidents occur because of human error. So we need to get that percentage down. And perhaps the new technologies, autonomous vehicles, can bring safer driving and mobility as well. But 71% of Americans are very reluctant to get into a self-driving car. And so I challenge Silicon Valley and also the auto manufacturers, and I say, share your confidence, because consumer acceptance will be the constraints to your growth.
Coming up, the biggest moments that you missed on Yahoo Finance today. We're back right after this.
It's time now for all the best moments that you missed today, right here on Yahoo Finance.
The haters are going to hate on Apple.
I know.
And no doubt.
Well, their ecosystem is so strong, it's hard to hate
But it all comes down to the install base is the golden jewel, and as long as they monetize that, given what we're seeing in terms of the super cycle, the stock has a 4 in front of it in a year.
Everybody is just forgetting about Joe Biden. No one's talking about him. Well, I have to take, if I put Trump away, if I put Trump down here, they're sort of scaled to each other. No one's talking about Joe Biden, but he has been the front runner by a little bit for a long time, and he still is the front runner.
6 years ago, America was not very much in the lead at all. But because of the advent of American technology and innovation and the invention of the reusable rocket, America has now zoomed to #1. So we're very, we should all take great pride in that.
This is not SARS. This is not the Middle Eastern Respiratory Syndrome virus, which causes a 40% mortality rate. So I think everybody has to take a deep breath and just realize we're always going to see new viruses coming out, and we need to take this one step at a time.
I do believe, based on conversations I've had with individuals,
both in the US government and, more importantly, with relationships in China, is that the number that have been reported out of China on this disease are really a fraction of the number of people that have probably had the disease. So if China's reporting about 800 with 25 deaths, we think the number is probably 10 times that number in China right now.
The big change here is that FICO is introducing trended data for the first time. So one way to look at that is, are you getting better or are you getting worse? They're going to put more weight on recent behavior. So if you're somebody who's been paying off debt, that's going to reflect more positively. On the other hand, if you're somebody who's been taking on debt in recent months, they're going to view you more negatively. So it's really, what have you done for me lately?
All right, one final look at where the markets finished the week. Here
Lower
you
for
go.
the week. Lower for the week. First down week of 2020. Of course, there's only been 3 weeks, so no harm, no foul. But an eventful week. Worst day in the market since October 8th of 2019. I think it sets up for a very exciting week ahead.
I think it is going to be really exciting. Is it going to be back to fundamentals
Yeah.
and what's coming out in the earnings reports, what we're hearing from companies, or is it headline risk and what's happening in China? Of course, we have the second reported case here in the United States.
Yeah.
Some concern. We've got big companies, Starbucks and your Disneys and McDonald's, America's biggest names shutting down stores and parks in China. Does that continue?
We'll see. I mean, it's hard to imagine a scenario, right, where the news on the coronavirus gets better over the weekend. And so with a bunch of earnings, as you can see here, that's a very cluttered board coming up this week in a market that's a little bit messy. You know, Jared Blickery saying things are fine broadly, but a very exciting week ahead, I think.
And the Fed.
And the Super Bowl next Sunday.
It doesn't get better. It really doesn't.
That's it.
Have a great weekend. That's all for now from New York. I'm Jen Rogers with Miles Udland, and this is the final round on Yahoo Finance.